here. It is a moment of extreme pleasure to present each one of you present today. Today we are going to have one-day seminar on Ind-AS, conducted by the committee of members of SIRC of ICAI. Today we are going to have the research person, Mr. CA Dr. ChinnSamy Ganesan. Can we have a huge round of applause for him? Thank you, sir. Thank you for your presence. And today he is going to cover for the Ind-AS topic on Ind-AS 16 property, plant and equipment, Ind-AS 109 financial instruments, and Ind-AS 115 revenue from contract with customers. Next thing is going to have our invocation for the ICAI motto song. Here are the few words for Mr. CA Dr. ChinnSamy Ganesan. ChinnSamy Ganesan brings with him more than 36 years of experience in the area of auditing. He is the lead partner of many Indian and multinational companies and carried out audit, advisory or international financial reporting, taxation, due diligence and other assurance services. He was conferred honorary doctorate in the International Financial Reporting Standard for his extensive contribution to Ind-AS and IFRS by renowned foreign university. He is currently pursuing the regular doctoral course on impact of IFRS convergence in India on compliance, corporate governance, quality of financial reporting with Madurai Kamaraj University. Ganesan sir was awarded the prestigious Lifetime Achievement Award in Finance from Rotary International District 32333. Ganesan sir started his practice as a chartered accountant in 1988 and was in personal practice till 2005. He then served as a director in audit with Lovelock and Lewis for 6.5 years and served as an audit partner of BSR and Company LLP for 6 years. He is presently the founder and CEO of Ms. ChinnSamy Ganesan & Co. Chartered Accountant and also one of the senior partners of SNGSN and Associates LLP Chartered Accountant and is the head of audit and assurance practice of the firm. Ganesan sir has presented 1450 papers at various seminars, workshops and conferences both in India and overseas on these specialized subjects. He has assisted 80 plus companies on Ind-AS transition and authored several books on financial reporting and Companies Act 2013. Ganesan sir is advising many boards of Indian and multinational companies and also served as an independent director in several boards. He was co-opted, specially invited as a technical member by ICAI to the Accounting Standard Board of ICAI, IFRS Implementation Committee of ICAI, Auditing Assurance Standard Board of ICAI and continuing as a specialized faculty member for Ind-AS certification course conducted by Accounting Standard Board of ICAI. Ganesan sir is an active resource person for the Accounting Standard Board, Ind-AS Implementation Committee, Auditing Assurance Standard Board, Continuous Professional Education Directorate, Committee of Members in Industry, Quality Review Board, Peer Review Board of ICAI, All the 5 Regional Council of ICAI, SIRC of Institute of Cost Accountant of India, SIRC of Company Secretaries of India, business school like IIM Bangalore, IIM Lucknow, Loyola Institute of Business Administration, Institute for Finance and Management Research, and several universities and colleges. It is very extreme pleasure and honor to welcome Mr. Dr. C.A. ChinnSamy Ganesan on the board. Thank you, sir. You made us a great day and we are feeling blessed to have you on the stage. Thank you. Now I am going to invite our senior most chartered accountant, C.A. Ramaswamy sir, to present short to our eminent speaker, C.A. Dr. ChinnSamy Ganesan, and also to present a memento. Now we are going to have our first technical section. That is the stage we are waiting for, right? So first technical section is covering on the topics of Ind-AS 16 property, plant and equipment, Ind-AS 109 financial instrument, and Ind-AS 150 revenue from the contract with the customers. I am going to invite Dr. C.A. ChinnSamy Ganesan to have on the board.
Good morning to all. And it's really a pleasure to interact with all of you on a topic which is always very dear to my heart, Ind-AS, and of course the topics which has been given to me, the standards which has been given to me, also very interesting. Financial instruments, and then you have revenue from contracts with customers, and of course property, plant and equipment. I must thank SIRC and the office bearers. And of course, I have my close friend also in the council, but because of the code of ethics, I cannot mention his name, who is instrumental for arranging this particular one-day program for Ind-AS. Thank you very much for this opportunity. I normally believe that even though the structure has been given as Ind-AS 16, 109 and 115, I always believe that the way in which we have to present is what is already known to us. We will keep it as the last session. Depending upon the time availability, we can either rush or we can even have a glimpse of the standard. The other two standards which are very important, we will consider those standards first. So I start with Ind-AS 109, financial instruments. The reason for taking financial instruments is that if you look at the balance sheet of any company, even if it is a manufacturing company, I believe that at least 40 to 50 to 60% of the asset side will be dominated by financial assets. And of course on the liability side also, you will have equal domination by the financial liabilities. And if you are thinking that the way in which you are accounting and as per normal accounting standards or Indian GAAP will be the same when you are looking at the Ind-AS accounting for financial instruments, you will have a lot of surprises. So accordingly, I thought that what are all the pain points for the preparers of the financial statement, as well as what is the pain points for the auditors when they are reviewing the presentation of financial assets and financial liabilities, as well as the measurement, remeasurement, etc. That's the way in which I have structured the entire thing. To give you in a simple terminology, this one slide will summarize the entire activity, because we are having already very strong knowledge on Indian GAAP. We will draw parallel from that particular knowledge and how we will move forward in the application of Ind-AS. That's the way in which I was thinking about structuring this entire program. That's the reason why I use the word, what is new. When we say it is new, the first and foremost of anything, an asset or liability or anything which, even income or expenditure which we wanted to recognize, we look for what is the recognition criteria for any asset or liability or income or expenditure. Similarly, when the asset or liability will move out of my books of accounts or the financial statement, derecognition is also an important aspect. This is actually, there was an old standard AS 30 but never made as mandatory standard AS 30 on financial instruments. To some extent, some of the companies have started using it because of the hedge accounting principles which were given in that particular standard. Similar model has been drawn here also. So we will look at the recognition and derecognition principles. And the second is, if I have financial asset or financial liability, how I have to classify that particular asset or particular liability. And once I have classified, is there any change between the measurement principles of one category to another category? Is there any possibility of I can reclassify that particular items as well? So when we are looking at the classification and measurement of financial assets, liabilities, rules are different for financial assets and rules are different for financial liabilities, and rules are different for financial assets which are in the nature of equity instruments. Accordingly, there are three different models which we are looking at, but the basic principle is coming with a concept called SPPI or the business model approach. When I say SPPI, I am continuously using that SPPI. That is the reason why I am expanding that. Solely payment of principal and interest. If the characteristics of a particular instrument is having only the characteristics of payment of principal and interest, nothing more than that, there is no value changes, then we call it as it has a cash flow characteristics of SPPA. If that test has been passed, we look for what is the business model in which that particular financial asset is being held by the entity. Depending upon whether they are using it for trading, whether they are using it for trading as well as holding, whether they are holding it for a longer term, the classification differs. That's the reason why that is important. The second is they have given a specific approach in respect of financial assets which are equity instruments. If an entity wants to use that particular model, there is a specific exception which they have drawn from a normal classification. We will look into that. For majority of the companies, that exception could be of real help rather than impacting the fair value changes in the profit and loss account every quarter. It may be of help. And of course, in respect of recognition and measurement of financial liability, the principles remaining the same. Then comes impairment of financial asset. This is what everybody is worried about. Every audit committee is discussing about, every board is discussing about the expected credit loss model. I am only going to take you through what is the implications arising out of expected credit loss model, what could be the easiest way in which you can handle the expected credit loss. But I must also give you a disclaimer saying that the ECL model which you are creating is to be analyzed on a case-to-case basis, depending upon the business, portfolio management, etc. You will have a lot of changes which has to be looked into. This is a new model. What we were so far using is, if I have identified that this will not be recovered, then I make a provision for that. So the loss is already incurred, or I presume that or assume that the loss will be inevitable, then I account for it. Whereas expected credit loss model starts with the incurred loss model, plus look at what is the present situation and what can go wrong in the future. Take all the aspects together and then try to make it as the basis for setting up a model for creating a provision for the possible impairment of financial asset. Impairment of financial liability, is it any possibility? If I say, you give me a loan and I will test it for impairment, that itself shows that you are not creditworthy, right? So impairment will not come in respect of your liability. And of course, hedge accounting, there is a simplest model which has been prescribed. Previously, hedge accounting is a very, very complex accounting, but under the financial instrument standard, they simply made it to align with the business approach of the entity. There was a rule that it should be effective and the effectiveness should be, there is a rule called 80 to 125. That means it should not be less effective than 80% of the total risk. It should not go or more effective than 125% of the total risk. Now they have removed that rule. They have just given it as the basis in which the management wanted to work out and decide this is my appropriate hedge effectiveness testing. So this is what overall 109 is talking about. Being on a Saturday morning, and this topic is very tough topic also, I thought that I will make it as interactive. So there is a question for you. At the end of the session you can also ask questions for me and I will try to answer that if it is known to me. But let me ask the question. The classification of a financial instrument has to be determined based on A, entity's business model for managing the financial instrument, the contractual cash flow characteristics of the financial instrument, both A and B. D, it is based on the accounting policy choice of the entity. How it should be? Which is the correct? A. Okay. A and B. Okay. Any other answer? Normally we have a feeling that it is an accounting policy choice. So I can select the accounting policy which will impact the way in which I present my assets and liabilities. But Ind-AS 109 read with Ind-AS 32 makes it very clear that classification of financial instruments should be based on two specific attributes. One, what is the cash flow characteristics of the instrument, and second, what is the business model approach of the entity. Both has to be looked into. It is not either or, it should be both. So that's what we are saying. It is classified based on entity's business model for managing the financial asset. What could be the business model? So I may have one asset, financial asset, and that financial asset is held for till its maturity period. Let us take an example. I have a trade receivable, or I have given a loan, and that loan I am entitled to receive the money as per the stipulated or contracted time period. If I am just leaving that till the end of that particular period, my business approach is to hold it till the maturity and get the amount which is determinable or receivable according to the terms of the contract. That is one business model. Now another business model, the same receivable, I wanted to make it as a securitization activity, sell it to another person who is ready to buy it as a portfolio, direct acquisition or whatever name you call. Normally we use the word securitization under financial instrument standard. In that case, you are not waiting, your business model is not waiting only to receive at the end of the period, but you are trying to find out what is the market situation. The market situation gives you better returns when you are securitizing the financial asset and selling it in the market and recognizing the revenue upfront or income upfront. In that case, you have a model where you have a mixed situation. You will hold it till maturity, but at the same time, if there is an opportunity available, you will sell it and make profit or book profit or loss, whatever, depending upon the situation, upfront. This is the second model. Now another model is you are not able to determine. Majority of the cases we will not be able to determine what we are doing, right? So up to the date of redemption or up to the date of the due date or mixed approach, we are not able to determine. In that case, it goes to a residual category, and our model is considered as the business model approach is anything will be done by the entity. In these three situations is what we call it as a business model approach. You put any item into this particular analysis, then you will understand and determine what is the business model approach. Debentures you can take as the basis. You can take even a liability also, financial liability also you can take, because I am talking about financial instrument, and I am saying financial instrument, it includes both assets as well as liabilities. For example, if I have taken a borrowing, what is the plan which I am having to do with the borrowing? Where I have issued, say for example, a convertible debenture or convertible preference shares. What is my idea. The conversion will happen only at the end of the period, or I have also another option to redeem it at any point in time. So this business model is the first criteria to look at. Of course, it has to be combined with what is the contractual cash flow characteristics of the instrument itself. Let us take a simple example of whatever we have done earlier. Trade receivable. What is the cash flow characteristics of the trade receivable? As per the terms of the contract, what is the value at which the goods or services has been rendered? You will be able to collect that money. If at all there is a delay in repayment as per the terms of contract, you may have the right to ask for overdue interest. So it is solely payment of principal and interest is the cash flow characteristics of a trade receivable. If you look at a debenture which is going to be redeemed at a particular point in time, that is also you will go on paying the interest on the debenture, and at the same time you will redeem at the contracted date. Again, solely payment of principal and interest. I have invested in equity instrument. What is the characteristics of that? Is it solely payment of principal and interest? I will also have the next question. If you say yes, I will ask why yes. If you say no, why no? So, what is the cash flow characteristics of an equity instrument? It is not solely payment of principal and interest, right? I am just looking for an appreciation. At any point in time I may sell it, or it doesn't come with a determinable amount to be received after a particular point in time. It doesn't have a maturity date. And accordingly, an equity instrument will not fall into solely payment of principal and interest. Okay, little bit of complexity will take. Preference shares, whether it has the characteristics of solely payment of principal and interest.
Is it cumulative or not cumulative?
Cumulative or not cumulative. Let us assume it's a cumulative preference shares. Then
it should classify as
SPPA. I am making a small change. Cumulative convertible preference shares. So every situation, he used the word cumulative preference shares, means it goes to SPPA. What we normally look at the end of a particular term, what will happen to the particular instrument? If I am saying it's redeemable preference shares, then SPPA. Because at the end of the period, we will end up with getting only the contractual payment arising out of it. If they are declaring dividend, then I am entitled even for redeemable preference shares. Not necessarily that it should be cumulative preference shares. In cumulative preference shares, what the advantage I have is, if the the preference share dividend is not declared and it is accumulating as an arrears, when the dividend is declared by the company, first the cumulative arrears of the preference share should be settled. That's the reason why he considered that there is a contractual payment of interest. Interest in this case is nothing but the dividend. You will see why dividend is considered as interest little later. Whereas if it is a convertible preference shares or cumulative convertible preference shares, compulsorily convertible preference shares or optionally convertible preference shares, same preference shares will have so much of different avdars. For each of the avdar, you have to look into your terms and conditions of the issue, and based on which you have to determine whether it will fall into the case of SPPA or not. When I hold a redeemable preference shares or cumulative preference shares, cumulative redeemable preference shares, cumulative convertible preference shares, again the same assessment I have to make out whether it will, my intention is to hold it till the maturity date and get it converted into equity. Up to that period, contracted payments I will get from that. In that case, I can still, a cumulative convertible preference shares from the holder's point of view can be meeting the SPPA test. That's a way in which the analysis comes in a bigger way. The major problem in the financial instrument standard is also that assessment itself requires a lot of background validation. From the auditor's point of view, from the point of view of the preparers, both are required to be looked at. And accordingly, unless you cross this particular bridge, you cannot even enter into how you are going to recognize, measure and subsequently measure it, and that is the reason why this is very, very critical for us to look at. I am not going through the entire paragraph by paragraph of the standard because of the simple reason I still remember that long back when I started speaking on accounting standard, maybe in 2002 or 2003. One of my friend, after the tax audit period is over, now all of you practicing will be enjoying the tax audit period where you will be started burning your midnight oils, getting up early in the morning, 3 hours of sleep or something like that. And mind you, even after you have uploaded all your returns, you will not get your sleep at 9 o'clock because your body clock has been reset and your physical clock will make you to wake up to 11 o'clock, 12 o'clock or maybe 1 o'clock, 2 o'clock, right? After the end of the tax audit period, one of my friends came to my office and discussing about the issue that he could not get a good sleep because of his continuous working for late hours in the tax audit season. And he asked me, Ganesan, I knowing you that not only in the tax audit period but during the other period also you burn midnight oil as well as you get up very early in the morning. How you are managing your sleep? I said, I don't know, maybe my physical structure is like that. Even if you allow me to sleep while I am making this lecture, I will sleep and continue to give the lecture. That is the way in which I have trained, or I have trained my body. But I will suggest you, you being a practicing chartered accountant, Ind-AS is coming up. You must read Ind-AS and become an expert on Ind-AS to advise your clients. Take the Ind-AS where standard to your bed, read 2 pages. I am giving a guarantee that you will get a good sleep. Next day, 4 of my practicing chartered accountants came to my office and they have said, Ganesan, this is the right time you have to surrender your certificate of practice. I was shocked why I should surrender my certificate of practice. They said, we believe you will earn as an alternative medical practitioner better than as chartered accountant because you suggested to read 2 pages to get a good sleep. But our friend has said that even before 2 paragraphs has been read, he got a good sleep. So that is the strength of Ind-AS, right? If I am taking you also through paragraph wise, most of you will be in a different world. And only I will ask questions and I will answer questions. And maybe they have already given me the memento, I can at any point in time walk out also. So that's the reason why what I am trying to do is, we started practicing this in 2016 onwards, almost 8 years. Maybe some of us are still in the initial stages of practicing this. At least some hands-on we have, 3 to 4 years. So we will only look at the practical issues which are relevant to the financial instrument standard. And to that extent, what is the concept which is required to understand also we will discuss rather than going by various step-by-step program. So the asset can be classified into 3 categories. Financial asset can be classified into 3 categories. One is fair value through profit and loss account. Second is fair value through other comprehensive income. And third is amortized cost. Normally people believe that the amortized cost model is equivalent to our cost model. First remove that mindset. Maybe I can simply say that come out of the comfort zone. Financial instrument standard has made you to make your life hell. That's a very simple thing which you should have. Like you get married, no? Up to that you are feeling that getting married will be really something you will enter into heaven. After that only you will realize what is in that and you will enjoy for it throughout your lifetime. Similarly, the amortized cost model is not the similar cost model which you are seeing or historical cost model. We look into that separately. Fair value, fairly you will know because of Ind-AS 113 which says that fair value is the value at which an asset can be exchanged or asset can be or a liability can be settled between the market participants. That means 2 parties should be ready at a normal price it should be an arm's length price. That's the reason why we are using the word market participants. So that should be the fair value. I cannot say whether the market value is the fair value. Only in respect of quoted instruments, the standard says that the fair value is equivalent to the quoted market price. In all other cases, you cannot simply say that your fair value is equivalent to your market price. For example, a guideline value of a particular item, or in case if it is liable for a stamp duty for in respect of some shares or debentures which you are registering, if it is coming into a particular activity which is not quoted, let us assume. In that case, two people are ready to exchange at one price. I am ready to sell at 100 rupees. Other person is ready to buy at 100 rupees. Whether that is a fair value need not necessarily be. The standard says you may be having a related transaction. So market participants, how they behave or how they agree for a value, that should be fair value. Let us not worry too much on that. That fair value is either accounted through the profit and loss account or accounted through other comprehensive income. The other comprehensive income, there are scenarios where you can actually opt for doing that as part of other comprehensive income. In some cases, you are forced to recognize that only as fair value through P&L account. Only where two conditions, what we have said earlier, business approach as well as SPPA test has been showing that it is only to collect the contracted cash flow, then only it says that the amortized cost model can be applied. Okay. So that is for the financial asset, three categories. Now before I go into a particular category or recognizing that, I have made an investment in a financial asset. That should be recorded in my books of accounts. At what value I have to recognize? My contracted value, or what is the market price or fair value on the date of I am entering into a contract, which is different from the amount actually I have paid, or it should be the policy choice of the entity. For example, when we are talking, yes sir? Cost of acquisition. Good. Because cost of acquisition is the way in which we normally recognize even property, plant and equipment, inventory, intangible asset, etc. Because that is the amount which actually we have given up. So accordingly, that should be the basis in which it has to be recognized. Any other?
Historical cost.
Sorry, sir?
Historical cost.
Historical cost. Okay. Okay. The historical cost alone, sir, when you are looking at financial instrument standard, convert that into amortized cost.
Okay.
Because the historical cost convention will not apply for Ind-AS 109 or any financial instrument standard, Ind-AS 32 or Ind-AS 107. So it is at cost. Okay. Any other answer? It is something interesting. I purchased a financial asset by paying say 100 rupees. Whereas the fair market value on the date of purchase is say 120 rupees. I paid only 100 rupees, that should be the rate at which I have to account for it. This standard says that it should always be or generally at fair value at the inception. So I should recognize at 120 rupees and not 100 rupees. I paid only 100. 20 rupees is, you are asking me to recognize an asset. We will go back to our normal accounting principles, because I always believe that doing a journal entry for every transaction will make you not commit any errors. So if I am paying 100 rupees and I am recognizing the financial asset, normal entry will be financial asset debit to bank account. Now you are asking me to recognize financial asset as 120 rupees, asset 120 rupees, but my credit to bank account is only 100. Where the 20 will go?
Other comprehensive.
other comprehensive income.
Or depending on the policy choice of the entity, how they choose.
Okay, depending upon the policy choice of the entity, whether it's fair value through P&L
P&L or fair value through OCA.
or fair value through OCA. If it is fair value through P&L, it will go to P&L, otherwise it will go to OCA. Any other thought process? The standard says that it is always recognized depending upon how you are going to classify that particular item, exactly what he is talking about. If you are saying that it will be fair value through P&L or it is going to be considered at amortized cost, in both the situation it will go to the P&L. If you are going to classify that particular instrument or particular asset as fair value through OCA, then it will go to OCA. The reason why OCA is not the direct choice is that what you can recognize in OCA has been clearly defined. It says that these are all the items which you can recognize in OCA. Or a particular standard will permit you to recognize under OCA. Otherwise, you are not eligible to move every item to OCA. It should only be as specified in the standard or as specified in Ind-AS 1 financial instrument presentation. Right? Now, this day one profit, we call it as a day one profit, or otherwise the difference between the fair value minus the actual cost of acquisition will go to your P&L or OCA. This day one profit determination itself is a challenge on the first day of your entering in with a financial asset. I still remember that when this initial discussion of India adopting IFRS came, the IASB's chairman has visited India, and there was a very close outreach program institute has organized, and many CFOs, many chartered accountants or institute representatives were attending that program. And the IASB chairman has actually asked, how many of you could understand the standard on financial instruments? This is a simple question which has been asked. And a foreigner asked the question, we are Indians, no? We don't want to give up. Majority of us have raised our hands. In a very polite manner, he said, if someone is saying that they have understood the standards on financial instrument, I normally presume that they have not read the standard properly. So that means if you are not reading the standard properly, you can understand the standard. If you are reading it properly, you will never understand the standard. That's the complexity of financial instrument standard. Right? So, what nowadays, even in films, people are saying, no, அந்த இடத்துல போய் ஒரு twist வச்சாண்டா அப்படின்னா. The financial instrument standard, every place there will be a twist, which you normally experience or normally practice, that will not be followed. Something else will be followed with as a specific rule. So that is the reason why we have to be cautious about this particular standard. Suppose if I am saying, what should be the classification characteristics? Like we have said, no, fair value through profit and loss account, fair value through OCA or amortized cost. Which category I wanted to put this financial instrument? You have to look at the conditions which has been given in the standard. The same condition I have put it as a flowchart. The simple reason, understanding will be easier. I ask the question, what is the screen? Okay, let it come. In the meanwhile, since only you are handicapped and I am available with the resources in my laptop, I will go through that and we can fresh up in case if it is going out of this. Without PowerPoint, we can make a powerful presentation also. What happens in this classification and what are all the conditions? If you look at the very first condition I am looking at is what is the asset's contractual cash flow characteristics. So remember that the first slide itself we have said that two conditions we are looking for to recognize a financial instrument. One is the contractual cash flow and the second one is the business model approach of the entity. So accordingly, the very first question which you are asking is what is the contractual cash flow characteristics of this particular instrument? Is it solely payment of principal and interest? If I say yes, I have to ask the second question because it's a cumulative question. Is the business model objective of the entity is also to hold and collect only the contractual cash flow? Cash flow characteristics of the instrument is also SPPA, and business model is also to collect only SPPA. In that case, any guess? Amortized cost. So it's not market or historical cost, it's amortized cost. Amortized cost differs from historical cost. Let me come back on that when we were talking about amortized cost. Suppose if I am saying contractual cash flow characteristics is still remaining SPPA, but the entity's objective is not to hold and collect only SPPA, and they also have a possibility of selling at any time wherever they wanted to book some profits. Not regularly, they will wait for the redemption period, but at the same time good opportunity comes in, they will exploit that particular situation. In that case, this is fair value through OCI. As I have said, இந்த பக்கமும் இல்லை அந்த பக்கமும் இல்லை என்னன்னே எனக்கு தெரியாதுன்னா goes to fair value through P&L. Interestingly, if you see the earlier clarification or classification of financial instrument under our AS 30, 31 and 32 as well as per our previous IAS 29 and IAS 32, in both the scenarios, they have said fair value through P&L is the first criteria to be determined. The residual category will come to fair value through OCI, whereas now it's ulta. Income from other sources means fair value through P&L. That's the way in which you have to look at. You are not able to determine what is the business objective, but cash flow characteristics remaining as SPPA, fair value through P&L. That is the reason why we are saying when I am holding an equity instrument, I may not be able to determine what I am going to do. Right? Now, let me take another scenario. Business model approach is all good, but the cash flow characteristics of the instrument is not SPPA, could also be possible. The moment the cash flow characteristics is not SPPA, there is no further classification is possible. It should be only fair value through P&L. Now, if I am concluding that if SPPA test is not met, everything should be fair value through P&L, there could be a possibility that even equity instrument fall into that particular category. All my holdings in equity instrument should be classified as fair value through P&L. Right? Fortunately, they have perceived a possible scenario. For example, one company is holding equity shares in group companies. It's a long-term investment and strategic investment. Why should I do a fair valuation at every point in time and take it to my profit and loss account? Because the moment you take it to profit and loss account, it is available for distribution as dividend as well. And also it's a notional profit which you are recognizing only at the time of disposal. You are not going to dispose at all because it's a strategic investment in a group company. Then you should be enabled to use some other possibility. It cannot be amortized cost because it is not having the cash flow characteristics of SPPA, so it cannot be amortized cost. Whether fair value through OCI can be given or not, that is the reason why they have said not only any item, not only equity instrument, they have said equity instrument we will consider separately, we will use certain conditions. But any other financial asset, if you wanted to designate as fair value through P&L, you can voluntarily designate. And they are also giving a small condition saying that it should be a matching concept. Suppose if I am recognizing fair value through OCI and the related income is accounted in my regular P&L, that could be a mismatch of revenue. So in that case, you can volunteer or you can opt for recognizing any financial asset as fair value through P&L. If that mismatch can be eliminated, you can volunteer to do it. This is for other than equity instrument. That means we should have a separate rule for equity instrument. Before that, I just have a quick question. Okay, I permit you to recognize your equity instrument as fair value through OCI as an option. If equity instruments are classified as fair value through OCI and I am disposing that particular instrument and making a profit, that profit has to be recognized where? In P&L, OCI, or I can recognize directly in the retained earnings, or I can take a policy choice. In the P&L. Because OCI is getting accumulated. Once it is accumulated, at the time of disposal, the financial asset itself has vanished from my P&L account. So related OCI should also be recycled. So recycling means I am moving it from OCI to P&L account. It is a normal assumption all of us will have. இங்கேயும் ஒரு twist வைப்போம். What they are saying is that if an equity instrument is held for trading, some of the financial institutions, banks and other entities will have surplus funds, and the treasury department will regularly buy and sell equity instrument because the return on that will be much higher than what they will be trading in any other debt instruments or in the normal business. They may be using the surplus funds for making a higher profit. The idea is not to hold. Idea is not to hold and sell it only for a longer time and sell it only when good market comes in. Regularly buy and sell. Or short-term profit booking is my objective. In that case, they are not giving you any option. They are simply saying go to fair value through P&L. Because your idea itself is to make profits, why should I allow you to take it to OCI? You should always book it in profit or loss account, whether it's a profit or loss. If I say, no, it is not held for trading, in that case, whether the entity wanted to opt for fair value through OCI, it is an option given. So it is an accounting policy choice for you to determine you wanted to use fair value through P&L or you wanted to use fair value through OCI. The moment you are saying fair value through OCI, if I am saying no, automatically goes to P&L. If I say that you can recognize the investment in equity instrument under fair value through OCI category. But there is a star mark which is coming in. What it says that never ever the balance in OCI arising out of this equity instrument will be recycled to your profit and loss account. That means even when the instrument has been sold and you made a cumulative profit or cumulative loss, that cannot be recognized in the profit and loss account. The question comes, the balance in OCI should also be derecognized because the asset itself is derecognized. Where I have to do that? It's a balance sheet to balance sheet adjustment. From OCI it will directly go to retained earnings and it will not be treated as an income in the profit and loss account. This is a very, very stringent condition, but entities will assess at the time of option being exercised. When I am exercising this option, I can understand, I can actually evaluate whether this will be helpful or taking it to the P&L will be helpful. But majority of the cases where we have help for transition, the companies felt that wherever the investment has been held in their group companies, they wanted to use it only fair value through OCI model because their profitability, they don't want profit from operations or profit before OCI. They don't want get impacted by means of the fluctuation happening in the price of the fair market value of that particular share. So they wanted to hold it. It's being notional. At the time of disposal also we don't mind, we will transfer it. Because why they are saying it, we don't mind, is that the taxation under the Income Tax Act is completely different. When you recognize your fair value through P&L account, whether you are recognizing under fair value through OCI account, your taxation in respect of the financial asset will not come into the picture. Because only when disposal comes in, the head capital gains will get attracted, and at that time you are allowed to check what is your cost of investment minus your sale proceeds. That's the only adjustment. Your fair value changes whichever you have accounted so far will not have any impact for the purpose of your taxation. And accordingly, companies are feeling that that will be a better way of handling it. 90% of the cases where we have seen, they have thought about going for fair value through OCA. Only in few cases, they have decided that we will go for fair value through P&L, even in respect of our investment in group companies. Can you guess why they have taken a call? They made a? They have? Sorry sir, a little bit.
They would have had an intention to report.
They wanted to, they have an intention to recognize through the P&L account. I'm just asking what could be the intention, why that intention is come?
Profit.
Okay, there is a pressure for profit for the parent company in their standalone financial statement. In that case, they should recognize through fair value through P&L account. That situation also came in 3-4 cases where the parent company is weak, but the subsidiary company is making very, very good. When the subsidiary company's share prices is going up, they wanted to recognize in the P&L account. So that has actually helped their negative net worth to become a positive net worth also. So it also depends upon case to case where you wanted to apply. The next question comes is that we have certain financial assets, we have certain financial liabilities which are not going to mature within 1 year, maybe 2 years, 3 years. Even let me take an example of rental deposit. So those rental deposits comes with interest free, right? It will be refunded after 5 years, the same amount will be refunded. You will not get any interest. What to do with that particular item? The standard says that you should fair value those financial assets and financial liability also. Similarly, I might have given certain properties on rent, I taken rental deposit, it's my liability. I might have taken some security deposit for giving some dealership, it may be my financial liability. So in all these circumstances, how I have to look at in respect of doing it. The people normally call that fair value of financial assets and liabilities, but it is nothing but adjusting for time value of money. Loosely they are using the word, have you fair valued your rental deposit? Normally it is adjustment for time value of money, and that rental deposit is accounted as per amortized cost model only. But still we loosely use the word, have you fair valued your rental deposit, security deposit, etc. In that case, if there is a necessity for doing the discounting for time value of money, when the necessity will arise, when the instrument carries interest below the market rate, when the instruments carry interest at market rate, when the instrument carries 0% interest, when the instrument is repayable on demand. For example, I am holding a debenture which carries 0.001%. Whether fair valuation of that financial liability is also required. When I am holding a rental deposit which is not carrying any interest, whether fair valuing is required or not. In what circumstances, or in what are all the circumstances it is required to fair value the financial assets and liabilities? A and B. A and C. Okay. A and C. Why, when the instrument is repayable on demand, is not applicable?
Because it will be a current liability and exceeds fair value.
It is a current liability, so the maturity date is not going beyond 12 months. We don't know, even though we are holding that for a very long period by means of renewal of the rental agreement every 11 months. Still we don't know at what point in time the other person will exercise this option to terminate the contract. And accordingly, even if I wanted to discount for time value of money, I don't know what is the period for which I have to discount the time value of money. So accordingly, D is eliminated. D is eliminated because when the instrument itself is carrying the interest rate as per the market rate, the contracted rate is equivalent to the market rate, there is no question of fair valuation comes in because the asset itself is recognized at the normal market price, and accordingly that is not coming in. In simple terms, if the interest payable on a financial instrument, whether it's a liability or asset, is zero or lower than the market price, necessarily you have to make an adjustment for the time value of money. That's the reason why all your investments which are 0.001%, or when we are structuring an equity investment into the company, and that equity instruments is coming at one portion as equity and another portion the private equity is coming as part of your CCPS etc. at 0.001%, or maybe as a debenture at 0.001% or whatever rate, then you have to necessarily look at what is the fair valuation of that particular item based on the market rate. Market rate assuming that I will borrow at 10%, then I have to use the 10% to make an evaluation of the amortized cost. Difference between what the actual amount which I have received, the difference will be considered as unamortized interest expenditure, should be amortized over the period of the particular financial asset or financial liability. Okay. Now let us, okay, when we are having, yeah, please sir. One second sir, the mic is coming to you. Sir, I think automatically off.
So when you look at the market rate, should we determine the period to be closer to what we are borrowing? For example, if we say we have a security deposit, say 5 years, so we should take a borrowing rate which is closer to the 5 years, because normally in real life it will not be equal. So we will probably have a 10-year mortgage or a WCT loan, whatever it is. But how do we typically adjust for that? Okay. Or should we get a quote?
Okay. Sir, this is a very, very relevant point which we have to consider, because the discount rate or the price at which we will work out the amortized cost, we have to necessarily determine what is the thing. What they say is it's the incremental borrowing cost as a normal rate. So incremental borrowing cost in the sense that the rate at which the entity will borrow. If I am a holder, then I have to see the opposite party who has issued at what rate he will borrow. Or if I am issuer, at what rate I can borrow the similar item. The moment I am using the word similar, what he has attributed is the very important consideration. I cannot just equate a 5-year bond with a 10-year bond rate. So I have to look at what is the closure, very close terms, or maybe the term of the instrument. 5 years means another 5-year bond. And then I may even adjust that rate for some other aspects if it is not quoted. There's a fair value measurement, Ind-AS 113 says that you have a market rate, but the market rate is not the exact rate which you have to use for discounting, because some other inputs may be there. For example, my net worth or my weighted average cost of capital will be completely different from another rate which is available in the market. Then I do adjustment for the various risk on equity, my liability, etc. Then I arrive at the cost. In simple terms, similar to the same term of another instrument available in the market, we normally use it. That's the reason why the rate at which the issuer can borrow from the market, we take that as the basis for the purpose of doing this adjustment. Below that rate, I have to do the amortized cost and account it over the period of the term of the instrument. So that's whatever we are discussing is coming from 0% bond. But in case of other cases, 0.001%, there could be a scenario where you will have both income comes in, but that is not coming in accordance with the market rate. So you will get a lesser rate. So the differential we will account for it. If it is a 0% instrument, the income which I am recognizing itself is notional. So accordingly, a compensating adjustment in the P&L should also comes in. So we will account an equivalent adjustment as a borrowing cost also. So there will be a finance cost which is recognized, and there will be a borrowing cost, interest income which is also recognized in respect of 0% bonds. Suppose if it is relating to a rental deposit, notional income will be recognized, but the cost, the matching cost, will be added to the right of use asset and depreciated over the period of the entire asset on a straight line basis. So that is a difference between rental deposit and a 0% bonds, what we normally do. The next question, next possible issue which may be coming in, when I purchase a financial instrument, I incur certain cost. I incur certain transaction cost for acquiring it. Similarly, when I am taking a loan or I am issuing a bond, I incur certain transaction cost for issuing that bond. What to do with that transaction cost? The options, various options available are charged to the P&L account on the date of acquisition, charged over the period of the instrument on straight line basis, added if related to financial asset and deducted if related to financial liability, added if related to financial asset and deducted if related to financial asset, except for fair value through P&L category.
It's a borrowing, you add it to compute your effective interest rate and amortize over the period.
Okay.
So again, the same thing you can approach the other side.
Okay. In respect of a borrowing, you will not add, right? You have already paid it. So you will reduce it from the borrowing.
Effective interest rate.
Effective interest rate model. So in other words, charging to the P&L account is not permitted. Charging it over the period of the instrument is on a straight line basis is also not permitted, because seems to be all right, but the problem which we are having is that straight line basis is not the correct option. Effective interest rate model is always has to be used under financial instrument standard, and accordingly you cannot use it on a straight line model. Third is added if it is relating to financial asset and deducted if it is a financial liability seems to be correct. And what is the difference between C and D? Whether C is correct or D is correct? Huh? D correct. Why you believe that D is correct, sir?
If it is under FETPL, we have to charge it to the revenue. So, because of that, D is correct.
On that.
If since it is charged to P&L account, D is correct.
Okay. So let us just virtually look at, if I am holding an instrument fair value through P&L, at any point in time, the amount shown in the balance sheet will be fair value. If I am reducing that again by means of an adjustment for liability or adding it in respect of an asset, then it is not presented at fair value. So except the financial assets and liabilities which are considered at fair value through P&L, in all other cases, the transaction cost will be adjusted in the value of the financial asset or financial liability. That is what exactly this is saying. It's an increment cost directly attributable to the acquisition, issue or disposal of the financial asset or financial liability. So if it is a financial asset, you will add it. If it is a financial liability, you will deduct it. And if it is financial asset or financial liability stated at fair value through P&L, you will directly recognize in the P&L account. Straight away at the time of acquisition, you will recognize in the P&L account. Right? Then, what I have to do with this transaction cost? The moment, say for example, I am issuing a bond for say 100 million, and I have incurred a transaction cost, issuer, audit fees, other consultancy fee, registrars for the issue, investment bankers, all put together is coming to, say for example 2 million. So out of 100 million, 2 million has already gone. Only 98 million has actually came in, right? I will recognize the asset only at 98 million and not at 100 million. The 2 million which I have already spent, gone from my bank account and reduced from the liability. But at the end of the period, how much I have to pay? 100. So the 2 million has to be used for determining what is my effective interest rate. Say assuming that the bond carries 10% interest, and this 2 million should also be considered. In other words, 98 million has come in, but my outflow over a period of time is going to be 100 million. The inflows and outflows should be exactly discounted so that the end of the period, the closing balance should be 0. Nothing but your IRR. So using your IRR rate, or we call it as an effective interest rate under this standard, you will discount that particular item, or you will identify what is the effective rate, and instead of the contracted rate, you will use the effective rate to add to the liability. So 98 million, first year if 10%, I am supposed to pay 1 million as an interest, so it should have been 99 million, and first year end I might have paid that 1 million, so it comes back to 98 million in a normal accounting principles, right? But here what I will do is, 1 million when I am saying, it will continue to be 98 million at the end of the period, whereas I am paying 100 million. So 2 million is going to be an expenditure at the end of the period, which is incorrect according to the financial instrument standard. So 98 million I will work out whether it will get discounted at 10% or 11% or 12%. You can simply go to Excel, capture in Excel file what is the inflows, what is the repayment terms, etc., etc. Use a simple what if condition. Closing balance should become 0. If it has to be 0, what is the rate of interest I have to consider? Put that as a column. It will calculate and tell you what is the rate. Using that rate, you account it, assuming that 11%, 98 million on which 11% which you will account it as the interest cost. Actual payout is only 1 million. So the balance will be called your amortized cost of the financial liability at the end of the period. That is the reason why I said it is not your historical cost, it is something different when we were looking at. That's the transaction cost account. Now the question which comes to us is, what should be the reason why we are having so much of classification? Financial instrument standard itself, we have said that it's a complex standard. Why we have to further make complexity by creating 3 categories for asset, 2 category for this, and within the 3 category for an equity instrument another category? Whether we wanted to invite trouble for us? But the understanding is very simple. Initial recognition of the financial asset or financial liability will be at its fair value. But subsequent measurement we should know, and after we make a subsequent measurement, the changes in the value of the asset should go where? To the P&L or to OCI, or it should be recognized somewhere else. You should know. That is the reason why the classification is important for the subsequent measurement. So what is the subsequent measurement which we will do based on the classification? Assets and liabilities classified as fair value through P&L. Naturally, we will do the fair value at every reporting period. The difference between the previous fair value of the financial asset minus the present the fair value of the financial asset will go to the P&L account. So suppose if I am classifying debt instrument as fair value through OCI, it will go to OCI because I have decided to consider that under OCI model, so I am taking it. Why I classified that debt instrument classified as financial fair value through OCI, or financial assets classified as through OCI other than equity instrument? Because other than equity instrument, we have for equity instrument separate recognition principle. That's the reason why we had that. Fair value changes are still accounted in OCI, but only condition is it will never be recycled to the profit and loss account. That's the only difference between these two. In respect of all other assets and other liabilities where you are not using fair value model, goes under the amortized cost model. But the classification is determined upfront when you have recognized a financial asset or financial liability, because the presentation in the financial statement should be according to that particular category. Now, before I move on to the next slide, I will ask one question. I have invested in group company. When I said equity instrument, I will recognize that fair value through OCI or fair value through P&L. Assuming that the group company is an associate entity or a subsidiary entity or a joint venture. In that case, can I apply Ind-AS 109 to recognize the investment made in the subsidiaries, associate and joint venture through my equity instrument can I use Ind-AS 109 or I have to look for any other standard? First of all, whether it is a equity, is it a financial instrument?
Yeah, in the separate financial instrument.
In the separate financial statements of the entity, it is still a financial instrument. Okay. In the consolidation, anyway, that will get knocked out. That's what. So, any other views? Any other views in Kerala? I'm going to twist to and that is for your normal accounting as per Ind-AS 28, 27. Okay. Interesting point here is an investment in an associate, joint venture or your subsidiary is not covered by Ind-AS 109. It is not considered as a financial instrument at all. It is considered under Ind-AS 27 or Ind-AS 28 depending upon whether it's an equity instrument in associate or subsidiary. But Ind-AS 27, separate financial statement, where they are explaining how the separate financial instruments, financial statement should be prepared. If I have made an investment in an associate, joint venture or in a subsidiary, I have the option of accounting it at cost. Not even amortized cost. The cost of acquisition I can recognize. That is the normal accounting. Accounting policy choice which they have said was, if the entity wanted to recognize that instrument in accordance with 109, they can also do that. That is an accounting policy choice. That's the reason why majority of the published accounts, if you have seen following Ind-AS, investment in associate, joint ventures and subsidiaries will be recognized at cost and not fair value through P&L or fair value through OCA. Because I don't want to do any fair valuation at all. Interestingly, in one of the cases, I still remember that I never thought that type of interpretation will also come into the picture. Nowadays it is not applicable because of the change in the income tax act. One particular entity which went for Ind-AS transition in 2018, not in 2017, second phase, 2018 it has went through Ind-AS because they have crossed, they are less than 500 crore, unlisted, but more than 250 crore. Sorry, it is a listed company, but net worth is less than 500 crore, so they are coming under the phase 2. So they have had a problem. They have a lot of investment in their group companies. If I am saying these group company investments are not associate investment, then you have to consider Ind-AS 109. If I say, no, these investments are only in associates or joint ventures or my subsidiary, then they have to go to cost model under Ind-AS 27. The dilemma is whether I have to go for Ind-AS 27 or Ind-AS 109. We were called for an accounting opinion because the transition was done by another firm, but they have given a lot of options and they engaged us to vet the assumptions used by the service provider who is helping them in transition. One of the assumptions the service provider has given is fair value through P&L is what he has suggested, and the other option he has given was fair value through OCA. Their worry is whether this will be helpful. At the time there was an income tax provision called as Rule 14A, where it says where you are having an investment in exempted assets, there is a notional disallowance comes under Rule 14A of the Income Tax Act. So when the dividends is exempted, so naturally opening balance, closing balance, average investment which I have made, on which 0.25% notional amount you have to offer as an income. Their worry is every time when I am making the fair value changes, I have to pay the additional, offer this additional income also. Is it any way I can avoid this? when they have asking this specific question, I have told them how you have concluded that these entities are not associate entities. They have said these entities are considered as an associate entities, not as an associate entities, because our holding was less than 20%. So that is the reason why it becomes a financial asset. Then I ask the next question naturally. Have you considered only the voting rights or the shareholding as the basis, or you have also seen whether any other factor to be considered? Because in your Ind-AS 110 consolidated financial statement, control is not defined based on shareholding or voting rights. You may be having only 15%. Balance 85% is held by another group. But because you are the owner of the technical know-how, they might have told that all the policy decisions will be taken by you. We will not enter into that. With 15%, I become the holding company of that entity, whereas the other investor will be a minority interest. If I am calling 85% holding and it's a minority interest, it will be something awkward, right? That's the reason why the standard has used the word non-controlling interest. Controlling interest is what? Non-controlling interest is what? So when you have decided the controlling stake, how you have considered these various options? When we have discussed that, they have said that that evaluation is not seems to be perfectly done. You know that as an accountant or a consultant, what you normally try to do. What is the ultimate answer you want? What are all the ways and means by which you can reach to that conclusion? With the available information, available situation, or within the four walls of law. I tried the same thing. Concluded that all the investments are investment in associates. Accounted at cost. No additional outflow. Problem solved for 3 years. Because what the assessment which they have made was not only their stake, the promoter's stake in that particular company, and the promoter is the chairman and managing director of this entity, and any decision which the other entity's board takes, the views of the chairman and managing director should also be part of that particular activity, based on which you have significant influence on the other entity. Because you are having significant influence with less than 20%, still you are an associate entity for that other entity. First, 3 years went on. Dividend distribution tax has been abolished, and dividend is taxable in the hands of the recipient. Because dividend is now taxable income, it is not an exempted asset. So section 14A is no more applicable. Practical issue being an associate is that every quarter when I am finalizing my financial statement, the other entity should also finalize and give that number for consolidation purposes, because I have to publish both standalone as well as consolidated. The obvious choice is to ask ChinnSamy Ganesan, is there any other possibility? To go back to say, no, it is not investment in associate. I said, possible, provided in the structure you are making the changes. As long as your CMD is not continuing as the CMD, he is only continuing as an MD, chairman is somebody else. Like that we have said that if this structure is okay with you, you can go back and reverse your position from the next year onwards. Up to this year you cannot do. Next year onwards you can do this restructuring of your investment or shareholding pattern, and you can still do that. But I have told that if you are doing this, you are only trying to take a comfortable view for the company, but it may be uncomfortable for the promoters and the directors. Take their view also and take their personal income taxation also into your consideration, and finally take a call. Interestingly, 3 cases come like that, 3 different companies. One group has decided that we will restructure the entire shareholding and go as not an associate. The other entities which has they said that we will consider that as an associate and then classify as a cost model. then they wanted to do it as a fair value model simply because all the investments are there. The other two companies have said, no, it's a very sensitive issue. If you are touching this, even our job will be at stake, so we will not go into that discussion at all. We maintain at the same level. So case to case basis, every practical issue comes in and you have to analyze. And if it is a solution available within the four walls of law, you can consider, otherwise it's not possible. Sometimes people will come with creative ideas. Accounting is not creative accounting. Accounting is not innovative accounting. The moment somebody is creative, somebody is innovative, then there is always a fraud risk in respect of financial instrument according to standards on auditing. SA 240 says if the accounting principles are normal accounting principles, then there could be a possibility of management override of the controls. And you have to look at it. Again, every loser clumps. Okay. The next question is, we were talking about an important aspect, impairment of financial assets. So an impairment of financial asset is normally called your allowance for expected credit loss. If any of your clients are using the word provision for bad debts in Ind-AS financial statement, please correct it. It should be allowance for expected credit loss, because it's no more provision for bad debts or doubtful debts. That means you are still under incurred loss model and not expected loss model. Even if you are doing the same thing but change the nomenclature, the external world will think that you are doing in accordance with Ind-AS. So this allowance for expected credit loss should be done based on 12 months expected credit loss. That means any loss for non-recovery will happen within the 12 months of this particular financial asset, or it may be more than 12 months also. I don't know whether it will happen only within the 12 months or it may be happening even at any time during the lifetime. We call it as a lifetime expected credit loss. It depends upon the nature of credit risk relating to the financial asset. Company can decide this as an accounting policy choice. What could be the better way in which you decide what is the expected credit loss? Because the simplified model for expected credit loss model is 12 months expected credit loss model. Lifetime credit loss model is little complex. So can it be the 12 months loss, lifetime, or depends, or accounting policy choice? See, your expected credit loss, very interestingly, related to the various credit risk associated with that instrument, with that asset. If you are ignoring the entire thing and making only a policy choice, you are not making a clear assessment of the expected credit loss. What are all the credit risk associated with that particular financial asset? You have to look into that. That's the reason why, see, for example, even when I am having a cash and cash equivalent, the expected credit loss model says that you have to assess if there is a probability of default in respect of cash and cash equivalent also. You may be surprised when I am saying that why there is a credit risk with respect to cash and cash equivalent. Assuming that I am keeping a fixed deposit in a foreign bank, that foreign country collapsed, there is a probability of default even for cash and cash equivalent, right? So you should attribute the credit risk involved for each of the assets and then determine what is the expected credit loss. The expected credit loss is nothing but you are considering the past events. That means what is the trend at which you normally having a problem with recovery of your financial asset, and what is the current conditions relating to that particular asset. Maybe past is regularly repaying. The current condition is the debtor has filed with the NCLT for some CARP process. So that means as a corporate debtor he is not able to pay. The current condition also should be looked into. Assuming that he has not filed anything with the NCLT, he is regularly paying in the past. Can I stop at that level and say that there is no credit risk attributed? I should also look at possible economic indicators or economic factors which may influence a possibility of non-recovery in that particular client case. Let us take an example. Let us assume that the amount I am supposed to recover as a trade receivable from my customer. The customer is regularly making the payment. As on the date of the balance sheet also, I have not seen anything. But when I am finalizing the financial statement as an auditor, or when the management is preparing, there is a new development which has happened with respect to some sanction made by the government. For example, Chinese investments, there is a restriction brought in by the government of India, and the way in which they can bring in here and how they can purchase, there are some restrictions. Let us assume that government is planning to bring in some restriction. As of now, it is not planning to bring in some restriction. Or there is a war between two countries. You remember, I can give an example, live example, when the Ukrainian war has been declared and it was happening, we made an adjustment in respect of our expected credit loss for certain clients who are dealing with that entities. And there is a decision made that the crude oil prices will be settled in INR and not in US dollar. We have made a reassessment of the expected credit loss. When there is an American economy witnessing some recession, for example, when the visas are being H1B visa, if I am not wrong, when the number of H1B visa is coming down, we have even considered that as a factor to determine the expected credit loss model. Because the macroeconomic factors has to be looked into, the worldwide recession also considered. So those elements, future elements is also brought in for the adjustment of the amount which you are looking at. So a simple principle is all the financial assets will carry a loss allowance, including your cash balance will also carry a loss allowance. Only thing, when you work out the probability of default, you will conclude that the probability of default is 0. So accordingly, the loss allowance is also 0. But if you are not considering the cash and cash equivalent in your ECL model, your model is not a complete model. That is very important when you are making the adjustment. This is another interesting point. People used to say, sir, he is regularly paying. We never believe that he will have a problem. This normally comes when the amount of impairment loss which you have to account for, ECL amount which you have to account for, is hitting the P&L, and because of that your bottom line which you have decided, it will be year-on-year growth is so much, but that is hit because of your ECL model. The immediate area where people will try to find out is there any tweaking of the model which we have developed. The EC condition which people will say, sir, these are the assets where which we have considered probability at 70-80%. Now there is a big improvement in that particular client, sir, and accordingly we need not even look at that. There is no triggers for considering certain period, which is, say for example in a banking sector, standard assets. In standard assets, nothing to worry, sir, nothing is due overdue. Why should I provide for that? No trigger has come in. Every payment is coming in properly. Why should I consider the impairment loss? Somebody is arguing. Please tell them the standard recognizes that there is no trigger is required for including that as part of your credit risk. The trigger may not be available now, but the trigger may happen in the near future. That is in anticipation you are making an expected credit loss. So that is what you have to look at. The triggering of the event is indicators of impairment when you are talking about your property, plant, and equipment and intangible asset. That type of indicators of impairment is not required for ECL model to be developed. The ECL model, 3 methods are permitted. Whatever model you wanted to use, you can actually use. Probability weightage of how much can go wrong for each of the different portfolio, and based on which you make the provision, and you arrive at what is the present value of the particular item, considering what is the original AAR and what is the revised AAR which you have to consider. For example, if I am giving you the loan today, what is the discounting rate which I have to apply, based on which you can arrive at what is the discounted present value or discounted cash flow which will arise out of it. That's the second model. Third model is a very simple. Management makes an estimate of my original cash collection should be so much, but actual cash collections is shortfall with so much. That shortfall I am considering as the expected credit loss model. All three is possible. But the problem is, in the second and third model, lot of assumptions comes into the picture. Management override will also come into the picture. And according to the best model which everybody can evaluate with respect to its appropriateness is expected credit loss model based on the probability. The probability, what we have seen when we have helped people to develop the ECL model, as long as you are going granular disaggregation of the portfolio, you will get a better understanding of the ECL required. If you are taking overall all the amounts put together, the ECL provision may be higher. So you have to make a disaggregated level, and you can further go down with respect to the business model which you are using. You can think about it. That's the reason why in financial institution, NBFCs, banks, etc., this expected credit loss model which they are assessing, verification of the assumptions used is very important, and how they have disaggregated into various portfolios is also very important. On that basis only it comes to the accounting. So disclosure is coming under Ind-AS 107. Sorry sir?
First case also, so many assumptions are there.
Third one.
First one also, so many assumptions are there.
It's there. But the interesting factor, and it's a very valid point, in the first case probability weightage which I am using, there could be a lot of assumptions which I am using. Even if I am making a small change in the assumption, my desired result can also be achieved. But all the assumptions will be validated. You can think that only auditors will validate the assumptions. Actually, according to the Companies Act, one of the requirements is for the audit committee to validate, especially for the banks and financial institutions. Reserve Bank of India has said that the ECL model which they are using should be vetted by the audit committee, and then the board should agree. Board should agree for the model probability of whatever you have taken. Normally we consider three major items. One is what is the portfolio at risk is what we consider as the first one. Second is what is the probability of default, and the third one is what is your loss given default. That means when something has already become bad debt, how much you are recovering from that. That means even if I am making a provision, it will be recovered subsequently. So to that extent the provision is not warranted, right? So consider all these factors and doing it. When you make assumptions at various categories, that assumption should be valid. Unless you validate that assumption, the model will not be acceptable. So that's the reason why I believe that when this assumption is being validated for consistency over a period of time, in fact in some cases the easiest way, as you are finding out, is to arrive at the desired bottom line is touch your ECL. One small change, your ECL is better, because it's a notional amount which you have created, notional amount of income which you are generating. But when we are looking at in my own other as a practicing chartered accountant or as a consultant or as an independent director, in all the scenarios the views are going in a different perspective. What we normally look at is this consistently this assumption is being applied. Is it a static assumption or it should be dynamic assumption? Every period we revisit the assumption. When we are revisiting the assumption, is there any corroborative evidence to support the new assumption? When they are changing a particular view, what is the new development which is allowing them to have that new view? That also we validate. And when it comes to the audit committee also, we are asking the similar question. We are asking the similar question, why this was not considered in the previous year only when you are bringing it. With all these checks and balances available, I think that the ECL model and probability weightage could be a better choice. That's the reason why I am saying at a disaggregated level when you are doing, you can find out a better way. I still remember that in one of the NBFC when we have made the provision, they were hesitant to give the aging analysis quarter on quarter or month on month. Actually, I have asked for 16 months independent aging to set up the model is what I have asked for. But they have given only 5 years annual number. I told very clearly, if I am taking 5-year annual number, your ECL model will be ECL provision will be very high. They are not listening because the CFO and his team was feeling that giving all this information will take a lot of time, and we don't have enough staff to give all this information. No problem, what you give is what is going to come out of my thing, right? So I just put that model into the evaluation. The provision for the NBFC come to at least 14% of the overall portfolio which they are managing. I said, sir, even all my contemporaries, all my peers are having only 4%. That is the reason why I said you give 12%, you are giving annual number. Not possible. If you are giving, then he said, can I give half-yearly number? No problem, give an half-yearly number. But if you are not getting that 4%, still you will going to give me quarterly number. If quarterly number is also not giving you the 4%, he will give me monthly number. Now you decide whether you wanted to test with half-yearly and then go for quarterly and then go for monthly. I am very comfortable to do all four because every time when I am doing a new model, I am going to charge you. If you wanted to save my fees as well as a correct approach, go for a month-on-month average. Then he has given 60-month number, and when we have assessed, because that NBFC was doing very fine, it is a microfinance company in agriculture sector. When we have actually done that activity, we have found out that the actual rate which they require because of their very good collection efficiency, hardly 2.78% to 3%. Then he said, sir, this is the correct model which we wanted, because CFO has now achieved what he wants to have. But my challenge was with the audit committee chairman. He was a chairman with another financial companies also. He was a, see how it is 3.78%, whereas I am having 4.24% in the other company. And I have to explain to him what are all the assumptions, why that assumption in the other company was different and this company is different. So you should always benchmark whatever you are doing. That will bring you a reasonable conclusion. I am not saying absolute conclusion, but your reasonable conclusion you have reached. After all, audit report itself is only a reasonable assurance only, no? They are not giving an absolute assurance. So your estimation can also be reasonable estimate. Okay. With that, I am covering the practical issues relating to 109, because within 3 hours, 3 big standards, very difficult to cover. So we will break for tea now, and we will reassemble, and then I will take the revenue recognition as the second one, and finally to Ind-AS 16. Thank you. Interesting standard is on the profit and loss account. People believe that the standard is equally complex like financial instrument standard, but I must tell you that only for some specific industries it will be a complex standard. For all other entities, life is same. The same manner in which you have done this before. The reason is, if I am saying my revenue is recognized at a point in time, no change in the way in which you are recognizing it. If you are recognizing your revenue over a period of time, say for example percentage completion method, to draw a parallel on this, there could be a possible challenges which you may have. But we have still experienced with some standard AS7 on construction contract, and to that extent whatever Ind-AS 11 previously we were having that particular standard, which was giving you the same comfort of what we are going to do in Ind-AS 115. The important focus which has changed compared to our earlier revenue recognition standard of your Ind-AS AS9 or your Ind-AS is that you are normally looking at the substance over the transaction to recognize your revenue. But the shift is now, what is the terms of contract you have entered with your customer? Because that is the way in which you run your business. Why should I look at my substance over the transaction? What is the contract you have entered with your customer? And what is the obligation you have agreed to be delivered to your customer? We call it as a performance obligation under this standard. So when your performance obligation has been complete, you recognize revenue. If the performance obligation is being completed over a period of time, recognize the revenue over that particular period of time. When more than one performance obligation is embedded in a contract, split the total transaction price into what is attributable to various performance obligation and recognize when that particular performance obligation has been completed and defer the revenue for the performance obligation not completed. So in simple terms, it talks about if I have finished my obligation of delivering a goods or service, I am entitled to recognize revenue. If I have not delivered the goods or services, but the client has given me a composite value, I cannot upfront take that as an income. That's a very simple logic. In this process, what happens is the contract with the customer plays a bigger role than what we normally look at revenue recognition criteria in the old standard. And accordingly, some of the revenue which you might have collected upfront may get deferred. For example, in a banking sector, you collect upfront processing fee and documentation fee, etc. in respect of a term loan which is more than 1 year term. Normally the bank used to recognize revenue. Even in NBFCs the same was the practice. They used to recognize revenue upfront with respect to the processing fee. The interest is recognized over the period of collection. And if there is an NPA, they don't recognize the interest, and that is maintained as a memorandum account or whatever you call. That is exactly coming from the RBI guidelines. Here, the moment a financial institution, why I am using the word financial institution or NBFC is that for them it is already made mandatory and they are following Ind-AS beyond a threshold limit. If it is an unlisted NBFC, 250 crore net worth, if it is a listed NBFC, they have to necessarily follow. So they are already following, and accordingly, the revenue recognition which they are doing should be based on what we call as the effective interest rate model than the contracted rate model. So if I have fixed 11% floating rate, if I recognize revenue at 11% floating rate on the amount outstanding, it may not be correct. Whereas I might have collected, say for example, upfront processing fee of so much. Like what we have seen in financial instrument standard, the processing fee as an expenditure is spread over the period of the repayment. Similarly, the income should also be recognized over the period of that. The moment I am saying the revenue is being deferred because it is not only for the particular initial acquisition of the contract, but for serving the client over the period of the loan. Similarly, any other cost which you have incurred for acquiring that particular contract. For example, I have engaged a sole selling agent or maybe a direct selling agent for whom I am giving a commission for acquiring a new account. That commission is also not to be expensed immediately. It should also be deferred over that period of time by using the effective interest rate model. So that is the way in which we are looking at, is the transaction price is to be recognized upfront or deferred over a period of time. That is what the standard is talking about. Interestingly, the standard has actually given a step-by-step process. Normally I used to teach the standards or lecture on the standards using a step-by-step process. For any standard I normally have a step-by-step process, but in this particular situation, the standard itself has given a 5-step process. So you have to go through that 5-step process, and then your recognition, measurement, and then your presentation, disclosure, everything will get covered in that particular 5 steps. So we will look into that 5-step process. That 5-step process is actually identifying the contract with the customer. If there is no contract, the standard is not applicable, interestingly. So if I wanted to recognize my top line, there are 2 top lines, right? One is my revenue from operations and another is other income. If I am saying there is no contract with my customer, then it will not be a revenue according to Ind-AS 109. Naturally, it will go only as an other income. So from your operations, you will not have any income, right? So identifying a contract with the customer, and then what are all the performance obligations we have committed with the customer in the contract, whether it is being simultaneously done on the date of delivering the goods itself, or there are some items which has been deferred to a subsequent period. The third step is very interesting step, determining the transaction price. Normally in a contract we will have the price. What is the reason why they are talking about the transaction price? They are anticipating that business contracts are not very simple nowadays. It's having a lot of complexity. Based on the performance, you are giving some incentives to them, or based on a non-performance, you are deducting some liquidated damages from them. Like this, if you are giving any performance incentive or bonus, or having a damages which is being recovered from them, that should also be considered as part of determining your transaction price. That's the reason why the standard says that the transaction price is fixed price and variable price, or fixed consideration and variable consideration. How to determine the variable consideration? The various terms and conditions of the contract should be looked into, based on which estimation has to be made, and then adjusted, added or adjusted against the fixed transaction price. That price is allocated to the various performance obligations. Say for example, if the fixed price is 100 crore, you cannot simply say that 100 crore I will allocate to all the prices, and there is a liquidated damages which may happen, say to the extent of 10 crore, 90 crore is considered as a transaction price according to the standard. You cannot say when the liquidated damages is being paid, I will recognize that as an expenditure, not permitted. Transaction price is determined and then allocated to the performance obligation, and based on which you recognize the revenue, whether at a point in time, for example, it's a product manufacturing company, at a point in time, over a period of time, made to order conditions, you account it over a period of time like a percentage completion method. You recognize your revenue, and lot of disclosures are required to be made. Contract assets, contract liability, reconciliation of the contract assets and contract liability, etc. are applicable. But believe me, this disclosure, extensive disclosure, is complex only if you are having really a contract to manufacture or contract to execute a particular revenue related activity based on made to order, or otherwise contract asset will not come, contract liability will not come. What you will have is only a trade receivable and trade payable. That is the reason why I started saying that for a normal company, this standard is not going to make any difference in the way in which you are going to explain how you are recognizing your revenue. Maybe some small disclosure changes will be there. Other than that, nothing is going to be big impact arising out of it. Contrary to what people have created a feeling, 115 is very difficult standard. Similarly, another standard people creating so much of hype is 116, leases. To my mind, leases is nothing, right? 109 really makes your life a difficult situation. 116 is a very simple standard. You have to only determine whether you have a control over the asset or not. Anyway, there is a speaker in the afternoon. But still, make your mind very clear, nothing to worry too much on 115, 116. Even if there is an insurance company which is going to follow 117 also, to my mind there is no big deal. Okay, so they are only making it simple over a period of time. So what is the difference between the old standard or in accounting standard revenue recognition vis-a-vis what we are going to follow on this? They are using the terminology transfer of risk and rewards in AS 9, you normally say, your Ind-AS 11 also you used to say, the revenue is recognized when the risk of or transfer of risk and rewards of ownership has been passed on from the seller to the buyer. Now they are saying transfer of risk and rewards is no more a consideration for recognizing your revenue. The moment I am saying that, if risk and rewards is not the basis, whether it is continuing to be my inventory or at what point in time that will be considered as my revenue, you will have a feeling. But they are using a different concept. And of course, I am not sure. Yeah. In the third, they are using that concept. Transfer of control is the criteria. But if you read the paragraph of transfer of control, it simply gives you in a different parlance when the risk and rewards of ownership is passing on to the customer. And accordingly, that is the reason why again I am saying there is no difference. How you have assessed. Only difference is if you are still showing your accounting policy for revenue recognition, revenue is recognized when the risk and rewards are transferred to the customer, which coincide with the supply of or delivery of the goods, you are at fault. When you are using the same thing, revenue is recognized when the control over the goods and services is transferred to the customers, which normally coincide with the supply of the goods, you are as per Ind-AS 115. Change of words, nothing great. But interestingly, NFRA has come out very heavily in respect of one review which they have done, saying that risk and rewards of ownership transferred is the basis for revenue recognition, whereas the company is following Ind-AS 115 and accordingly the revenue recognition itself is incorrect. And the auditor has not qualified his audit report and accordingly the audit report is not reliable. Auditor is considered to have negligence of professional way of doing the audit. They have sent a notice. They have concluded. So what we now has to do is that, are we changing our accounting policy, presentation, disclosure in accordance with the new standard is what you have to ensure. If you believe that that is something difficult for me, I give a simple example. I have two theories in my life. One is proud to copy. Second is don't try to invent the wheel, reinvent the wheel. Somebody has already given me something as the basis. Somebody has applied their mind. They have a technical team which has assessed. So you also take it as a starting point. Don't copy paste it straight away. Proud to copy. But copy paste it and amend it to your circumstances. You need not reinvent the wheel because somebody has already invented the wheel. You have to only adjust the wheel according to what is your vehicle size. That's the simple thing which you have to have. The problem which we are having is we are not only proud to copy, we are having the strength of copying to the core extent possible. That's the problem. When I was reviewing one of the work paper file, because this principle is not only talked with the professionals, it's also being talked in my own office when we have our internal training team. No? So the article students and the team members, this is it, Sare Soltar copied everything. So they have copied and pasted, and I was reviewing the audit work papers of a non-banking financial services company. I was seeing the revenue is recognized, or depreciation, that is the best example for you to connect. Depreciation has been considered based on the useful life of the property, plant and equipment. Should have been there in respect of NBFC. What I was mentioning is depletion is considered based on successful efforts method. Just 1 second. Where is the question of depletion comes in respect of a non-banking financial services company? I called the article student, and before that I asked the manager, because manager has also cleared it. I asked the manager, how you have cleared? Sir, you only, I asked him, sir, he said, you only asked to copy. Proud to copy where I was used to say. Very copy good, sir, proud to copy. எல்லாம் கரெக்ட் தான் தம்பி. இந்த பையன் இதுக்கு முன்னாடி எந்த ஆடிட்டில் ஒர்க் பண்ணிட்டு இருந்தான்? சார் அந்த மைனிங் கம்பெனி போனாங்க சார் அந்த ஆடிட் அடே மைனிங் கம்பெனியில் இருக்கிற காப்பி பண்ணி NBFCஸில் அட்டாச் பண்ணியிருக்காங்கன்னா நீ அதை கூட பார்க்க மாட்டேப்பா. ஸோ தட்ஸ் த வே இன் விச் வென் யூ ப்ரௌட் டு காப்பி பட் ப்ளீஸ் யூஸ் யுவர் ப்ரொஃபஷனல் skepticism to amend according to the requirement. Depletion comes in a mining industry and there is no question of depletion coming to an NBFC. So that at least that level of professional skepticism and quality control has to be maintained. Okay, that control is even if you are looking at INCO terms or international commercial terms which we normally follow, when the control over the goods is passing on to the buyer is coming in the same way. The risk and rewards of ownership is passed on to the customer is what we are doing. So there is no major difference coming in this. But the point where we have to be careful is what is the terms of the contract with the customer is the primary key for your start point. You have to see what is the terms of the contract and what is the performance obligation arising out of the contract. What is the price which has been fixed? What is the other conditions imposed with respect to that particular item? If you are not reading your contract and just going in recognizing simply, you may get into a problem. Even in a normal manufacturing company, I will give an example. Even though I have said that it's very simple, let us assume that there is a master sales agreement, MSA or MSL, whatever, sales level agreement, where they are saying, first 1 million pieces, you charge me 100 rupees. Next 1 million pieces, you charge me 95 rupees. From third 1 million pieces onwards, you have to charge me 90 rupees. Because in the first year, indigenization has not happened. You are importing using certain material, so the customer is ready to allow you 10 rupees extra. But it's a master level agreement over a period of time. And you have to consider whether this is a precondition for selling my initial 1 million pieces also. In that case, I should average out this 100, 95, 90 and take the average price even for recognition right from the day one. Problem will be the invoice which you have raised for GST will be different number, and the revenue which you are recognizing in the books will be different number. Unfortunately, we don't have any other option. We have to maintain a reconciliation outside the books of accounts. Even when I am saying the interest income is recognized by an NBFC or bank in a different model, what you are recording in your loans and advances will be different, because that is the way in which you will collect from the customer or the borrower. When I am maintaining this in a different manner, even your GST liability and other liability, you have to keep a parallel reconciliation process, which has to be, sometimes it's a very tedious efforts which you have to put in. Relying on the system will be necessary for a bigger entities. Smaller entities can still manage. And as I said, there is a 5-step process. Good thing in this standard is, this standard gives a lot of guidance, a lot of I should say, it's like a hand holding you how you will allocate your transaction price, how you will determine your performance obligation. Only problem is, if you are printing out Ind-AS 115 itself and taking it to the bedside, not to take your sleep, but taking your bedside, and if you are not having your pillow, you can use this as an alternative. That is the size of the standard. Accordingly, one-time effort may be required, but my usual style is one-time effort I will not take. If I am printing, say for example, 100 pages, I split in one movie, if I am not wrong, Michael Madanakavarajan, Kamal gives to R.S. Shivaji a portion of the total amount contracted transaction price. A portion is being given. He is not counting. He will just put this like this and take some portion and give it. Similarly, I take the entire printout without considering how many pages. I split that pages to 10 of my team members. 100 pages is given to all of them. And the requirement is they have to read it in full, because I am not going to read it, that which I am not telling them. They have to read it in full and come to our training room, present for the 10 pages. And I am good at asking questions, not answering questions. So I will start asking questions. They might have done a elaborate study, no? Then I will also have my knowledge very clear. So basic understanding I will have, but elaborate understanding with this deliberation or the learning and development activity you will have. You can also try that activity in your own organization. The core principle under this standard is simple. What it says is that the entity has to recognize the revenue in respect of the delivery of the promised goods and services to the customer. So, when the delivery of the promised goods and services is happening, promised goods means there is an obligation which I am taking to deliver. So that obligation comes as a point. Goods maybe or services is also attached to that, to the customer in an amount. It is not talking about what is the consideration. It says it is an amount that reflects the consideration to which the entity expects to be entitled. So I have to, not based on my transaction price with the customer I will take. I should know what is my entitlement according to the delivery of my promised goods and services. That should be the amount which I have to recognize. But when I am reading it, I get confused, right? I normally split any definition into various key words. You can try that to easy understanding. Transfer of promised goods and services. We call that as performance obligation. What are all the performance obligations involved in this particular contract? Second is, what is the amount expected by the entity? Fixed consideration and variable consideration. Fixed price and variable transaction price. Net figure is what is I am expecting. And then I am considering with my customer, and to that extent the revenue which is coming out is from ordinary activities. For example, if somebody is selling their land or building, that is also one person is buying it. Can I show that as my top line? No. Only the profit on sale of that property, plant and equipment has to be recognized under other income. I cannot take it as a sale. From the ordinary activities you have to take it into consideration. So this is the three key points to understand this particular definition. The 5-step process, if you understood, then there is nothing complex on this particular standard. I have some examples also. To that extent time permits, I will use all the 3 examples, or I will just take one example and skip to the next step. As it's already 12 o'clock, I have to cover one more standard also. Right? The 5-step process starts with identifying the contract with the customer. So, first and foremost, we use the word, is it a gated question or is it like a password to enter into the standard? Yes, if there is no contract, the standard is not applicable. So if you are not a real right to enter by putting the actual password, like this, here also this is a password which you have to have the right to access. If you are not, then you are not entitled to go into the standard at all. The moment I say, yes, there is a contract with my customers, is there only a single obligation you have agreed, or you have agreed for more than one obligation in that? Let's take a simple example. Let me take an example of a manufacturer, car manufacturer. When you buy the car, maybe during the festival season or during the off-year season, they will come out with saying that buy the car at so and so price, we will give you 3-year extended comprehensive maintenance free. So what is the 2 promises which they are giving? Sale of car, so goods will be delivered to you. Second promise which they are making is that 3 years comprehensive free service which I will give. What they are collecting, say let us take an example, I am getting say 10 lakhs for the car. 10 lakhs, let us assume small car. So don't tell me, sir, which car comes at 10 lakhs. When I am using the numbers, I am very careful of using the numbers. What number I can mentally calculate, I will use the number. Complex fractions and other things I never use because I am very poor in maths. So 10 lakhs, let us assume that is the price I am collecting from the customer for the car. If somebody is buying the car and asking me 3 years comprehensive maintenance services, I will charge, let us assume, another 2 lakhs. And there is a fraction on the back. Let us assume that car is 8 lakhs. 2 lakhs I will charge for the contract. Put together 10 lakhs which I normally get. If somebody is paying the comprehensive maintenance separately. 2 obligations have 2 different transaction price, 8 lakhs and 2 lakhs. But I am asking the customer to pay me just 8 lakhs as a special offer to get both the services done. What we do under AS 9, we will recognize sale of car at 8 lakhs on the date of registration. 2 lakhs is a free service, only going to happen in the 2nd year or 3rd year, depending upon when it starts after the free service is there. During that period, whatever additional cost incurred is debited to P&L. So what is the problem? Standard says your cost is accounted in the 2nd and 3rd year. Revenue is accounted upfront, which is incorrect. So you have to defer the revenue also to the subsequent period where you have not delivered your performance obligation relating to your AMC or comprehensive maintenance work you have not deferred. So accordingly, out of this 2 lakhs which you have given as the consideration, your total contract price in a normal situation is 10 lakhs. So what you have given is 2 lakhs of discount you have given, and each independent contractors, one is 8 lakhs and another is 2 lakhs. So if I am going to give a discount of 2 lakhs, I am giving 20% of the total transaction price as the discount. Correct? 20% is 1 lakh, right? Or 40%. 10 lakhs, 2 lakhs means 20%. நான் தான் மேக்ஸில் வீக்குன்னு நினச்சேன், எல்லாருமே வா டீ குடிச்சா ஃப்ரெஷ்ஷாக ஆயிடும்னு நினச்சேன், எனக்கு கொஞ்சம் டல்லான மாதிரி இருக்குது. So 20% is 2 lakhs, right? So 20% discount I am giving. That 20% is assumed to be given on 8 lakhs of car and also 2 lakhs of comprehensive maintenance work which you are going to get. So accordingly, 1,60,000 will be deferred for the subsequent years because the performance obligation is not met. Whereas in respect of car, 20% of that is how much? 1.6. 8 minus 1.6 is how much? 6.4. So you can recognize only 6.4 lakhs as the revenue immediately on transfer of the car. So now you will understand, instead of recognizing 8 lakhs, I am recognizing only 6.4 lakhs. Reason is, I have completed only one obligation. My customer will demand the obligation to be performed in the 2nd year, 3rd year and 4th year. So naturally that should be recognized over that particular period in time, so I have to defer. So that identifying the performance obligation is the criteria based on which I have to determine the transaction price. Of course, transaction price I have said, fixed transaction price and variable price, both put together I have to look at. The variable transaction price is a challenge, maybe incentive, bonus or performance premiums sometimes, or discounts which I have to give, or maybe I will give them some sort of liquidated damages. All these things has to be looked into, and probability of that will happen should also be worked out. And but interesting point is the probability of whether I will be getting the incentive, probability of whether I am eligible for the additional work which I have done, probability of I am entitled for some premium, probability of I am giving a discount, probability of I am going to be charged with the liquidated damages are same way in which you are doing right from time immemorial. Same method is being suggested here also. Accordingly, nothing great. Only thing is, for each of the variable consideration, you have to work it out based on your own past trend, whether this will be eligible or not eligible. In that case, if it is an income which will be coming in, add to the fixed cost, fixed transaction price. Whether it's a concession which you have to give, reduce it from the transaction price. That comes to your total transaction price as per step 3. Now the step 4 is what I have done with an example of car and the 3 years comprehensive maintenance. I have allocated the transaction price of 8 lakhs to the car value and for the comprehensive maintenance. I have to allocate to various performance obligations. This allocation of transaction price may be little difficult when it comes to IT and IT enabled services company, where they may be developing a software, they may be customizing the software, they may be giving a training in the software, they may be maintaining off-site some support services which they will provide, they may be giving a warranty, extended warranty. If so many items are there, all of them are separate performance obligation. You have to determine what is the independent selling price which you will charge for that particular item, and based on which the deferment will happen for the undelivered component. And finally, you will recognize the revenue based on the obligation which has been completed. That's a 5-step process, the standard says. Yes.
So, with respect to warranty that is given, there is a provision in Ind-AS 37 where we have to recognize your provision.
Good point, ma'am. You are still ahead of my slides. So what she is asking for is, you are talking about extended warranty, whereas warranty provision is coming under Ind-AS 37, provision contingent liability and contingent assets. Why you are saying that your price has to be adjusted for that? I carefully use the word extended warranty. Normal warranty, I make a provision and do that in accordance with Ind-AS 37. Extended warranty is an obligation I am giving over and above normal business practice. So I am promising them to do something more than what I normally do. That extended warranty will also be determined what would be the possible outflow based on Ind-AS 37 estimate, but adjusted in the transaction price. Sometimes when questions ahead of my session comes in, I normally park it in the parking lot for 2 reasons. One, take it at the appropriate time, and the second is very obvious reason, I may not know the answer. I just postpone it, and at the end of the session, lunch will be asking you to come out from the session. Even if I am not explaining, you will be happy with that and you will forget about it. So if I am parking anything, please let me know whether I have cleared it or not. So there are conditions which has been mentioned, how you can determine whether there is a contract with the customer or not. All these conditions are cumulative conditions. If you look at that, it is simply saying, is there any business which is enforceable as per law or as per business practice? If that conditions are satisfied, then automatically I am concluding that the step 1 is crossed. For example, when I am saying, is it approved and the parties are committed to their obligation? A contract is signed by both the parties for their offer and acceptance like type of thing. Can the rights of goods and services and payment terms has been identified in a contract very clearly? I will say what I am going to deliver to you and what is the price which you have to give it to me. Whether the collection of the consideration is considered probable. AS 9 is also talking about this. Revenue is not recognized if the ultimate collection is considered not probable. That is what banking companies are doing. Why they are not recognizing the interest on NPA assets is ultimate collection of principal itself is not considered probable. How you can recognize your revenue? So here also they are saying ultimate collection of the consideration is also probable. Is it a commercial substance or it's like, for example, I will enter into a contract to marry somebody, and if I am not fulfilling that particular contract, whether they can enforce it as a contract with the customer, whether somebody is considering that the opposite party is a customer, then it's not a marriage relationship, something else, right? So accordingly, whether it is making a commercial substance is what we are saying. And the last condition is interesting condition, assuming that I have started performing, but at one point in time the other party is not comfortable with my work. They are throwing me out and putting some other person into the activity. In that case, whether I am entitled to collect whatever cost and profit up to the stage of I am kicked out of the project, then only it gives me a commercial substance. If they are saying, no, I will not give you any money, that may be a bad debt, credit risk, that is different. But if the contract specifies at any point in time when I am terminating, you are not entitled for any profit element, we will only reimburse the actual cost incurred, then it is not a contract. So all these conditions are cumulative conditions. Then commercial substance comes into the picture. Interesting point here is that this assessment happens at the beginning of revenue recognition. So whenever I am going and doing an audit of a company, I normally look into whether any significant contracts entered into during the period, especially where they are into IT services or they are into make-to-order type of activity. I ask for significant contracts and try to see whether there is any situation which I have to look at to ensure that this is falling under Ind-AS 115 or not. All those conditions I will try to see as part of my audit procedure. In a normal manufacturing and selling, it's a normal activity and accordingly there will not be any situation. If I have already done the analysis of the contract even for a made-to-order type of customer, once I have done the assessment, I need not do it every quarter, every half year, every year end. I need not do that again for that particular contract. Unless the entire terms and conditions or major terms and conditions are significantly differing, then I have to revisit. Otherwise, I can simply take that as a presumption. What I have assessed still holds good. Okay, now this is a gated question. Yes, gated question. Now the question is, suppose I have given the answer, I don't have a contract which is written, it's an oral contract, whether that is considered as a contract. My customer takes the phone and tells me this is a delivery schedule, you send that, I am sending this, goods are accepted. This standard says, need not necessarily be everything should be written. It may be oral, it may be based on business practice. If the two parties started performing in respect of a contract, even if it is an oral contract, and the other party acknowledges the performance, then automatically it is considered as a contract. So oral contract can also be part of it. Only condition is that should be enforceable by law. That's the only point which you have to look at. Now, okay, in this I will skip because we will go too much on this. I will leave this presentation for you so that you can see the other conditions, other examples for you to understand. The second step is to identify the performance obligation arising out of the entire contract. I have already explained what is performance obligation. The condition which they are trying to find out is that whether the customer benefit from the goods and services which I have already delivered, either in its own or together with the other resources he is already having, whether he can make use of it. If he can make use of it, it is considered as an obligation, as a separate performance obligation. And entities promised to deliver is separately identified from other promises. Like I have said, car, maintenance services, software, customization, training, on-site maintenance or off-site maintenance, back office services, everything is identifiable performance obligation. Then I will consider that there is distinct performance obligation which are available in the contract. If I am not able to see that the two conditions are not satisfied cumulatively, then I will consider the entire contract as a single performance obligation. So recognition will be so simple. The other cases it will be split over the performance obligation. Let us take an example. Enters into a contract its customer for sale of a machine and standard installation. Installation services are also offered by third-party providers. Whether there is one performance obligation or it is more than one performance obligation. Only one or two. Possibility. One or two? One. Two. Okay. What happens is they are giving you the condition 1 and condition 2. No? The first condition is machine can be used with other available inputs. So that means I need not even go for a installation with the supplier. I can just take the machine, use third-party service providers to install that machine. Second is goods and services are separately identifiable. That is also there. There is no separate integration of services, or because installation is a standard service, there is no separate activity. It's an integrated activity. In this case, because I have used the word standard installation, that comes as a single performance obligation. If I have said that it requires a specific skill sets which is available only with the supplier, then it becomes two obligations. So for installation and commissioning, I took a lot of effort. For manufacturing and selling of the goods, I am taking effort. I will split that into two. In this case, it will be considered as a single performance obligation. Take this. Okay. This is more or less like what we have explained. Contract for construction of a new high-end power station. Control over the power station is expected to be transferred at the end of the fifth year. It's the first power station of this particular design, and entity E agreed to provide support to customer F in connection with the general maintenance of the plant for the first year of operation free of charge. Entity E also provides similar maintenance services to other power stations. So let us go to the first condition. Of course, here the difference between the first one and second one is it is the first power station of this particular design. That means I only have that technology, the others cannot do it. So then two performance obligation comes in. General maintenance is not the third performance obligation. General maintenance, actually there are three. One is general maintenance, and I am also giving them the support services, and then the supply of the power station. So general maintenance is a normal warranty. So then I don't do anything on that. It is only considered as a integrated service. So two services are there in the activity. This is to make you understand, if you are giving a contract for construction of a factory building or a house, and he supplies steel, he supplies cement, he supplies brick, he supplies fittings, whether it has one performance obligation or more than one performance obligation.
No, it's one, right? How
See,
much is everything?
simply it's integrated because I don't have a separate goods or services which is identifiable. This is used for the purpose of constructing the final output, right? But the customer can actually sell that. If I'm not, I'm taking the money, but I'm not doing the services, he can simply take the lien on the steel which has been supplied and sell it, or use other contractor to use the same item and say that I have adjusted against the advance paid. One condition will be satisfied, other condition is integrated, and accordingly it is not there. The third step is determination of the transaction price. As I have said, fixed consideration plus variable consideration. Variable consideration, I have explained that it makes discounts, credits, incentives, performance bonus, etc. Guidance is available how you can determine. It actually says that you can determine based on what is the expected value, the sum of probability of getting the possible actions, or most likely amount, a single amount which you can get as the performance or variable consideration. To make it very simple, Padi Kenar Thadana, whether I can say successful, if I say no, because I will fell into the well. And accordingly, if I have to fulfill the entire thing, then only I will be able to reach the performance being completed and entitled for the variable consideration. You should go most likely amount, whether I will be able to do it or not do it. Expected value may be a range of values they might have given. So for example, if I am setting up an industry where I am saying your power savings will be at least 1 lakh rupees per month, or maybe I am saying up to a maximum of 5 lakhs per annum or per month you can save, and the customer says if I am saving 1 lakh I am giving 10%. to you additionally, or 1% additionally. 20% means 2% additionally. 5 lakhs means 5% additionally. Then what is my expectation whether the efficiency will reach 1% or 5% based on the variability? I have to determine what is the slab at which I will get the benefit. That is the expected value method. Depending upon the nature of the item, you have to normally determine that particular item. For example, in this case, what they have said was, I am building a aircraft for the customer. What it says is the fixed contract price is 100 crore. If I have completed the contract 2 months prior to the specified date, then another 100 crore I will give. If the number of flights taken for the next 12 months will be so much, I have given a performance bonus of 0 to 100 crore. So if you look at 100 crore is transaction price fixed, so I straight away take that as A, and I have to add B to arrive at my transaction price. B could be what is the outcome of first completion bonus and what is the outcome of my performance bonus. So completion bonus, what it says, 2 months in advance, if I complete the project, I am entitled for it. If I am not completing, even 1 day delayed, I am not entitled for it. So what is the most likely amount I will achieve? That concept I will use to determine this number and add it as variable consideration. The next one is, what is the expected number of flights according to my own assessment, similar aircraft, how much it can do, and based on which I will fix up what is the variable return which I will get based on what we call the range of amounts which I can get. That also I will add. The total amount is considered as a transaction price. That is what we will do, and I will skip the others. Okay, this also we will skip. Another interesting point when we were determining the transaction price is whether there is any significant financing element involved. Customer might be advancing 80% of the total contract price, or you will get only 1 rupee and give the customer the entitlement to, or the control is transferred to the customer and collect it over a period of time. So you have to normally look at, or you are giving an extended credit period to the customer, or customer is actually giving you something as a loan type of thing rather than just an advance. In a normal scenario, the advance is, say for example 10%, but he gives 80% of that amount as an advance. The simple concept which I look for is, if I am doing a cash sales means normal credit period when I am selling, what would be the transaction price for this particular item? Just because somebody is giving 80% in advance, what is the transaction price I will give it to them? Naturally there will be a concession. That should also be considered as an adjustment. But the interesting point is, the significant financing element is not adjusted as a transaction price, but this has to be determined. The rate, again, what we have talked about, it gives a guidance. Cash price minus normal transaction price agreed. Between the payment and the actual delivery of the goods, if there is a substantial period of time, what is the normal interest rate in the market? Somebody is giving it free of cost. What is the rate? What is the rate of interest? What we have talked about in the previous scenario. It also gives a practical expedient. The contract will be completed within 12 months, no adjustment is required, short-term contract. So financing element may be explicit or implicit, but still you have to adjust the significant financing element. What you are supposed to do, you have to reduce the transaction price to that extent of the significant financing element, recognize only the balance amount, recognize the interest portion over the period of your repayment or the execution of the contract as an interest expenditure. So that is what will happen when you are getting an advance, where you are giving an extended credit period to the customer. Normal selling price may be 100 rupees, but because I am giving him 3 years to repay, I might have added some margin on that. That margin is my interest income. I have to defer it, recognize over 3 years period. That is what significant financing element is talking about when it comes to your significant financing, your variable consideration to be determined.
Less than 1 year,
Because less than 1 year, the amount may not be significant when you are discounting. That's the reason why they are having that. And they are giving us a practical expedient. Don't complicate too much. Sometimes the account, the standard centers are also having some art. That is the way in which we have to take it.
Will the recent disclosures of Ind-AS certain cash flows affect this, because that covers the supply chain finance program, where if we have availed extended credit for our trade payments, the disclosure requirements is separate. So will this have an impact on this?
I'm talking about the MSME.
Not MSME, the regular banks regularly offer this extended credit program where if my credit period with my supplier is only 60, I can avail an additional credit period of 90 or 1.
Automatically it will get covered.
Though the contract is within 1 year, it doesn't matter whether it's...
No, if the contract is for 1 year, but I am allowing him to repay for 3 years.
No, I am talking about a different scenario where I have many suppliers. I buy steel and cement from lots of suppliers.
Okay.
They give me a free credit period of 60 days. That is normal standard in the industry.
Okay.
But within 60 days, I won't give it away because my cash cycle from my customer is 90 plus.
Okay.
So I need an extended credit period. So for this extended credit period, what I do is I buy this extended credit period from banks by adding an interest component to the price. Okay, instead of 60 days price, I ask him to give me a price for 150 days, and that gets loaded as cost in the books. Okay, and on the 60th day, what happens is I avail or I enable him to discount his bill and get his money. So he gets his price or whatever for 60 days. So then for the balance 90 days, for which I have paid as a cost, I enjoy extended credit period, and at the end of the 150 days or so, I pay the bank and send him his numbers.
Okay, in this case, when I am saying, maybe I can say that it's a bill discounting scheme, or maybe I am having a corporate financing option which I am extending to my customer, because all the big companies are now doing it. What they are saying is that even though there are agreed terms of contract, especially when it comes to the disallowance under section 43B(h) of the Income Tax Act for micro and small industries, the major entities have opted for this particular activity. What they have done is, they said that I will take, or I will stand as a guarantee for the loan which you are availing from the bank or financial institution. You can discount my bill on the first day itself. So on the first day to 45th day, you have to bear the interest. From 45 days to 190 days, I will bear the interest. Or 180 days, I will bear the interest. So that's a normal situation comes in. Your question is, when this type of arrangement has happened, when I have sold and I am getting that after 180 days from the banker, or they are taking that particular interest as an expenditure, what will happen the situation of significant financing element? You are already splitted that into two components. Your selling price remaining as per your terms of contract by means of invoice. Another is, it's an explicit arrangement for interest payment. That is coming as a separate arrangement. And accordingly, what I am supposed to do it, if it's implicit to split, it is already available as two separate instruments. And accordingly, your accounting as an interest for the balance period will be like a borrowing where you are recognizing that interest. Revenue will not get any impact on that. That will remain the same. Whether I have answered your question or not.
Maybe we can take this offline.
Okay. But the thing is, any arrangement for doing this bill discounting activity and other things will not fall into your 115 for variable consideration. Make that.
I understood, but what...
We will discuss that. For the benefit of others, I will say it will not fall into the criteria of Ind-AS 115 variable consideration, because that is a separate transaction or separate agreement, and main contract is for supply of goods, promised goods and services. This is main contract. That's a separate agreement. So separate agreement, it's already accounted in a different perspective as a financial liability, where interest will be accounted on a effective interest model, etc. But I will talk to him to find out whether there is any specific issues and discuss offline with him. So the one question which is coming in, every case where the transaction is happening at a different level or different advances level or different payment level, you have to necessarily look at whether there is a significant financing element or it is a normal business practice to take that level of advances. For example, in a real estate sector, when the development happens, 10% when you are signing the agreement and 20% when it comes to the flooring activity and maybe lintel level, etc., etc., maybe more than what you are supposed to pay, they are taking that money, but it's an industry practice, general practice. So there is nothing to worry about that you are having a financing element involved. But in some cases, what they say is that you can pay me entire amount in advance, even before I go for the call it as I am not able to recollect the name, pre-bid type of pricing which they offer, like in a what you call pre-IPO situation where underwriting is happening. Similarly, underwriting for real estate transactions is also happening now. The structure is also happening now, where normal selling prices, say for example 6,000 rupees per square feet, they offer at 5,000 rupees per square feet, and they say that after the 3 years period when I am completing the project, you are entitled to take this at the same 5,000 rupees price, or you are entitled to take from me 6,000 rupees as a refund. So nothing but it's a financing arrangement. Okay. So that type of arrangement when you are having, you should always analyze all the advance payment, all the contracts where you are giving a deferred payment terms for your customers. Very prevalent when you are buying a car, the consumer durable products, where they are saying pay us 1 rupee down payment and take the goods and pay in equated monthly installment of 24 months, automatically comes into this category of significant financing element. Car, heavy machinery which has been purchased, all these cases could be having a deferred payment terms. You have to analyze whether that is giving you the expected level. I have some examples. And the step 4 is to allocating the transaction price over the performance obligation. What it says is the best evidence is observable price. That is the reason why I use the word. I am also selling the similar item at so and so price. So it is an observable price for me, and based on which I will split and account the combined transaction price over the 2 performance obligations. What it says is that a residual model can also be used. For example, if I am not able to determine what is the transaction price for one and what is the transaction price for another obligation, then I can say what is the transaction price for one obligation which I have performed. I will recognize that and defer the balance for the other obligation to be accounted in the 3rd or 4th year depending upon our example. But what it says that fair value of the obligation you cannot take. Actually, old standard on revenue recognition says, Ind-AS 18 is saying actually, when you are having multiple element arrangement, they use the word multiple element arrangement, here they are talking about performance obligation. If you have multiple element arrangement, when you are splitting and recognizing in the multiple arrangement, you have to do a fair valuation of the element which has been completed. Unperformed element, you have to actually postpone it. But now fair value is not possible to be considered. Warranty, that's what I said, you are ahead of my slide. So if it is a normal warranty, you will just make a provision and nothing to be get adjusted. If it is an extended warranty, it will be considered as a performance obligation. You will recognize that also. That is what I have done. Allocating the discounts I have already explained. And finally, the last step is to recognize the revenue over a period of time or at a point in time. The standard is not saying what are the circumstances where you will recognize at a point in time. Whereas they are saying what are the cases where you will recognize the revenue over a period of time. In all other cases, it will be recognized at a point in time is what they are using. So for example, this is the 3 paragraphs I picked up from the standard to determine whether revenue has to be recognized or the performance obligation is considered to be performed over a period of time, based on which percentage completion method can be applied. There is only 3 circumstances where customer simultaneously receives and enjoys the benefits. I am entering into a AMC contract for 3 years. So customer has paid the amount in advance, but I cannot recognize upfront. I have to recognize over a period of time because customer enjoys the services over a period of time. I am an educational institution. I collected the entire fee in advance for 3 years. The actual tuition or actual lecturing is happening over a 3 years period of the degree. I have to recognize over the 3 years period. When normal scenario will be AMC type of contract or contract for providing a general maintenance activity will fall into that particular scenario. Customer controls the asset as the entity creates and enhances it. So for example, customer is having a site and I am building his factory or I am building his house. At any point in time, if I am not cooperating, I am not doing it. Customer has a kick-off right. They use the word kick-off right. In US GAAP, I am just using that. Customer can kick me off the contract and use somebody else to finish it up, because he has the control over the development which I have done in respect of that. So, asset built on customer site is an example. The entity's performance does not create an asset for which the entity has an alternate use and the entity has a right to payment for performance to the date. So for example, when I am developing a particular asset and customer at the end of the period will be able to use it, but when I am billing, customer will pay me the cost price as well as margins relating to that cost which I have incurred. So when I am made to order or there is an order for developing a specific asset for the customer, then the normal contract where I will recognize over the period of contract. In all other cases, revenue should be recognized as soon as the control is transferred. With this example, we will know the revenue, what I have reiterated in the first beginning of the session itself. I have said, in a normal manufacturing activity, normal product selling, normal trading activity, the standard will not have any major impact, because it's the same thing, transfer of control. Only in other cases you have to do all these activities, including transaction price, variable price, everything has to be worked out. Others are not required. One debate which is coming arise out of this is the second one. Let me take. Customer controls the asset as the entity creates and enhances it. Asset is built on customer side. What will happen if I am developing a gated community in the land owned by me and flats are sold? What will happen? At a point in time or over a period of time? Sorry, sir?
Fixed element will be at the point.
1 second, sir. Let me.
The fixed element will be at the point. Otherwise, agreed fixed element.
Sir, come again, sir.
Fixed element will be at the point of time.
Fixed element will be at the point in time. Okay, at the point of time. So this is the biggest problem which came because of this particular standard for real estate sector. Even though they are saying the institute came out with a specific guidance note on real estate developers, and they have withdrawn the guidance note after the introduction of Ind-AS 115 for Ind-AS companies. So that means they are saying that you have to recognize the revenue only based on this particular standard, and if you look at this, you don't have a control, customer doesn't have a control over the development which you have made. Even the customer can visit your place during the development, etc., etc. Customer will be entitled to take the possession only after you allow them to take the possession. in accordance with the terms of the contract. And accordingly, real estate development over a period of time which all the real estate companies were recognizing under AS 9 now will become a problem of you have to recognize only after completion of the project and selling each of the unit. Completion of the project means maybe one flat has been completed, you have sold it, then you will recognize revenue only to the extent of that one particular flat. Could be a possibility. When this has come, one of the estimate came from real estate sector. They may be requiring to reverse around 26,000 crores of revenue already recognized based on percentage completion. Then there was a big debate, and the institute has come out with a notification saying that this standard or the institute education material is not saying percentage completion is not at all possible for real estate developers. Each has to be looked into based on the contract with the customers. If you are looking at the contract with the customer, you will end up with having a feeling that it should be recognized only at a point in time, not over a period of time. Accordingly, certain conditions are required to be there with respect to the construction agreement entered into with the customer if you wanted to recognize revenue over a period of time. Okay, you have the method. The methods are similar to what we are having. The disclosures are little extensive disclosure like contract assets, contract liability, what would be happen for in case of significant changes, etc. That brings us to the end of this particular session. With respect to property, plant, equipment, I will, how much time I have? I have 20 minutes, more than enough. With respect to this particular standard, I can simply narrate it as a story. Then you will be able to connect it without going into the slides. Slides we will go through that later. This I learned from one of the academicians. He was trying to make out this explanation. I have then elaborated that to fit into this particular situation where the interest is getting lost because the lunch time is coming up. At the same time, ready to listen to a story, right? A simple concept of looking into a property, plant, equipment coming into your balance sheet, being used during the course of its useful life, and it loses its value over a period of time, and finally it doesn't have any value. Very easy comparison I can make is with the human life. A child is born, asset is purchased. But of course, I cannot prepare a balance sheet and recognize one child, this is the value of the child, I cannot put. But I have a cost of acquisition for the asset which I have purchased. So in my balance sheet, I can recognize the value at which I have purchased this particular asset and recognize that particular asset at the transaction price or the cost which I have paid. When I am talking about the cost cannot be only direct cost, any other cost to bringing the asset to the intended use or for the present location and condition. Transportation cost, consultant cost, engineering cost, installation and commissioning, all put together will be the cost at which I can capitalize this particular asset. So asset and the child has been recognized. Child grows, and child to grow, we have to spend a lot of expenditure. That expenditure is not giving me any economic benefit because I am just taking the normal situation where that so many old age homes. So whatever economic benefit you are thinking at your old age, which is not going to come from your children. So whatever expenditure you are incurring is not going to give you any economic benefit to you. Similarly, when you are incurring repairs and maintenance expenditures to ensure that it's operating properly, it does not give any economic benefit to you, and accordingly that will be charged to the P&L account, right? Suppose if you are this, nobody should take it as an offense, but I am just giving as an example. Suppose if the child has taken a professional degree, because in Chettinad there is one concept called வேஷ்டி கட்ட தெரிஞ்சிட்டாலே அவனுக்கு மார்க்கெட்டில் இந்த ப்ரைஸ்னு அவங்க சொல்லுவாங்க. செட்டிநாடு சைடில். ஆந்திராவில் வேறு ஒரு மாடல் இருக்குது. ஸோ இஃப் there is a degree, professional degree which this child has attained, then the value for the child increasing. Similarly, if I am adding some additional expenditure which brings me some economic benefit over and above what I have originally thought about it. So that means the subsequent expenditure is not just a routine repairs and maintenance expenditure, but it is an expenditure which increases the value of the asset. Then the subsequent expenditure should be capitalized and not charged to the P&L amount. The machine is being used on a routine production or servicing of the customer, etc., etc. It's being used. Even vehicle, when it is running, slowly its life is getting deteriorated. Similarly, human is also, when the age is coming in, lot of diseases are coming in, the age factor, the number of days started counted, and to that extent you have to value it at a value lower than what you have originally estimated, right? So accordingly, every year when there is a wear and tear which is happening to the machinery, or the value which you expect to get deflated in the value of that particular item, you have to account it in your books of accounts as an expenditure. We call it as a depreciation. That depreciation is estimated based on the estimated economic useful life of the asset. The estimated economic useful life of the asset, when I am saying what you are estimated to use that particular asset. For example, if a computer is capable of working for 5 years, but in an IT and IT enabled services, because of the high end of usage, they may consider that the economic useful life or replacement of a new computer will be within 2 years or 3 years. They charge it over 3 years period as a estimated useful life. So that is charged in the P&L account. And at one point in time, there is a bypass required because of some other problem, so the value dramatically comes down in the human life also. Here also the machinery gone into that level, there is a physical damage or some other reason, because of that it could not produce the cash flows which I am estimating. Then another standard kicks in and says that you have to consider whether any impairment of asset has to be accounted for to reduce the value further than what is being accounted in the books of accounts. And finally, when death occurs, there is no value, entirely written off. Similarly, useful life is at the end of the useful life, at least you will have some resale value for the asset, but human life you will not have anything, right? The resale value, to that extent, what you are collecting will be considered as your income, and the asset will be de-recognized in the books of accounts. Very simple thing. Now, what are all the complexity in the process which will happen? Now we will forget about human life, we will take only the property, plant, equipment. One possibility is, when I am recognizing a particular asset, I might have acquired the asset at a price, and when I am comparing the price now, the price for replacement is much higher, because the value of the asset has gone up dramatically. Like a land or building, the value has gone up. I don't want it to show that particular asset at the same cost, but I wanted to have that at a higher price. What is the market price? In that situation, I have the option of revaluing the asset. But the condition attached to that is, I cannot selectively do a revaluation. I have to do the revaluation of the entire class of assets. For example, if I have decided to revalue the land, entire land has to be revalued. If I decided to revalue the buildings, entire buildings has to be revalued. So that is the condition for revaluation. The second condition, it says that the moment you have started using revaluation model, you cannot keep quiet after the first revaluation. Every year you have to see, at the every reporting period, I can say at the every year, you have to see whether the price at which, or the revalued price at which I have stated the asset still have the same market value, or there is something significantly changed in the fair value of the asset. Market price might have significantly increasing by another 20%. Mandatorily I have to revalue again. Mandatorily I have to revalue again. I cannot simply keep quiet, saying that revaluation model done at that point in time. The third element is, in respect of your normal accounting, your depreciation is on your cost minus your residual value. Whereas here, if you have revalued the asset, depreciation will be on the revaluation amount minus your residual value. That means you cannot keep the revaluation as a separate reserve in your balance sheet, but it should also be adjusted against your charge to the P&L account by means of depreciation. These are all the revaluation model complexity which comes in. Another complexity which may come in is that I am operating in a particular industry where I cannot continue to use that machinery continuously. After 3 years or 4 years, I have to mandatorily do a complete overhauling of my entire facility, or entire machine, or entire aircraft, or entire ship. I have to do the dry docking or whatever I have to do. So that scheduled maintenance or complete overhauling is an expenditure normally accounted in the year in which you have incurred. Contrary to that, standard says that overhauling expenses based on scheduled maintenance activity. Scheduled maintenance requires a complete overhauling expenses. Don't say that every 3 months once I will do a scheduled maintenance by shut down my factory, do the deep cleaning. That is a normal maintenance activity. This, without that particular activity, you cannot run the factory itself. So for example, after a particular number of hours of flying, the aircraft has to be completely redone. Similarly, after a particular number of voyage, dry docking has to be done for your ships. After a particular number of years, your lorries or your heavy vehicles should be having a fitness certificate for which you have to do a lot of activity. Those costs which you are going to incur should be considered as component of the particular asset and amortized over the next recycling period or overhauling period. So for example, every 4 years I will do, and I will incur, say for example, 1 crore. 1 crore has to be capitalized as part of the component of the property, plant, equipment, and charge 25 lakhs each, because at the next 4 years I am going to do another overhauling activity. I have to consider that as a component of the property, plant, equipment. The moment I am using the component, there is an approach called component cost approach which comes to your understanding. If one machinery or one equipment or one property, plant and equipment is having multiple components which has significant value and having different economic useful life, then that should be separated and accounted as a component of that particular property, plant, equipment and depreciated over its separate estimated useful life. Simple example I can provide is, entire building cannot be capitalized. Lift has to be considered as a separate component of the building and it has to have a separate economic useful life. Depreciation principle will be different. Similarly, in a factory, the furnaces outer shell will be considered as a normal machinery. Internal liners has to be considered as having a significant component to be depreciated over the estimated period of replacement of that particular item. This is a component cost approach, is mandatory for all entities under Ind-AS 16 property, plant and equipment. Having said that, an asset can be purchased, outright purchase. An asset may be exchange of another asset. An asset may be purchased with deferred payment guarantee terms or extended credit period. Whatever we have seen in your revenue recognition, the same principle will apply here also. Interest component will not be part of the component of your property, plant and equipment. Only if that plant and machinery takes a substantial period of time, a concept called qualifying asset comes in. Ind-AS 23 borrowing cost is getting kicked in and you have to capitalize the borrowing cost, or otherwise the borrowing cost will be charged to the P&L account. Okay. And of course you have to make the relevant disclosures. That's all. So we will just look at this. What is the definition of that? If you look at that, used in production for administrative purposes, supply of goods and services or rental for others, this rental for others gives a small confusion. What confusion it creates is whether I have to go by Ind-AS 116 leases or I have to go by Ind-AS 16 for this particular item. People normally get a confusion between right of use asset vis-a-vis Ind-AS 16 property, plant and equipment. Right of use asset is determined based on what is the lease payment you are supposed to make over the lease period. It is only for the right which you are having for 5 years or 3 years or 10 years. It is not equivalent to the value of the property, plant and equipment. Okay, that you have to be very, very clear. Here similarly, when I am giving it on rent, it is a lease income which I consider. Only thing is, revenue will be recognized in accordance with Ind-AS 116 as a lessor, but my accounting will be as part of the property, plant and equipment, and I will have an explanation that it's leased to the other party. Administrative purpose, all your corporate assets, furniture, fixtures, office equipments, everything will be for administrative purposes. Expected to be used during more than one period. This created a small problem in respect of stores and spares. Stores and spares are normally considered as part of inventory. Now, this standard says if stores and spares are capable of being fitted into the equipment and can have more than 1 year of usage, then that will not fall under inventory standard. That should also be capitalized as part of property, plant and equipment. So there is one big gap which comes in. We normally ask the management. Normally the management gives an explanation, no such item. Okay. Life is very simple. Okay. So I am splitting this into 5-step approach. Initially how we will recognize at cost. Subsequently how we can measure either cost model or evaluation model. Depreciation is what you are supposed to do based on the economic useful life. Impairment accounting in case if there is indicators of impairment. In Ind-AS 109 we have said no triggers is required. Whereas here, unless there is an indicators of impairment, we will not account impairment. Impairment accounting will be as per Ind-AS 36. It's an impairment of asset standard. Finally, your reporting and disclosure, how to present according to Schedule 3, how to present in accordance with this particular standard, what are all the disclosures required as per Schedule 3, what is the disclosure required under your Ind-AS 16 is extensive which you are supposed to look at. So, whatever I have talked about is what is coming in. Cost of an item of this, probable that future economic benefits will flow to the entity, cost can be reliably measured, is what we will look at. And of course there is one story which we have in respect of the definition, an embarrassing story which has been asked to me. I will come to that later. I also took a lot of case studies for you to make you understand. Measurement at the time of recognition should always be at cost, no fair valuation, always be at cost. Revaluation model comes only at a later point in time, that is subsequent measurement only, you can go for a revaluation model. And I am buying today, what is the cost paid should be the value of the asset which I have to do. I cannot say I am purchasing this, market value is another 10 crore more, I wanted to recognize that 10 crore also not permitted, initially it is only cost. Subsequent measurement only, it is possible. So this is very easy for understanding that. Component cost approach I have explained to you. Borrowing cost I have explained to you. After recognition I have said that two models, cost model and revaluation model. And this also I have mentioned to you, entire class to be revalued, sufficient regularity, how to use it, and depreciation will be on the entire revalued amount. Depreciation should be cost of the asset less the residual value. And you can use either straight line method or WD method, or even you can use your systematic method also. You can say that 1 lakh pieces, this particular mold or die will be capable of manufacturing. Unit of production method also you can apply. But whatever you are applying, there is a requirement. Schedule 2 of the Companies Act is saying that this is an indicative economic useful life. If you are using anything other than that, there is a justification which has to form part of the notes on account, so you have to give that justification. Useful life, as I have said, even though the asset can work for 15 years, one entity using it for 15 years, another entity wanted to replace it once in 10 years. For entity 1, 10 years is the useful life, another entity it will be 15 years of useful life. And the point is, useful life estimate has to be revisited every time because of the change in the manner in which I am going to replace that particular asset. Also, I have to reconsider for doing it. Depreciation and impairment we have already discussed. Other key focus areas of plant maintenance activity and major overhaul I have already talked about. Property held for sale, that could be a possibility. I have recognized a property, plant and equipment. Now the property, plant and equipment, I am planning to sell it. I am not going to use it and I am going to sell it. In that case, you have to reclassify that particular property, plant and equipment as property, plant and equipment held for sale or non-current asset held for sale. Ind-AS 105 will apply. Ind-AS 105 says that at the time of reclassification into property, plant and equipment held for sale, you have to test whether any impairment has to be accounted for. You have to charge it off to P&L and the balance value will be carried as non-current asset held for sale. And after subsequent measurement, no depreciation will be charged. You have to always see whether the cost price has come down less than the net realizable value. If so, you have to again make an adjustment. Otherwise, you can maintain at the price which you have fixed at that level itself. So that brings me to the end of the session. Any questions?
Decommissioning costs no longer required to be present when you are decommissioning.
Okay. One point which I have not added because it's specific to certain industry. Decommissioning cost or site restoration cost or asset retirement obligation, whatever name the industry is calling. What it says is that, say for example, if I am 2-3 industries we will let us discuss. Assuming that I am into oil and gas, I am doing a exploration activity. I am extracting the minerals also, but I have an obligation to restore the land back to the normal condition to avoid the environment disturbance. So what is expected to be incurred as my obligation to restore the site to the original position, or what we call it as a restoration cost, or my asset retirement obligation, etc., should be calculated or estimated at the beginning of the period itself, at the initial recognition itself, should be added as an additional cost to the asset and depreciated over the economic useful life of the asset. Irrespective of, I am going to incur the cost only of the 10th year, still I have to recognize right from the first year itself. That's what asset retirement obligation. So it continues the same way. For example, if I am putting in telecom sector all the towers which they are fixing, there will be a huge installation and commissioning work they will do, but they have to restore it back to the normal field. So in that case, that cost should also be estimated and used. This is all what we call it as a asset retirement obligation, etc. We have to estimate and add it as part of the cost of the asset itself. Yes, sir.
Hello. One practical question is
Sit close to.
Hello. The practicality of
Volume.
capitalizing.
That's the problem. Yeah, please carry it.
See, the accountant views are different from management views that to capitalize a particular asset.
I will come down. Yes, sir.
My voice can be audible at any place. No mic is required.
See, the accountant views and management views asset along with the revenue nature. Sometimes management says that over here it will be what is your
It's a normal problem with property plant and normal problem with the property plant and equipment is what should be capitalized and what should be charged to revenue, and subsequent expenditure, whether it should be capitalized or subsequent expenditure whether it should be charged to the P&L, is always a point of debate between the management and the auditors. That's what he is asking. If there is a difference of opinion between the auditors and the management, how we have to handle that particular situation. I will give an example based on what our past experience is that we were doing an audit of an industry which is mining the clay, China clay, doing the refining, and finally the China clay in powdered form is going to various paint industries and soap industries as a filler for that particular activity. So it was a very old plant, and there is a revamping of the entire plant has happened. Huge cost. They have incurred some crores of rupees at that point in time, and they wanted to capitalize the cost of the expenditure rather than charging to the P&L account. Unfortunately, as an auditor, when we were having the discussion, we were trying to find out only one concept. In old AS 10, the concept was saying that the subsequent expenditure result in output more than the originally estimated output, then only you can capitalize. That's what the point which we have in the old standard. When we were asking whether the productivity has increased than what you are originally doing, technical discussion has brought us the point that it is actually giving a better quality of the output. Otherwise, it has some black particles, etc., where they are able to get only a lesser selling price. Now it is brought back to the original position. That's what they have said. Because it is not producing more than the originally estimated quantity, at that point in time we have said, unfortunately you don't have any say, you have to charge it to P&L. With a long debate, finally they have agreed to charge to the P&L. Similar situation if it happens now. This new standard says subsequent economic benefits arising to the entity by incurring this expenditure. No output is my requirement. Because of that, my selling price previously 100 rupees, now 150 rupees. Enduring economic benefits coming in, I am eligible to capitalize this particular item to that. So the norms little bit flexible to take the view of the management also. And in that particular situation, I normally go with a technical assessment made even internally, not necessarily that third party has to do the valuation, unless the quantum involved is so high and you as an auditor believes that you cannot take the call just like that with an internal assessment because it could be biased. In that case, you can use the external expert. But in a normal technical write-up itself, you can understand that what management believes is acceptable to us. If it is completely not acceptable, then you have to maintain your stand. But in the new standard, Ind-AS 16 or even AS 10 revised, you have the better position to align with the management view. If they are able to demonstrate that it results in a future economic benefits, subsequent expenditure can be capitalized. It's not a problem. Similar issue has happened. One case of a banking company where we were doing, that corporate office was in old Mumbai. You know that if it is a 100-year-old building in Mumbai, how much it will have the issue. They have completely overdone that. Face value has been lifted. The argument came about the total expenditure. They don't wanted to charge to P&L, they wanted to capitalize. Joint auditors meeting which was happening, the discussion was the similar thing. It doesn't have any economic value, it is not bringing something more than that. You are only stabilizing the existing structure to ensure that it is not falling down. That's what they were arguing, and accordingly they said that it should be charged to P&L. CFO and the board wanted to capitalize that particular expenditure. When we were analyzing, actually I am not doing the audit, but I was part of the audit team, leading the audit team on an assignment basis when I was in my private practice at that time, before I moved on to other accounting firms. When we were analyzing this, I have seen that they have done a lot of structural analysis. And based on the structural analysis, it is not only bringing back to the original condition, because of that the economic useful life of the asset will get extended by another 20 years or 30 years further. When this assessment has been, technical analysis has been done, we took a stand that, okay, certain items can be capable of attributable to the facelift, which has to be charged to P&L. Certain items is strengthening the value of the asset, which gives an extended usage. So we will try to segregate that, but we as an auditor will not have the technical knowledge. We left it to the technical team itself. They have made that, and it has been vetted by a third party consultant, and based on which we have allowed a partial capitalization and partial charge to pay. So it's all the professional skepticism and judgment of the auditor, and of course management will also have a view. I normally believe that in my audit experience of more than 36 years, is got completed now on the 37th year, and if I am taking my articles period also, because right from day one I was doing audit. It's not just like that in any other audit firm where you learn it only on the third year. So if I take it, 4 decades of audit experience is already with me. In all these circumstances, I have a very strong belief, which was actually the belief has been I inherited from my senior. He says that as an auditor, we are going and doing the audit only for part of the year. But the management is running the business. They know better knowledge and better understanding of how the business has to be run. So if you are not listening to the management, the reason behind their conclusion, you are not the good auditor. I still go with that principle. So 365 days when somebody is dealing with that, then I am doing the work only in the last 1 month. I may not be an expert to say whatever they are deciding is completely wrong. That's the reason why I listen to the management and try to understand there is a corroborative evidence as part of my audit process. If it is available, then we accept. If it is totally an innovative accounting, then we will not accept.
Any disclosure required, sir?
Not required, sir. Not required. Not required. Because AS 10 is not saying any subsequent expenditure to be capitalized or not. It doesn't.
Earlier, for ECB loan, we purchase from abroad and we borrow from abroad and we pay realized gain.
Okay. Okay. Right.
Can take this. I have
Okay. The first question which he is talking about is if I have taken a foreign currency loan, how the exchange rate differences will be treated, whether it has to be capitalized or it has to be charged to the P&L account, because AS 11 is different and Ind-AS 21 is different. But even in Ind-AS 21, when you are reading with the Ind-AS 23 on borrowing cost, you will know very clearly incremental borrowing cost which you have incurred. There is a paragraph called paragraph 5E, if I am not wrong. Amortization of the exchange rate differences in the nature of borrowing cost, compensation of borrowing cost. So when you have an ECB loan at say for example 2% and there is an exchange rate difference of 6%, put together it's 8%, where you can take an Indian loan, INR borrowing at 10%, the 6% of exchange rate fluctuation will also be considered as part of borrowing cost as per Ind-AS 23 and not Ind-AS 21. And accordingly, the same principle what we follow continues.
only realized. Unrealized also.
Unrealized also you can take. The unrealized problem is not because of Ind-AS 23, it is because of your Income Tax Act. What he is trying to do is under Income Tax Act there is a section called, if I am not wrong, section 32 capital A. It says that in the block of asset, the cost of purchase and all other direct or indirect costs can be added. Along with that, realized exchange losses or unrealized exchange losses for import of machinery is allowed. So, if I am taking an ECB loan and buying machinery in India, then the entire exchange loss is not capitalizable under the provisions of section 32A. You cannot add it to the cost of the asset. Whether it will be allowed as an exchange loss, the argument or cases are saying that this is relating to a capital asset, so it is a capital expenditure. To that extent, it is not for earning the income, so it is also disallowed under section 37. And in both the situations, you are not going to get that. That has been confirmed by many case laws. Yes, sir.
Actually, we have scrapped the asset, scrap disposal also happened. But the depreciation is getting charged. Should it be delivered to WDB or?
Okay, suppose this is relating to fully utilized asset or assets which has decided to be scrapped. It still have a WDB in the FA register, what I am supposed to do, whether I have to continue to charge depreciation till such time I am disposing it. Concept is known. The moment you have concluded that this asset has to be scrapped, impairment comes in. So you have to either use impairment standard to charge it by impairment, or you have to have an accelerated depreciation because your economic useful life is not going to be kicked in. My suggestion is accelerate the depreciation so that you can consider that for your EBITDA calculation. If you use the word impairment, everybody looks at as if your business itself having a problem.
Yes, sir. Customer is asking me to manufacture to with my supplier, but he is not, he is giving money as a service income. So they capitalize that as a
Okay. For example,
not asset sale and
Understood. What he is asking, the next question is very common in automotive industries. I will take a specific example: mold and dies. When I have to manufacture a particular component, it requires a mold or die. So I have to incur huge cost on preparing that mold or die. So I will say, sorry, this is going to be used only for your product manufacturing. So accordingly, you fund me this money. There are two possibilities. One, the person who is funding this will say, this is my asset and I am paying full reimbursement towards the cost. In that case, you should not capitalize that because it's somebody's asset and he has the control. Control means you can direct him how to use it. When he doesn't want you to manufacture, he can take it back. In that case, it doesn't meet the criteria of an asset, because the control over the asset is lost. So that is possibility one. Second possibility is he will say, I will only fund this money, you treat that as your asset, but I will allow you to charge a portion as part of your selling expenses, amortization over a period of time, 1 million usage, etc., etc. In that case, you will continue to charge depreciation in your books and the amortization will be as part of your revenue. There are only two possibilities.
optionally convertible redeemable preferred shares issued by subsidiaries.
Okay, we will discuss offline, sir. That requires a lot of discussion. It requires a lot of time also.
Major spares.
One second.
Suppose that it is after purchasing A section. Now I am purchasing spares, huge spares.
Okay.
Could I calculate?
Okay. If I have purchased the asset in the AS regime and subsequently now I am purchasing additional subsequent expenditure relating to the asset, whether I can capitalize. Now I have to tell you that in the AS regime as well as Ind-AS regime, the standard is same. They have revised the AS 10 exactly in line with the Ind-AS 16, and accordingly in both the scenarios you have to capitalize, provided economic benefits is accruing to the entity. So, right, sir? Yes, ma'am.
Regarding revaluation, you were telling that whenever the asset is revalued in the US, so we have to charge the depreciation along with the revalue on
Yes.
revalue.
Yes.
So suppose in the transition period, we have some revaluation reserve. What will be the treatment for that?
Transition period, when you are saying, first time they are transitioning from Indian GAAP to Ind-AS. So if you have a revaluation reserve, Ind-AS 101, first time adoption of Indian accounting standard, it says the assets and liabilities that can be recognized in accordance with Ind-AS alone can be recognized in the opening balance sheet prepared under Ind-AS. Since revaluation reserve cannot be part of the recognizable item of reserves under Ind-AS, it will be moved to the normal retained earnings. So you will de-recognize revaluation reserve, add it to your retained earnings, because every adjustment will go to the retained earnings. At the same time, you have to maintain separately under the Companies Act. Ind-AS is nothing to do with that. Under the Companies Act, this being a capital reserve, you cannot declare dividend out of that. You have to maintain separately compliance of dividend. So maybe I will, because we have already taken more than 20 minutes, that 20 minutes is not going to be taken out of the other speaker's time, your lunch time. Okay. So thank you very much for making it so interactive, and thank you very much for bearing me for more than 3 hours, and over to the moderator.
Thank you for the amazing section, sir. The way you had narrated the personal rights incidents made us more interactive. You had asked several questions, thereby making more lively. You had given equal opportunity to all the audience present here so that they can clear and clarify our doubts. I am planning also to do Ind-AS certification course. I think your information will be very much value added for me, and thanks for your valuable input, sir. In spite of your busy schedule, you had gave us a great section and made our day a blessed one. Thank you very much, sir.
Thank you so much.
Now we are going to have a lunch break, and I request all the members to come back at 2 p.m. To take to the next technical section on Ind-AS 37, 116, 117 by our eminent resource person, Mr. C.A. Kamal Garg. Can we have a huge round of applause for our person, Mr. C.A. Kamal Garg? We are very happy to welcome you on the board, sir. Here is a short brief about Mr. C.A. Kamal Garg. C.A. Kamal Garg is a fellow member of Institute of Chartered Accountants of India and First Class Commerce.
I can brief myself. My name is Kamal Garg. I am a gentleman. That's okay.
As per his request, I am leaving.
Don't leave, sit and listen to the lecture.
Yeah, sure, sir.
It is not a part of your syllabus, so why do waste time? So thanks for inviting me, and a very good afternoon to each one of you. And I know post-lunch things are challenging and your faces are smiling. I don't know whether you are giving me deception or not, because when face smiles, the eyes somehow become small. So keep the lights on so that I can see and vouch whether you are sleeping or you are nagging. So before I come to the topic, how many of you have assembled here to get the PPT? Okay, I have now 26 years of experience in seminars and all this stuff. One thing and one question which is quite common. PPT mil jayega kya? Whether I will get PPT or not. So that's why I'm asking this question in the beginning, whether you want PPT or you want the lecture. I would suggest PPT though you will be getting very soon from SIRC. But today we'll be discussing 3 standards given to me. One is Ind-AS 37, second one will be Ind-AS 116, leases, and last one Ind-AS 117, the pain area. So I will be discussing these 3 topics, not theoretically. I will be discussing pain areas of these topics. Theoretically, you are into these standards since long time now, except for Ind-AS 117. So let me ask you a few questions. A simple request: do not search on Google, and don't take the help of Google or WhatsApp University also. So please try to answer these questions very categorically. I will start from leases first of all. Let us take a question for understanding. A real life question, but I am changing our data. So we have a company NTPC. NTPC, you know very well. Now we have other company also in Delhi, NDPL. NDPL is North Delhi Power Limited. Now please listen these words and try to analyze with the help of your own wisdom. NTPC, a power generating company, entered into one agreement or a kind of MOU with NDPL. And the agreement states that out of 100 power generating equipments with NTPC, 20 power generating equipments will be exclusively dedicated for NDPL. That means whatever power is produced by NTPC from those 20 machines, that is meant exclusively and only for NDPL. NDPL is a power distribution company. So normally what the journal entries they will be passing in the books of NTPC, when they will sell the power to NDPL, the journal entry will be NDPL receivables account debit to sale of power account. In the books of NDPL, the entry will be now power purchase cost account debit to NDPL payable account. I place this question with journal entries before the house. You please tell me whether this so-called MOU, which is technically called as PPA, power purchase agreement, falls into lease or not. I have one more question to make you more painful. Let us assume a situation, we have a company Infosys and we have another company Genpact. Genpact is into BPO KPO operations. Infosys and Genpact, they signed one SLA. SLA stands for Service Level Agreement. Now, what SLA states, out of 100 computers or workstations with Genpact, 50 workstations or 20 workstations exclusively will be working only for Infosys, and that too as per the directions and instructions of Infosys. Now, question arises again the same way, whether this SLA between Infosys and Genpact falls into lease accounting or not. I'm asking this question with whole responsibility and authority for a reason. In real world, people are committing mistakes. And I must tell you, all these two questions, all these scenarios fall into lease arrangements. Why? I will tell you. This is the discussion topic of Ind-AS 116. Obviously, I will discuss in detail in a while. Second thing. The second standard I will be discussing is Ind-AS 37, provisions, contingent liabilities and contingent assets. Of late, what I observed, we people as finance professionals are too much focused on provisions and contingent liabilities, and we are least bothered about contingent asset, because the mindset says contingent asset is never accounted, and that's the reason we never analyze also specifically the arbitration amounts. If your company is having some arbitration things going on, and there is a huge probability that this arbitration award will come in our favor, generally people do not disclose. I use the word disclose, not report. They never disclose the same in notes to accounts, because the mindset since our CFNL days is that contingent assets are never accounted and they're only disclosed in board report. Matter over. The same thing is still propagating like that. The third standard I will be discussing is Ind-AS 117 insurance contract. So tell me very honestly, how many of you have read the first 2 pages of Ind-AS 117? Answer is a big no. Your smiles are telling, and some people are very much frank to say no also. There is a very big misconception. I was the part of the draftsmen. I am a member of Accounting Standard Board. So when we were drafting this standard, it took us around a year to understand what Britishers want to say. Now, what they want to say, even they don't know, but we have to say something because MCA is on our head along with NAFRA and other things. You must be surprised to listen this fact that Ind-AS 117 title is insurance contracts, not insurance companies. That means this standard Ind-AS 117 is living in the ages of a misconception that people do say Ind-AS 117 will apply only to insurance companies. No, it will apply to insurance contracts. Your companies or your clients may have several contracts which have the clauses or covenants having the nature alike insurance contracts. Example is performance guarantee. Second example is financial guarantee. Third example is liquidated damages. I can go on and on. So all these 3 examples may, I emphasize the word may, fall into insurance contracts. The way your faces are getting serious, it means that it is an indication or a red flag that tomorrow morning you may be first of all opening Ind-AS 117. Ye kya ho gaya? And I must say, this today's discussion, obviously standard is very big in Ind-AS 117, so I will not invest the time in what is debit, what is credit. Today we will understand whether a particular contract may fall into Ind-AS 117 or not. Because accounting is simple. People may say many things. I believe accounting is simple because we are those CA students who always tallied our balance sheet in our CA final days, irrespective of the fact that it was not tallying. The examiner was confused how the student tallied the balance sheet. So tallying a balance sheet is not a problem. The problem is to identify whether the contract becomes insurance contract or not. I must say, with this whole responsibility and humility, majority companies who are into manufacturing segment and those who are into real estate sector, they may have to revisit their contracts because they generally do include LD clauses. LD means the liquidated damages. If you are the holding company, I am the subsidiary company, and you gave me a corporate guarantee, this corporate guarantee may fall into insurance contract. So you have to analyze the situation. So we'll discuss all this stuff, and then you will, by the end of this session, you'll be happy to understand some great things. So let me start with lease accounting first of all. So how this lease accounting has a history? In 2016, we have International Accounting Standard Board, IASB, in London, and this historically went back to London only. What happened over there? The chairperson of IASB those days was Mr. Hans Hooger Wurst. This Wurst is not W-O-R-S-T, it is V-O-R-S-T. And this Wurst cascaded to worse things in accountancy for a reason. How it started, he was giving a speech someday and he said that in aviation industry what is happening, majority of the airlines are taking aircrafts on leases. So he said, one plane was flying in the sky, it got crashed, and the airline industry said that we are not responsible because on our balance sheet, this is not our asset. So this way it started, and Mr. Wurst said that majority of balance sheet items for a company are under lease, called as operating lease. And it is highly worst scenario to say that you are using these assets on continuous basis, but still they are not coming on the balance sheet. And because of this reason and debate, a concept came, control, which we call as right of use. So now what happened, there are two parties, one is lessor and second is lessee. One is lessor, second is lessee. Please remember, those old days we were saying leases are of two types, finance lease and operating lease. This model of classification still exists, but only for lessors. For lessee, the model of accountings have changed. Lessee will be saying it as ROU, meaning thereby, in my balance sheet, I may say this laptop as my property, plant and equipment. The same laptop will appear in the lessee's balance sheet as right of using this laptop. That is ROU. It may be a debatable contention, but yes, this is what as it stands today. And that's the reason, first fundamental principle is to analyze whether a given arrangement between me and you falls into the definition of lease or not. I repeat my question. The first analysis is to analyze whether a particular arrangement falls into lease or not. And hence I raise a question before the house. Can you please make a distinction between leasing and licensing? Leasing and licensing.
Licensing is for a shorter period of time, whereas leasing is for...
Licensing is for shorter period of time. Let me give you a very minute example. Suppose that this hall is taken on rent to organize this one-day workshop. The agreement between me and you will say, rent for one-day workshop, hypothetically say ₹100. It is a licensing arrangement because I do not have any control on this hall. The word licensing is defined by section number 52 of Indian Easement Act. Now why I am quoting this section? Your contract for this kind of licensing still will use the word rent. That for a single day I will pay you a rent. The question arises, legally it is a licensing arrangement. But can on this licensing arrangement we should apply Ind-AS 116? Answer is yes. Because accounting moves on substance over form. So whatever Ind-AS 116 says, Ind-AS 116 says that in case of licensing arrangements, you need not do ROU accounting. That's why the words are short-term leases. So when you refer Ind-AS 116, what they are saying, that if your lease is for a period of less than 12 months, there is no need to do ROU accounting. So please remember always, this is called as licensing arrangements under the law, that is Indian Easement Act, and it is called as short-term lease under Ind-AS 116. Now where is the discrepancy? The discrepancy is notes to accounts. Ind-AS 116 says, disclose the nature of lease arrangement, irrespective of it is a short-term lease or a long-term lease. Now in these short-term disclosures, what we are writing, that the company has availed some short-term leases. Please correct the language and analyze whether the contract is a licensing arrangement or not. So for this purpose, I repeat, the section is section number 52 of Indian Easement Act. So you have to refer that section in a diplomatic way in your notes to accounts. The series clip about leases. Then I will come back to the NDPL NTPC question. The standard Ind-AS 116 defines lease as a contract if it has these three features. A contract is or contains a lease if it conveys the right to control. Conveys the right to control, number one. Number second, the use is of identified asset. And number third, for a period of time in exchange for consideration. If you see the words are for a period of time, the period is not defined, and that's why the other paragraph of Ind-AS 116 says, if it is short term, do not do ROU accounting, if it's long term, you have to do ROU accounting. The words right to control are extremely significant. There is a checklist. The checklist is, ask yourself these questions given on the second block. If the answer to these questions, question 1, 2, 3, 4, if the answer to those 4 questions is yes, then it will fall into lease arrangement. Then we will check whether this lease arrangement is for more than 12 months or up to 12 months. Depending upon that, it will go into ROU accounting or non-ROU accounting. So the first thing is to analyze whether the contract falls into lease arrangement or not. What are these questions? Question number 1, can the asset be identified? That is, whether it is physically distinct or not. If the answer is yes, I will check second question. Can the customer direct and decide about the asset's use? If the answer is yes, then we'll ask third question. Can the customer means the lessee, can the customer get substantially all the economic benefits from the use of that asset? If the answer is yes, then I'll ask the last question to myself. Can't. Now it is not can, it is can't. Can't the supplier substitute the asset during the period of use? That means the lessor has dedicated the asset to me. Now he cannot change during the contractual period. If the answer to these 4 questions is yes, it will be a lease arrangement. Then second step, 12 months or less than 12 months, ROU accounting or no ROU accounting. With this very 4 question scenario, I place before you this question. Question number 2, I will come to question number 1 in a while. North Delhi Power Limited, NDPL, is a power distribution company. NTPC is a power producer company. NDPL and NTPC entered into a contract whereby NTPC will generate power exclusively, this word is very important, exclusively for NDPL as per the directions of NDPL. So this word, direction, is again very important. Rupee 1 crore worth of property, plant and equipment were dedicated by NTPC for NDPL with respect to above contract. See the word dedicated, again very important. The contract price is rupees 10 crores and the tenure is for say 3 years. The question is whether this contract qualifies as lease. This contract technically in power industry is called as PPA, Power Purchase Agreement. Now, if you see this data, ask yourself these 4 questions. Can the asset be identified by the lessee? Answer is yes, those power generation equipments. Number second question, can the customer direct and decide about the asset's use? Answer again is yes. NTPC have to behave as per the instructions of NDPL. Other one is, can the customer, that is NDPL in example, can NDPL get substantially the all economic benefits from use of that equipment? Answer again is yes. And lastly, can't the supplier, that means NTPC, can't the NTPC substitute the asset during the period of use? The question indicates the word dedicated. So we can take a safe assumption that it is only and only for NDPL. And that's why it becomes lease arrangement. Real world, this is not happening. I cannot name all the things which we discussed in the board, but this is not happening. And I can vouch my words with one example again. Rather, note the example fact. Whenever time permits you, go to Google, and if my memory serves me right, Economic Times in year 2011 published a news. Because those days it was IFRS, Ind-AS was not the word even. IFRS was just the beginning. So those days Economic Times in 2011 published a news, and the news was, once IFRS are adopted by India, majority power purchase agreements will travel into lease arrangements. You may search on Google, this news will be there. Or you can search like this, power purchase agreements treatment under IFRS or Ind-AS now. You will get this news again. And this is only one example, not the exhaustive list. We can have the BPO arrangements also, we can have some other arrangements also. For example, if I take one more note, let us assume you are a tire manufacturing company. If you are manufacturing tires, you outsource some job work to another entity with a condition, you will work exclusively for me. Then whatever machines he is using for your job work execution, they will fall into lease arrangement. The question is not a trouble. The question is, if it is a lease arrangement, the corporates and the clients, as the case may be, they need to decide whether they need to do lease arrangement accounting or they need to devise some mechanics to come out of lease accounting. At least wrong accounting should not happen. I believe this point is clear to each one of you. Because when nothing is coming from your side, it seems like remain calm for 1 minute, speaker automatically will reply. That's why he is invited. So please be interactive also. By the way, yes sir.
This question also the rooftop solar. It is an OPEX.
Yes sir. Yes sir.
We invest and then we only pay for the
power.
Yes.
Nothing else. Now whether this should be, it's a long term, 25 years contract. Whether this should also be, like right to use and then...
One factor is missing in your question, control.
Control.
Who is having the control? The party on whose roof it is installed, or the party who is installing?
In fact, physical control we have. On our roof only it is there.
Physical control, usage control?
Usage control also in my...
Then it will be a lease arrangement. Now when we say control, sir, for the purpose of control, we have to see two things. One is substantive rights. Second is protective right. Suppose that I installed this rooftop solar. I entered into an agreement with you. You look after the solar cell, maintenance, etc., etc. But do not supply electricity from this solar cell to any other neighbor. So I am having a protective right, but you are having the substantive rights. So in that very case, it will be a lease arrangement. Now second thing, shall I do lease accounting or not? You said that it is for long term. So for that very matter, it must be going into ROE accounting. Now third question, although the lease arrangement is for a longer period, that is more than 12 months, whether it is a low value asset or not. If it is a low value asset, again I will come out of ROE accounting. And that's the reason, if I am a, say, resident, a normal individual, and on my roof there is a solar plant or a solar cell, so I will not do this ROE accounting, because either I will not be having the control or it will be low value for me, because government is subsidy. But if it is a case of industry, like for example Cochin International Airport, entire airport is on solar energy. So in that very case, if that solar cell is implanted by some other manufacturer, it could be a lease arrangement. Got my point, sir? Serious question. I discussed this question in the beginning. Let us have a formalization. You entered into a rental agreement with a banquet hall for leasing a space for 200 invitees for celebrating annual day of your company. The amount agreed was for rupees 1 lakh. The space will be used for 8 hours on a particular day, for example 29 March 2024. Question is whether such arrangement is a lease under Ind-AS 116. So please remember, legally it is not a lease arrangement by virtue of section number 52 of Indian Easement Act, which says it is a licensing arrangement, but accounting moves over substance over form. And that's the reason when you will disclose this thing in notes to accounts, what you will write? You will write that the company has entered into certain licensing arrangements resulting in short-term leases. Matter over. Are you getting my point? So this word is required. Certain licensing arrangements. There is no need to refer section 52 because accounting need not have these kind of legal sections. So whenever time permits you, it's my humble submission, please at least for your own record, download section number 52 of Indian Easement Act. See this question also. RST Limited hired security services from DEF Limited. The services included CCTV, 100 numbers installed at various points in the premises, plus the security guards for various entry-exit points. The contract price is rupees 1 lakh and the tenure of contract is for 3 years, whether it is a lease arrangement. It's very common nowadays that people do engage some security agencies and they say, I will also install CCTV with you, and once you will terminate the contract, I will take away my CCTVs. And they are supplying not only CCTVs, but they are also supplying manpower, security guards. So whether it is a lease arrangement. And especially I must ask you, security guards taken on hire, whether it is lease arrangement, you may be comfortable with CCTVs. CCTV, because it's an equipment, you will say yes, it is a lease arrangement. So my bone of contention here is security guard. Because security guards cannot be said as my property or plant or equipment. So what to do? All these are practical questions only, which generally comes to ICAI for any opinion or any suggestion.
Can we replace security guard?
Huh?
Security guard can be replaced
First of all, security guards can be replaced. So by default, it will not go into leasing. Let us make it complicated, sir. Let us assume the security guards are under my control. I will offer them some sweets, some snacks. They are always happy. They always obey me. And the contract is saying that we are into sensitive business. So only those security guards will remain here till end who were there on day 0. Now what to do? Can we capitalize ROU of manpower? I am using the man. No, you cannot. And that's the reason. The logical thing of this is the standard lease accounting leases says that when you pay something under a lease arrangement, you have to segregate the contract price into various components. And those components are lease components and non-lease components. These non-lease components are technically called as service components. If I give one more example, you took the building on lease, and the person who is giving the building on lease says, you give me rupees 1 lakh per month, I will look after housekeeping also. So housekeeping is non-lease component. In the same way here, security guard service is a non-lease component. That means in this question what will happen? CCTV will be right of use and security guard fees will be manpower service or security service, like that. And what is the objective of discussion? This 1 lakh rupees is a console amount. We need to split it into 2 components: CCTV, ROU and security services of security guards. The problem in real world is how to split. Academically it is very simple to say that 1 lakh rupees will be splitted on the basis of relative standalone selling price. As in India we are having relatives with no relation, in the same way this word relative standalone selling price keeps on changing after every 1 kilometer. Why I am saying so? For example, let us take a situation. You are engaging security guards for these premises. You approach 2 agencies. One agency is located nearby airport. Other agency is located, say, in Mylapore or T Nagar. They quoted their own quotations. So question is, which quotation I should accept? Lower quotation, qualitative quotation, or the quotation which keeps me on a good note in P&L? What to do? What is the meaning of relative standalone selling price? The meaning of relative standalone selling price is the price which you have had paid if you have got these 2 components on individual basis. So as per your view, as per your wisdom, if I need to split this rupees 1 lakh, which quotation I should adopt for this area? The quotation given by agency which is nearby airport, or the quotation given by the agency which is nearby Mylapore or T Nagar? I believe you are understanding the question. The basis of selecting the relative standalone selling price. Sir, normal world what is happening? They will adopt that selling price which will have a lower impact upon their P&L. And when this objection is raised by regulators, we have no answers. Because you cannot say to the regulators, "Na, मेरे दिल को अच्छा लगा, my heart felt good."
वो भी कर देते हैं.
हाँ? वो तो सर फिर देखिए, you know, hack है. What you can do, you can do. The thing is, in India, majority professionals are on a wrong path when they try to take quotations vis-a-vis standalone prices. They forget to apply Ind-AS 113 fair value measurement. So standalone.
L1, L2, L3.
Yes.
Proper.
Yes. So we have to understand that relative standalone selling prices shall be in sync with the requirements of Ind-AS 113 fair value measurement. That we are not focusing. I am not saying to increase your workload. I am simply saying at least prepare your working papers, be as a corporate or be as a client, that your file must be a speaking file. That my standalone selling price is on the basis of these parameters, which he is saying very correctly, L1, L2, L3 parameters. So meaning thereby, suppose that sir decided this T Nagar fellow price is good for me because it will be having a lower impact upon my P&L. No problem, you adopt that price. But you have to now prepare on a reverse order why this price is justified. So you justify the price here and here. justify the price on paper also with the help of Ind-AS 113. And the loophole of fair value measurement is only one. Big debate which ever will perpetuate is how fair is the fair value. It is never fair because it is highly subjective. Two words are used in Ind-AS 113. The value which is achievable in the highest possible use and in the highest advantageous market. Now you can very well understand highest possible use and highly advantageous market. With these two words you can play with the words. So I have given you the loophole. I cannot speak much upon it, but otherwise it will become a session of telling something like money laundering. So I will not go into that. But yes, one thing is a pain area. Whenever you derive a ratio or split, please base that ratio on standalone selling prices which are coming close to fair value measurement. By the way, let me divert from the topic a bit. Let me ask you a very interesting question. What is the difference between accrual system of accounting and mercantile system of accounting? I have seen notes to accounts of various corporates. They use the word mercantile as a substitute to the word accrual or something like that. Is there a distinction between these two words? Accrual versus mercantile. And this question is very important also. Why? If you refer ICDS 1, ICDS is Income Computation and Disclosure Standard. If you refer AS1 or if you refer Ind-AS 1, all these number 1 standards, AS, Ind-AS, ICDS, they are using the word accrual. But when you go to Income Tax Act, section number 145, method of accounting, it uses the word cash or mercantile. So there must be some sense, no?
Wherever required is mercantile.
Wherever
required is for accrual basis and wherever required is for cash basis. So
no, sir, I am asking a different question.
Mercantile.
Accrual or mercantile? What is the distinction between these two?
Accrual and cash basis. Both, wherever it is applied is.
I don't find any change, sir.
What
between accrual and mercantile.
Just sir, see. Once we qualify chartered accountancy course now, we know how to say the answers. Like sir said, there is a disclaimer. Normally both are same. So that means one thing is certain, distinction is there. So I will tell the answer in the end. Let us keep it on a suspense side. But difference is there. And the difference, okay, let me spill the beans now, why to wait. See, historically what happened, when this standard was drafted, AS1 originally, a difficulty arose. The difficulty was, those days this NAFRA or earlier days NACAS, they were not there. Only ICAI was the regulator for accounting. So a difficulty was, our accounting standards are applicable to commercial enterprises also, charitable enterprises also. The word mercantile is derived from the word merchant. So a discussion came up. The discussion was, if we will keep the word mercantile in accounting standard 1, which is broadly applicable to all, it will be a wrong perception for those accounting functions of charitable institutions. Because if the charitable institutions are writing, we have prepared our financial statements on mercantile basis, the users will be getting the impression that this charitable institution is into business or commercial ventures. So to keep this thing on a other side, a synonym was thought of. And the consensus came to the word accrual. This way it started. And that's why if you see Income Tax Act, in the entire act, only for PGBP, the word is mercantile. Otherwise the word is accrual. And this is in the cognizance of Income Tax Department also. When CBDT notified ICDS 1, see, ICDS are applicable to PGBP and income from other sources. A charitable institution may have income from other sources. And for that very reason, ICDS 1 also use the word accrual. So you have to be very focused upon words if you are drafting your notes to accounts. Even for commercial enterprises, please do not use the word mercantile. The technical, legally correct word as on date is accrual. That's the difference. So sir, normally this is the small difference. Okay, let us come to this place. I will now take another 10 minutes to complete this standard, and after this discussion, you will get to know many new things. First comparison I will be teaching you as to what is the difference coming up when we traveled from Ind-AS 17 to Ind-AS 116. Earlier days it was Ind-AS 17, which today we have AS 19. So how it makes a difference from AS 19 to Ind-AS 116 or Ind-AS 17 to Ind-AS 116. This will be the first discussion. The last discussion of 116 will be lease term. How to have a lease term. For example, you must have seen various contracts. It is written that either party can terminate the lease after giving 2 months notice. So we will have the analysis of that contractual term also. Just have this example first of all. Imagine that you want to rent some space in the warehouse for storing your goods. You would like to enter into a 3-year rental contract. The owner of that warehouse offers 2 options to you. Option number 1, you will occupy a certain area of XY square feet, but the specific place will be determined by the owner of warehouse based on actual usage of warehouse and free storage. Option number 2, you will occupy the block number 13 of XY square feet in sector A of that warehouse. This place is assigned to you and no one can change it during the duration of the contract. Take 30 seconds and please reply me back as per your wisdom. Out of these 2 options given to you, which one falls into lease arrangements under Ind-AS 116? Option number 2. The reasons are quite obvious. If you see option number 1, asset itself is not identified. Option number 2, it is getting identified. And more importantly, option number 2 also says it is dedicated to you only. No one else can interfere. So that means first step completed. Asset is identified and hence it is a lease arrangement. And that's the analysis here. So when you will get the PPT, you will get the answers also. I am skipping the answer because we have discussed. Now after we have identified whether a given arrangement is a lease arrangement or not, then comes the accounting part. For the purpose of accounting, what do we have to do? Lease price or the contract price and the split. Let us analyze that part also. Now let us assume we entered into option number 2 and the contract price agreed was rupees 10,000 per year. This payment includes the payment for rental of block number 13 and its cleaning once per week. So that means 10,000 rupees per year includes 2 components. One is the rent component, second is the housekeeping component. We have to split it, and for the purpose of splitting, what we need to have? Relative standalone selling price. Question has given you that data. Therefore, you need to split the payment of rupees 10,000 into lease element and cleaning element based on their relative standalone selling price, that is for similar contracts when got separately. You found that you would be able to rent out similar unit in warehouse next door for rupees 9,000 per year without cleaning services, and you would need to pay rupees 1,500 per year for its cleaning. That means after your analysis and workout as per Ind-AS 113, you came to a conclusion the ratio will be 9,000 is to 15,000. Now what we will do? In this ratio of 9,000 is to 15,000, we will split rupees 10,000. Now when we split, based on this splitting, rupees 8571 will go to lease component and rupees 1429 will go to service component. That's the first breakup of this split. Now what we need to do? This lease accounting standard says you have to calculate the present value of lease payments for the entire lease period. Here the question says lease period, let us assume 3 years. Discount rate, let us assume 5%. So for entire 3-year period, we will compute the PV. Now, please remember, theoretically on screen, computation of PV is easy. Real world, the biggest challenge is discount rate. What discount rate should be adopted? I would request the people, do not search on Google and please answer my question. For the purpose of computing PV, which discount rate should be taken? I give you some options. Option number 1, weighted average cost of capital, or incremental borrowing rate, or that rate which equates PV of inflows to PV of outflow, that is IRR. At least first option is ruled out. Weighted average cost of capital cannot be used. Out of other 2 options, you can take any one option. And generally people take incremental borrowing rate. Reason, I must tell you first. I will come back to these calculations in a while. Just see the second part. Discounting rate. Forget the tax part I will discuss separately. Standard says for the purpose of PV, you have to take either the IRR or you can say in other words, interest rate implicit in the lease. And what are the options given? The PV can be computed by either of the following two rates. One is incremental borrowing rate, or now see the first bullet point, or PV, a rate at which PV of lease payments plus PV of unguaranteed residual value, that means PV of outflows, is getting equal to PV of underlying assets plus lessor's initial direct cost. That means whatever cost he incurred, that also need to be factored into while computing this IRR. Real world, what is the challenge? We will not be in a position to get to know what's the lessor's initial direct cost. Even if you will write with the request, now please tell me the direct cost, he will say get lost. It's not your business. And that's why people, what they do as a practical expedient, they do adopt incremental borrowing rate. Generally, they will go to the SBI website and will take MCLR, and that is being taken care of for the purpose of discounting. By the way, this rate should be pre-tax rate or post-tax rate? It is a pre-tax rate because lease payments are also pre-tax. Now I go back to the computational elements. So if I assume that discount rate is 5% and lease term is 3 years, so in that very case, what will happen? You have to compute the PV and then you will split it up. Now I have done the calculation of PV. The PV of rupees 10,000, by splitting it up into service component, it will give you 8571, will be standing at 23341. So PV of lease component is 23341. Now what we will do? We will do a table analysis of unwinding. Now just see what we will do. Opening balance, that is PV opening 23341, add 8% of unwinding 1167, exact payment made 8571, then closing balance, and again it will go on and on, it will become 0 at the end of 3 years. See the journal entries. Now give me 2 minutes on this screen and just see the analysis going to come up before you. Journal entry number 1, initial recognition in the books of lessee, because nothing has changed for lessor. Lessee will do the journal entry as right of use asset account debit to lease liability account with the present value. What was the present value? 23341. Subsequent measurement. Now subsequent measurement will be payment of lease liability and unwinding of interest and incurrence of non-lease element. Just see the journal entry. Interest expense account debit 1167 to lease liability account. How this 1167 is coming? Unwinding. Now other entry, payment of lease liability. So lease liability debit. Lease liability debit. What was the component of lease? 8571. So lease liability debit. Then is expense for cleaning service account debit, P&L debit, to bank rupees 10,000. One more element, that is amortization of ROU, because ROU is intangible. So 3-year period is there. We will amortize ROU also, and that's why the entry is depreciation account debit to right to use. That is whatever amount will come, that is 7780. Now I must raise certain questions before the house, before we go to the comparison of old standard and this standard. Question number 1. If you see the last journal entry, the last journal entry is depreciation account debit. Depreciation account debit to ROU. My question to the people is, don't you think it should be amortization rather than depreciation? Are we on the same page to say that ROU is intangible? Yes, it is intangible. We learned since beginning that intangibles are amortized. So my question is, shall we say this as depreciation or shall we say it as amortization? Asset is identified. So is it amortization or depreciation? Depreciation. In many annual reports, what I observed, people are writing ROU is amortized over the effective lease term. Technically, the sentence is wrong. If you will refer Ind-AS 116, very specifically it is written, ROU shall be depreciated as per the requirements of Ind-AS 16. Ind-AS 16 is property, plant and equipment. Why? The reason this gentleman gave. Asset is identified. And that's the reason, if you are having the notes to accounts recallable, please do cross verify. Are you using the word depreciation or are you using the word amortization? Number one. Number second, majority corporates are incurring one more mistake. When they prepare their accounting notes, accounting policies, very common, we have one policy for property, plant and equipment, other policy for intangible assets. What corporates are doing, the useful life of ROU in a tabular format is given below intangible assets, but it is required to be given below property, plant and equipment. The standard itself says 116 that it shall be depreciated as per Ind-AS 16. So this is first learning. Second question for the house. Whatever you are seeing on the screen, whether it will have any impact upon deferred tax. Please appreciate and apprehend. We do not have any ICDS on leases. We do not have any ICDS on leases. So that means those who are saying yes, they're correct. That means when I pay rupees 10,000 or when I incur rupees 10,000, income tax department will give me deduction for that. There is no capitalization of this lease under Income Tax Act. So it will result in a temporary difference as per Ind-AS or a timing difference as per accounting standard. So proper reconciliations are required. Primarily what will happen, if I take a hypothetical situation, net profit as per P&L account before lease accounting. Net profit as per P&L account before lease accounting rupees 1 lakh. Net profit 1 lakh minus interest expense minus depreciation will give me net profit after lease accounting. Now when I will go to income tax purpose, what I will do, net profit as per P&L account after lease accounting, add back lease accounting and less the expense of lease payment. Are you getting my point? A small question. Again the same request, do not search Google. This interest unwinding for the purpose of Schedule 3 will be debited to which head? Finance cost. It is a finance cost. If you are so comfortable with finance cost, let me ask you one more question which is quite allied to unwinding. We have employee benefits where we do unwinding because of actuarial valuation. So unwinding of interest vis-a-vis employee benefits due to actuarial valuation, where this unwinding of interest which is embedded in employee benefits will be reflected in P&L, finance cost or somewhere else? OCI. Sir, I asked you about interest element, not actuarial gain or loss. Actuarial gain or loss goes to OCI. What about the unwinding of interest? After a long time I am getting a feeling that I am asking CA final questions MCQ. Which of the option is correct? See, please understand, we have guidance note. Guidance note on division 2nd, schedule 3. Okay. Guidance note on schedule 2nd, guidance note on division 2nd, schedule 3 very categorically states unwinding of discount for lease liability, for financial instruments, for employee benefits should go, I am saying the word should go to finance cost. Now there is exception also. However, the companies have a choice only for employee benefits that either they can debit this unwinding of interest or employee benefits in finance cost or within the employee benefits. Generally people have adopted the second option, employee benefits. Now if you are so clear, I must ask one more question over here. You told that yes, we have impact upon deferred tax. You told yes, there would be impact upon P&L. Prima facie, do you think that there could be a major hit on P&L vis-a-vis the old practices of lease accounting in the initial years? Just see the comparison. Had we been into Ind-AS 17 old model of accounting or AS 19 today, for a lessee what will happen? Whatever rent he paid, 10,000 rupees debited to P&L, matter over. But when this new standard came, Ind-AS 116, just see how P&L is getting impacted, and it will impact only initially. Gradually it will come down. In P&L, the new incorporation is interest expense 1167. Other new incorporation is depreciation 7780. And third one is 1429 towards cleaning expense. Now what is happening? Incrementally 376 rupees are impacting your P&L on a higher side. I must also say this impact is for 1 year. But because lease period is for entire 3 years, for entire 3 years put together there is no impact. Ultimately 30,000 will be there, no? Just see. So that's the reason what happened when this Ind-AS 116 was notified with effect from 1st April 2019. Majority corporates are worried because in the initial years P&L is getting hit. And even today, if you are entering the new lease arrangement for the initial years, there will be a problem because P&L is getting impacted with no benefit in income tax set. I am having a different question. Let us change this topic for a while. I must ask you one question which should also be tormenting one. Companies do have independent directors, right? Now the sitting fees paid to independent directors. The sitting fees paid to independent directors in P&L, where it should be reflected as per Ind-AS regime. Has any answer? Huh? Other expenses? When we were students now, we were taught only one thing. Silence amounts to fraud. So those who are not telling that means they are having a deemed consensus of those who are saying other expenses. Sorry? Remuneration. But there is no such head remuneration in Schedule 3. Some may say legal and professional charges also. Some of you must be having PSUs as clients or maybe working in PSUs. So in PSUs we have nominee directors also and they are paid sitting fees. Where should be shown? CSR. Because it's going to the nominee directors now. So corporation responsibility. In fact, what is happening, all of us are on a wrong tangent. There is a huge locus shift in Ind-AS 19. Ind-AS 19 deals with employee benefits. Ind-AS 19 very categorically states, for the purpose of this standard, employee will include all the directors and key management personnel. Employees will include all the directors and key management personnel. If we go to accounting standard AS 15, what it is writing? For the purpose of this standard, employees include whole-time directors. So just see the shift. AS includes only whole-time directors as their employees. But here, when you come to Ind-AS, all the directors are covered. And even if you will say that I am not believing independent director as a director, even then there is a trouble. Because for the purpose of Ind-AS 19 as well as Ind-AS 24, party related, KMP includes non-executive directors and independent directors. So what is the learning coming up? In your P&L, whatever sitting fees we are going to pay to independent directors or non-executive directors, it will be reflected at two places. One is employee benefits, second is RPT. RPT means related party transaction. And this is a change. Now just see, I always have a kind of amazing note. People say financial statements are meant for users of financial statements. Now the users are getting confused whether I should say independent director as my employee or I should say he is my safeguard shield or something else. The kind of differences which are coming out in all these regimes is adding more towards the confusion. But yes, the law is the law, we can always debate, but we cannot change it. So the learning here is, there are two-way learnings. Unwinding of discount vis-a-vis employee benefits may have an option either to go to finance cost or employee benefit itself. And second is a caveat precaution. The precaution is whatever sitting fees is being paid to independent directors or non-executive directors under Ind-AS regime, it falls into the category of employee benefits. You see this question now, last question, then I will switch to other standard. A company has opened a branch at a building by signing a rental agreement with the landlord of the building on which branch is situated. The initial agreement will be for 10 years and either party can terminate the agreement at any time by giving 2 months notice. The tenure of the agreement can be extended at parties' consent. The company has no intention to discontinue the branch operations in near future. However, the loss-making branches may be subject to relocation or closure in future. What is the lease term in this case and how to account for this lease? How to count you know very well, we have just seen, but still, major question over here is, what is the lease term in this case, because the lease term will change the entire fortune of this question. If you will say lease term is 10 years, are you counting? If you will say lease term is less than 12 months, no, are you counting? This question is very significant, especially for those companies which are having branches and that don't rented premises. And this is one of the standard which is not liked by banking companies. Although banking companies are yet to come under Ind-AS regime, but they are under a fear factor. If at all Ind-AS are applied to them, it will be a very major hit because most of their branches and ATM vending machines are on rented premises. See and imagine what kind of a hit they have to bear on P&L.
There is no non-cancelable period here, so it should be considered a short-term.
Yes, so first part is the non-cancelable period is only 2 months. Now sir, the other question which is allied to it is, shall we say because it is a contract for 10 years and 2 years is the non-cancelable period, so it is a short-term lease and hence ROE counting is not required. Now what people are doing in real world, people are taking a misuse of exemption. People always say it's a 2 months notice period only, so non-cancelable period is 2 months because the lease term defined by this standard is lease term means the non-cancelable period. The non-cancelable period is 2 months. Now corporates always do an argument. The non-cancelable period is 2 months only, so it is less than 12 months. No need to do ROE accounting, but they are oblivion of a fact that this so-called 2 months non-cancelable period is used by the corporate again and again because it is renewed, extended, and that's why Ind-AS 116 says at the inception, the word is inception, at the inception of lease you need to define your lease term which is a non-cancelable period of lease, but while deciding this lease term keep 2 things in mind. Number 1, periods covered by an option to extend the lease, and number 2, periods covered by an option to terminate the lease. In real world what happens, generally leases are getting renewed year by year. This indicates that you have no intention to terminate, and that's the reason if there is a probability to continue, then it will still fall into ROE accounting even the fact is 2 months of non-cancelable period. And what corporates are doing, not all but I should say more than majority, they are misusing this only first sentence, non-cancelable period. They are not going to other 2 sentences. So what is the point here? If you are doing audits, then you have to have working papers with you. Why you decided that this period is a short-term period or is a extendable period. And if you are an auditee, you also must have this kind of a computation or a working analysis in your file. And having said that, I must ask you the last question over here. When we say lease term, I said the words at the inception of the lease, at the inception of the lease. What is the distinction between inception of the lease and commencement of the lease? Inception versus commencement.
Inception is first time, commencement is even after renewal.
Okay, quite close to the correct answer. Inception is the date on which the contract is signed. Commencement is the date when you get the control over the asset, and that's why commencement date can come many times in the life of the lease contract. Like here, when the contract will be renewed, again a new commencement. So it will create a havoc, and that's why the standard says whether the lease term is short term or long term, you will decide on inception. And maybe it can happen on inception you are not sure whether it will be extended or not. If next year it is extended, then you will have to account on ROE model, because you are rebutting a presumption taken by you on inception. You missed one more thing when I was discussing this topic. Let me go back and ask you a last question finally. Deliberately I rushed over here because I wanted you to be in trouble. The series second bullet point and first sentence. Under Ind-AS 17, based on warehouse economic life. The same economic life word is used in Ind-AS 116 also. My question to the people is, what is the distinction between useful life and economic life? Property, plant and equipment, intangible assets, both these standards are using the words useful life. Ind-AS 116 uses the word economic life. Even in past, Ind-AS 17 uses the word economic life. So this clip of no use, there is no answer on it. So what is your takeaway on distinction between useful life and economic life?
See, it should perform as it is, right? I mean, take a laptop for example. It could still be useful after 4 or 5 years, but it will not perform the same level as it performed on the first day. So that distinction is what is economic life and
yes, right. We try to recall our older days when we read the accounting for the first time, how the asset was defined. Asset is a resource controlled by the enterprise from which economic benefits are expected to flow to the enterprise. That means the economic life is dependent upon the economic benefits shell life. If I say the layman example, suppose that sir is having a car. Sir used this car for 5 years. After this, he sold this car to another gentleman. He used this car for 10 years. That gentleman sold the car to other one. He used the car for 3 years. Now we have 5 plus 10 plus 3. That means total 18 years. Now we have one life, 18 years, and 3 standalone lives, 5, 10 and 3. Out of these two, option 1 and option 2, which one will go to useful life and which one will go to economic life? Option number 2 will go to economic life because you are deriving benefits out of it. And option number 1, that means 5 plus 10 plus 3, it is useful life. And each category is economic life. Assets are depreciated over useful life, meaning thereby when sir will sell the car, then he will be depreciating 18 minus 5. Real world it is not happening. If you are buying a second hand asset, normally what people are doing, they will jump to schedule second and will see where the asset is falling in the slab, and then they will start afresh. Whatever depreciation is a wrong practice. I hope when I will go back I will be safe, because being like so many mistakes are there. So before I leave for the tea break, I must also emphasize, because I was told by a board when I was in ASB that once you get to Chennai, spread this message also, because this message is required pan India. What is the message? And it's a learning also for each one of us. There could be a possibility that a company may have, or maybe I should not say the word company, entity complying with Ind-AS may have the assets which are at WDV 0 in balance sheet but have physical existence in the premises. This could happen. Now the problem statement here is the entity is using the asset, generating the revenues out of it, benefits out of it, but the matching principle is getting failed. Now how it is getting failed? The cost of using that asset in the name of depreciation is not coming up on the debit side of P&L. But revenue which is generated is there, so matching concept is getting failed. It results in a kind of accounting mismatch. So question is, if this is the problem statement, before I give my version of solution, what is your take on it?
But the expense is already expensed in the previous years.
Expense the previous year, how sir?
Already
Audit depreciation though we already consumed. Now what happens, sir? Let us take a situation. There is a laptop, sir. Now laptop is depreciated fully. So in balance sheet it is 0. But in my FAR, fixed asset register, it is still appearing, right? My staff is still using the laptop. The benefits indirectly are coming to me. But the cost of using this laptop, other than electricity, other than other things like wear and tear, That is not coming in P&L. So matching concept is failing, and one more element is failing, that is Ind-AS 16.
Real pre-adjustment need to be made.
No need to do pre-adjustments. What is the requirement, sir?
Revaluation.
Revaluation, yes, that's the correct answer. We have, sir, AS 10 revised and property, plant and equipment, and the same way we have Ind-AS 16 property, plant and equipment. Both are same nowadays. What it says, that entities need to review useful life at least annually. Now, when I know that this asset is 0 WDV, but still I am using, that means asset is still having some life in it. It is not a ventilator. That means it's an indication that I must go for revaluation. And in such a case, what will happen, sir? When revaluation will take place, automatically depreciation will come. Now, what is happening in real world? People are not going for revaluation. If you don't want to go for revaluation, either substantiate the asset is low value asset. When I say low value that doesn't mean by cost. Low value means the substantial benefits. Either substantiate that it is a low value or go for revaluation. So now what we have to do, you have to make an analysis. If in your FAR there are 10 assets, and out of those 10 assets, only 8 are appearing on balance sheet, but all the 10 assets are contributing to your EBITDA, then that means that something is missing. Obviously, material factor always come into play. And this is what in real world happening. So this completes from my side the Ind-AS 116 all stories, and I am really thankful that you are still on awakened side. You have not slept. So I think, sir, Anna, tea break is there or not? Acha, you are here. I thought you were. You are sitting in the front. I never noticed you. So break is there or not?
Before going for tea break, I would like to invite Mr. C.A. Balasubramaniam sir to present shawl and memento to our resource person.
Last mein kar lenge na.
Okay, we can do at the last.
Sometimes, you know, I feel when this kind of felicitation happens now, it seems like it's a lifetime achievement award, and they are saying don't come again.
So it's a memory for you.
A memory. So I will take this memory towards the end. No?
Yeah. So now we can go for a tea break for 15 minutes. I request all the team members to come back after 15 minutes.
I am very sorry, you must have prepared some speech. So I didn't give time. I learned the speech also. We are thankful to sir coming from Delhi all the way long, and one very common statement, taking time out. Okay, let me assume that we are not aware of Ind-AS, but I cannot take this assumption for accounting standards. So corresponding to this, we have AS 29, provisions, contingent liabilities and contingent assets. AS, I am saying AS 29. The same question again, whether AS 29 deals with trade payables and accruals or not. Ma'am, let me again ask my question. My question is whether trade payables and accruals are dealt by this standard or not. I am not asking whether it's a provision or not. Are dealt by this standard or not? Yes. Yes, because the question is asked, that's why the answer is yes, or it is yes. Normally, my experience had been that, okay, if it is the yes answer, if it is the yes answer, employee benefits payable, whether it is called as provision or trade payable or something else. And please do not say something else, because this is the option looking a bit awkward.
Other liabilities.
Huh?
Other liabilities.
In fact, your answer is correct.
Other liabilities.
He is also surprised. मेरे को लगता है. See what is happening. I will show you the screen also. Half of the population in corporates, when they draft their policies regarding trade payables and accruals, they always refer guidance note on Schedule 3. I am not saying it is wrong, but it is incomplete. We have para number 12 of AS 29 and para number 11 of Ind-AS 37, which deals with trade payables and accruals also. I will show you the screen. So when you say provisions, the paragraph says why it is not a provision, and depending upon that we have to draft a policy for the same. We will see one by one. So 3 topics are there: provisions, contingent liabilities and contingent assets. let us start with what is provision. So, Ind-AS 37 defines provision as a liability. Provision is a liability of uncertain timing or amount, and it is a present obligation. This word present is very important, because the same definition you will again find for contingent liability with only one change. The change is, instead of writing present obligation, there the word is possible obligation. So the definition says provision is a liability of uncertain timing or amount. It is a present obligation from past events. It is a present obligation from past events, and it may result in outflow of economic resources or benefits. Now the caveat here is, they say this present obligation may arise either because of a legal obligation or a constructive obligation. That means provision is a liability which may arise as a result of two obligations, either constructive obligation or legal obligation, and if this obligation is expected to result in outflow of economic benefits or resources, it needs to be accounted for in your P&L, because prudence is the concept. My question to the house is, what is the distinction between legal obligation and constructive obligation? And second question which is allied to it is whether this concept of legal obligation and constructive obligation is there or not in accounting standards regime.
Legal obligation is on account of any contract or something.
Okay.
Constructive obligation is based on business practice.
Okay, I can take this one, business practice. First of all, please understand, when you go to AS 29, Accounting Standard 29, there is no concept of legal obligation or constructive obligation. The distinction of legal obligation and constructive obligation is only and only in IFRS regime, and in India it is Ind-AS regime, Ind-AS 37. The words themselves tell the story. Legal obligation means an obligation which is rising under any statute. For example, payment of taxes, PF, ESI, etc. These are all legal obligations. When it comes to constructive obligation arises from practices, customs, traditions. That means where you do not have any realistic alternative but to pay, and the other party is having a valid expectation out of you that you will fulfill this promise. It is a constructive obligation. For example, the Pavali bonus. It may not be contracted with you, but the company has a practice that they will pay, and that's why it becomes constructive obligation. One more example, and I would suggest each one of you to check your company's website also. On the website of a company, it's a real fact I'm telling you. On the website of a company, it was written in the CSR responsibility statement that the company is cognizant of environmental damages, and the company assures the general public that environmental damages will be restored. Now, whatever damage took place, no restoration happened. But when you see the P&L, no provision for restoration liability was provided. This is the contravention of Ind-AS 37, because Ind-AS 37 says, if by virtue of your statements, you have raised a valid expectation in the minds of the user, then it is a constructive obligation, and you have to create a best estimate of that provision to be provided for. And those of you who are with those companies which are listed and are complying with BRSR, Business Responsibility and Sustainability Reporting, they must be highly cautious. Highly cautious. In BRSR report, we have to report upon 9 principles. P1, P2 to P9. In any of these principles, if you made a statement which may incur a liability in future, you have to provide a provision for the same. For example, your company made a statement under P3, employee workforce. You made a statement that the company is planning to induct some handicapped employees as a matter of their empowerment. In that very case, whatever possible outflow can happen on their employment and recruitment, it needs to be provided for as a constructive obligation in your financial statements. Obviously, there can be some exceptions. Exception could be if, say I am the auditor, I said that in your BRSR you are making this valid expectation, there is a provision. You may say that we have this plan, but the timing of plan implementation is not more than 50% in immediate next 12 months, so what will happen? The probability of outflow will be remote, and then there is no need for provision. So what I experience in corporate houses, that this constructive obligation accounting is very poor. There can be many such instances, and for this purpose you have to refer a director's report. If the company is listed, you have to refer MDA report, management discussion and analysis report. If the company is listed, you have to refer BRSR report. You have to refer company's website also. Wherever any kind of commitment is being given, which may entail outflow of resources in immediate next 12 months, and the probability is more than 50%, provision needs to be provided for. And if provision is not provided, then disclosures are required, that the company has made these constructive expectations in the mind of the users, the provision for which is not provided because the outflow is remote. So this is very cautious thing which we need to ponder over. So what I said is something like this: every liability which may result in outflow is not accounted for as a provision, because these factors need to be pondered. First, there must be a present obligation out of past events, number one. Number second, the outflow of economic benefits to satisfy that obligation must be probable. The distinction between probable and possible is the 50% range. This 50% range is not given by ICAI or any other institution. It is a customary accounting practice across the globe. So if the probability of outflow is more than 50%, we will call it as a probable one. If it is less than or up to 50%, it is called as possible one. If it is less than 50%, it is called as possible one. If it is less than 10%, it is called as remote. That is the criteria which accounting traditions do follow. And lastly, the amount of economic benefits required to satisfy this obligation must be reliably estimated. In my personal view, these words used in the standard, reliably estimated, are highly unreliable words. Why? If a company wants that the P&L should not be hit, what they say? Probability to hai, there is a probability that outflow will happen, but amount is uncertainable. And they will do all the hanky-panky things to establish that amount is unascertainable. So what will happen? P&L is not hit. The second thing is, auditor will say, I will qualify the report. They will show you auditing standard number 706. You cannot qualify, it is emphasis. Company is also happy. Market sentiments are also happy. Auditor in this planet can never be happy, because he will always keep on thinking, even after signing the audit report, whether I was right or I was wrong. And if the God will be kind to you, which in fact he is kind, a new article will come to your office for training. You will say, please read this audit report to get familiar with the company, and you will find 100 faults in your audit report, and you will say, sir, your audit report is wrong. Again, this will be called as Nafra Junior. What I am trying to say, whatever you are doing over here on this reliable estimation, please have proper documentation that these estimates were unreliable because of these reasons. And what to do for this purpose, you may take a note. Even if you are working in corporates, this still can be helpful. We have a standard on auditing, SA number 540. It deals with audit of accounting estimates. So if you are working in corporates, you may use it as your indicative element. You may say that as per SA 540, estimates are unreliable because of this reason. Excuse me. By the way, what is the difference? What is the difference between event and transaction? Because what they say here, past event, not past transactions. So difference between events and transactions. For example, you signed a contract, the party 2 years back, and now what happened? You breached the contract. The party took you to the court and was filing a claim for damages called as liquidated damages under section number 73 of Indian Contract Act. Now, the contract was signed, advance was given, it resulted in a transaction. So whether it will be called as an event. Distinction between event and transaction.
Transaction is when money is being transferred
Yes.
at the same time.
Event is that component that gives birth to transaction. So whenever money values are exchanged for goods or services, that result in transaction. So transaction is an exchange. That means event is a big set, transaction is a subset, and that's why intentionally the word event is used in this standard. Past events, it may or may not include happening of a transaction. Just see this thing which I was discussing. This is para number 11. Para number 11 of Ind-AS 37. The same paragraph is there in AS 29 also. That is para number 12. So here it is 11, there it is 12. Now para number 11 deals with trade payables and accruals. Just see very carefully, and specifically when I will come to the note in the last bullet point. Para number 11 of Ind-AS 37 says that provisions needs to be distinguished from trade payables and other liabilities like accruals. Now what they have defined? They have defined trade payables as well as accruals. What they say? They say trade payables are liabilities. Trade payables are liabilities to pay for goods or services that have been received or supplied, and the word "and" is very crucial, and have been invoiced or formally agreed with the supplier. So invoice itself is a kind of formal agreement to supply. Whereas when you see the word accrual, the first sentence is same. Accrual are the liabilities to pay for goods or services that have been received or supplied but have not been paid, invoiced or formally agreed with the supplier, including amounts due to employees, for example, amounts relating to accrued vacation pay. Now what is the distinction coming up? The prime distinction is when we come to trade payables, it's a formal agreement or invoicing. But same thing is not there in accrual. Now what is the precautionary note which is given by Ind-AS? Ind-AS 37 says, although it is sometimes necessary to estimate the amount or timing of accruals, the uncertainty is generally much less than for provisions. Accruals are often reported as a part of trade and other payables, whereas provisions are reported separately. With this very small discussion, I raise a question before the House. The question is, as at 31st March 2024, some amount is payable to employees as employee benefits payable. Whether this will be shown as a provision or it will be shown under trade payables and other liabilities. I mean trade and other payables. And why this question is important? When you go to Schedule 3, in Schedule 3 we have current liabilities as well as non-current liabilities. When you deep down current liabilities and non-current liabilities, we have one component provisions. In the component provision, there is a separate heading, provision for employee benefits. So if you say employee benefits payable will come into provisions, why? If you say employee benefit payable will come into trade payables, why? So what is the distinction now? What is your take? Employee salary payable as on 31st March 2024. Whether it will be reflected below trade and other payables, or Schedule 3 itself is having a specific line item, provision for employee benefits. Whether it will be shown as provision for employee benefits. Salary payable will go to trade and other payables. What will go into provisions? Leave encashment, maybe gratuity benefit, maybe terminal benefit. So whatever normal course of salary is there, month by month, that will go into trade and other payables. That distinction is required. And obviously, when we have the provisions for employee benefits, we will split into current and non-current. I must ask you one interesting question over here. They say trade payables and accruals, and then the heading is trade and other payables. So they are writing accruals are often reported as a part of trade and other payables, whereas provisions are reported separately. The words are provisions are reported separately. The word is reported, not disclosed. Whenever in any standard, it's a kind of a golden rule. Whenever in any standard the word is used reported, that this element should be reported. It means that this element is not confined only to presentation on the face. It also requires some additional disclosures. That means the word reported here means in balance sheet you will show it as a provision. In notes to accounts you will describe that provision, plus you will also show movement in provisions. Opening balance, additions minus deletions equal to closing balance, and that too item by item. Item by item means there could be other provisions also other than employee benefits. That we need to be very careful about. Next, let me ask you before I show you here. Suppose that there was a mishappening for which you filed an insurance claim. Okay. Now the loss because of mishappening was provided for, say the amount is rupees 10,000. Expected insurance claim which you are very certain will be received, because ultimately what they have given you a check. They have given you a check and you will present it after 31st March. So question arises, if the loss is of rupees 10,000 and insurance claim sanctioned and duly given to you as check also is rupees 8,000, what you will do as an accounting presentation? Will you offset it? Will you offset it or will you present it separately? So I have two options. Either in P&L, on the debit side I will say loss rupees 10,000, and on the credit side I will say insurance claim rupees 8,000. Or second option is in P&L I will say loss 10,000 minus 8,000 equal to 2,000. What should be done? Second option, offset.
Yes, we can netting off. In
In fact, if you say offset, this is the wrong answer. And you know, majority corporates are doing offset only. Why do they do offset? Because sentimentally, if in P&L somebody will see na insurance claim, it is not a good sign. So what they do offset. And this offset is prohibited in Ind-AS 37. Very categorically it is prohibited. Technically it is called as accounting for reimbursements. Just see what I am trying to say. Sometimes entities have right to reimbursement of related expenditure by third party, for example, from an insurance company. In this case, a right to reimbursement is recognized as a separate asset, no netting off with provision itself. It is specifically prohibited. So if you are doing it sentimentally, an auditor is also happy. Either you have made the auditor happy or the auditor is not aware of this provision. I am saying very bluntly. But what you need to understand, if this offsetting happens, it warrants a qualification if the amount is material. How many of you know what is the concept of onerous contract? What is, yes sir, onerous contract?
Cost is exceeding the income.
When the cost is exceeding the income. Can it happen that the benefits are exceeding the cost, but still it is onerous? Because you use the word cost, that's why I am saying question is there. This question came to this light because of the word used cost.
Benefit comes now and cost comes much later without announcing.
Okay, so again the word is cost. Okay, let me make this question simple. So as per your understanding, what is cost? What we are going to incur is cost.
Outflow of resources.
Outflow of resources. In fact, she is right. Outflow resources. Cost here will include not only your operational cost but penalties also. So if you are supposed to exit from a contract, and in order to exit from the contract you have to pay something as a damage, that is also part of cost. So as far as the answers are concerned, if I club answers given by sir and ma'am, the cost here is not the normal cost, not the regular cost. If you include all such outflows, that may land you into trouble. That is what is known as onerous contract. So just see the screen, second block first of all. Standard says onerous contract is a contract which in which unavoidable cost. So cost is separately defined as cost of fulfilling. Now cost of fulfilling also includes penalties, fines, etc. exceed the benefits arising out of that contract. Loss contract that cannot be avoided, that is burdensome contracts. So when there is a loss contract, burdensome contracts, the standard says you have to make a provision at the lower of two things. One is unavoidable cost of fulfilling the contract or penalty for not meeting your obligations from the contract. We will do a case study also on this, a real life case study with some chain links. Do we need to create a provision for future operating losses? And this is happening a very real way in India because of startups. So startups say that we are into the business and some new business for next 3-4 years there will be only losses. So some of the startups, what they did, they provided a provision for these kind of losses. Can they do so? Answer is no. The standard specifically prohibits to create a provision for future operating losses. Why? Because future operating losses are avoidable losses. You can avoid with some course of actions. And that's what the standard says. For future operating losses, column number 1, should not make a provision for future operating losses because there is no past event, number 1, and the future operating losses can be avoided by some future course of actions. And yes, if some future operating losses are going to happen, it is a kind of a precaution. Always test whether the assets are getting impaired or not. So happening or a possibility of happening future operating loss in future is an indication of impairment of assets. If there is impairment, we have to go by Ind-AS 36 as well. Restructuring. What they say, restructuring is a plan of the management to change the scope of business or a manner of conducting a business. For example, earlier you were using Bajaj scooter. Now you made a plan. You are a company, Zomato company, मान लीजिए. You are a Zomato company. So Zomato field boys, they were earlier using Bajaj scooter, which was creating pollution, was having old technology also. Now what they did, the company Zomato decided now they will use electric scooters. It's a restructuring plan. If it is there, then whether it needs to be accounted for, answer is yes. And for restructuring plans, Ind-AS 37 will be applicable. That means the amount you will be incurring for implementation of restructuring plan needs to be provided for as a provision. Now just see the words. In case of restructuring, this third column, second block. In case of restructuring, an obligation to restructure arises. It happened in real world, I will tell you. Obligation to restructure arises only if there is a detailed formal plan for restructuring and a valid expectation related to restructuring has been raised in affected parties. I can tell you example by taking the name of the company because it's in public domain now. There is a PSU NBCC, National Building Construction Corporation. When time permits, you download the annual report of NBCC of year 2019-2020. What happened? In North India, there is a place called as Gurugram. Earlier days, Gurgaon. So NBCC was having an apartment building in sector 37D, Gurgaon. That building was constructed very old days, maybe in late 2000 or so. Gradually what happened, the building developed cracks. And some teams were appointed like IIT, engineering teams. All these teams gave a report that this building is not safe for your accommodation. Now what happened? All the residents of that building, they shouted that where should we go? NBCC is responsible. Now what happened when the rounds of meeting took place? After these rounds of meeting, in 2023 or maybe 2022, I need to check, the residents and the company, they came to a conclusion. The conclusion was NBCC will refurbish this building after demolishing the structure and creating a new one. And meanwhile, whatever the transition phase is there, the company will provide them two options. Option number 1, to take the refund of the amount they have given for purchasing this building, obviously with the indexation rate, whatever will be there. Or the second option is, we will provide you alternative accommodation without any rent. So this was the formal scenario which happened. Now the question is, this formal agreement happened by the balance sheet date, but nothing was paid. The question is whether NBCC needs to account for the amount involved in exercise of these two options, either refund or take alternative accommodation. Answer is yes. Now the challenge is, NBCC is not aware or not sure how many residents will go for option 1 and how many will go for option number 2, and that's where the word comes for probability. Are you getting my point? So depending upon NBCC discussions, they need to analyze that the probability is like this or like that, and then the provision will be created. This is also called as a kind of restructuring with valid expectation, because in this case NBCC is having no realistic alternative but to exercise these two options, either of the two. Are you getting my point? Now comes to contingent liability. Before I discuss contingent liability, I placed before the house this normal general question. The board of directors, BOD's board of directors, recommended dividend for rupees 10 lakhs for the financial year 23-24. How shall this be treated in financial statements of 23-24? Only disclosure. No debit credit?
No debit.
Okay, agreed. For this first answer, agreed, no debit credit. And you said, sir, disclosure. With a whole smiling face, you said disclosure. What disclosure and where the disclosure? Keep this question in mind, and with this question in mind, read the definition of contingent liability. The definition of contingent liability is two-way definition. The first limb is a contingent liability is either a possible obligation, not present, a possible obligation from past events that will be confirmed by some future event, or other thing is a present obligation arising from past event, but either the outflow is not probable, that is less than 50%, or the other one is the amount cannot be reliably measured. So second limb we already discussed when I was discussing provision. If it is less than 50%, it will go to contingent liabilities. But now let us come to the first limb. The first limb says contingent liability is a possible obligation arising out of past events that will be confirmed by some future events. So here two events are connected. With this first block, because second block we already covered, with this first block, I again ask you this question. So let me break this question into 2-3 limbs. First question in this question is whether outflow of resources is apparent. If at all dividend will be paid, there will be some outflow. Whether two events are apparent. Is there any past event? Yes. Company's performance in past. Company's agreement with shareholders in past. Agreement means the memorandum and articles of association. And how dividend is confirmed? Board recommends. Shareholders declare. That means whether the board recommendation will fall into finality or not is based upon a future event, that is shareholders approval. That means it is a contingent liability. In India, what is happening? Disclosure is happening, but the placement is not happening. Normally what is going on towards the end of the disclosures, whatever is left, last points, something like last journey of the man, and the last thing is take the God's name. So in the last page it is written, the dividend is recommended by the board, but the placement is wrong. It is not a residuary disclosure. The placement must be under contingent liability, and where? When you see schedule 3, contingent liability, then some headings are there, like claims acknowledged but not, like this. There is others item also. Contingent liability, others. Within this others, statement written, others, if any, please specify. It is that, if any, specify. And now your faces are telling me that whatever I discussed is quite close to your companies or clients also. And that's why whenever we say that disclosure, we also need to always be careful. Disclosure, nowhere proper placement is required. And why the placement is required? Try to recollect Ind-AS 1. Ind-AS 1 very categorically states, disclosure does not mean haywire disclosure. They must be properly cross-referenced, properly sequenced. And that's the sequence which we are missing. So it will go into contingent liability. Last discussion and then one case study, then we'll move to Ind-AS 107. Contingent asset. This is the normal, yes sir. Notes to accounts, where we have this disclosure of contingent liability. Last item of contingent liability is others. This will be others. Contingent asset. In the whole standard, this is the only statement about contingent asset. A contingent asset is a possible asset arising from past events that will be confirmed by some future events not fully under entity's control. Very simple definition. And below this definition, one more statement is here which I forgot to copy paste here. The statement is contingent assets are not recognized. Contingent assets are not recognized in financial statement but are disclosed. But for disclosure there is a reason. Disclosure will happen when there is a certainty kind of element. Let me give you a real life case. Only thing is I have removed the company's name. So the company is here RST Limited. It constructed highway for NHAI. NHAI stopped payments to RST Limited because highway was of not good quality. This dispute was referred to arbitration cell of Delhi High Court under the Arbitration and Conciliation Act. RST Limited won the arbitral award and NHAI was ordered to make the payments. NHAI appealed against such award. Whether the arbitral award won by RST Limited is contingent asset. So you can see the definition. Possible asset? Yes. Arising out of past events? Yes. That will be confirmed by some future date event? Yes. Is it under your full control? No. So full control is not there. Now other thing is the next paragraph, whether this level of certainty is more than 50%. Now what is happening in real world, generally auditors and the corporate houses do not involve their legal team into it. They take the decision on their own. I must put this on record before this house. We have section number 34 of Arbitration and Conciliation Act. Every appeal against arbitral award is not a good appeal because there are certain conditions. For example, if the award was given to you in your favor and there was unfairness. Unfairness means the arbitral bench was not independent or the arbitral award was against public policy. So certain parameters are there. In this case what happened, those parameters were absent. So the legal team said that there is a high probability that this appeal will not sustain in the High Court. So what will happen? We cannot do debit credit accounting, but we will disclose in notes to accounts that this company may be made entitled to this award, and then the brief description of what happened. So if in your case there is a case of arbitration or something like this, please always involve your legal team. And I must tell you with whole humility, do not take this opinion from auditors. Auditors are good in standards, auditing, accounting, whatever. They may be good in Companies Act. This is the allied law, arbitration law. So for this purpose, either involve a legal team or a legal consultant, and then take a call whether it must be there in your financial disclosures or not. Why this disclosure is important? If a company is going to be valued, in that very valuation, this arbitration award plays a very vital role. And for your convenience, I can name the company also. Why to hide it? Because the information is in public domain. The name of the company is ERA, E-R-A. ERA Infrastructures Limited. It's a listed company. So this company went into CIRP. CIRP means Corporate Insolvency Resolution Process. Now what happened in this case? This appeal was going on, but this company made a good thing. They took a legal opinion, and on the basis of that opinion, they disclosed in the financial statement that this is happening. The benefit was when resolution plans were invited, a good value was offered. Because in this very company, Air Infrastructure, there were no real assets. So only asset which was a kind of a bait or a coveting asset was arbitration claims. So this disclosure in fact is a survival. So you have to take a legal team into confidence. Now there are certain case studies, some of them I discussed orally. One case study of onerous contract is pending. Let us discuss that case study also. Yes, two case studies rather. First case study is a company, Siemens Company. Siemens Company operates a set of water parks with layer facilities for families in Gujarat. This is a real case, only name is changed. You may recall Gujarat earthquake happened. Those days this is the case study. So I repeat once again. Siemens Company operates a set of water parks with layer facilities for families in Gujarat. Recent earthquake and world financial crisis caused that number of visitors in water parks dramatically dropped. Siemens Company estimates that the number of visitors will not increase back within next 2 years, and as a result, Siemens will make a loss of rupees 3 million each year. What should Siemens Company do in the financial statements? So the company is expecting that for next 2 years there will be loss. Anything needs to be done as far as recognition and measurement is concerned? Answer is no. Why? Future operating loss. And that's the conclusion here. Because it's a future operating loss, nothing need to be done for such kind of a loss. In the same continuity, other element is, except for water parks, Siemens operate also 2 theme hotels in Gujarat. Hotels are held under non-cancelable operating lease that expires in 3 years. Siemens managers estimate that due to overall decrease in number of visitors, hotels will make annual loss of rupees 1 million each year if continuous operations. Siemens may also prematurely terminate the lease, but with the penalty of 2 million Indian rupees. What should Siemens Company do in the financial statements? The contract is onerous, so nothing is coming as a benefit, only costs are getting incurred. So what amount should be taken care of as a matter of provision for onerous contracts? Lower of 2 items, and what are 2 items? Penalty and the contractual flow, and that's the thing over here. So create a provision at the lower of penalty to exit the contract or loss in case of completing the contract. So let me show you the journal entries also. Journal entries will be like this. Impairment of assets account debit to, no, this is not the journal entry. Journal entry will be provision for onerous loss account debit to provision payable account. Now you can take the nomenclature as you wish. Question for you. When you will create a provision for onerous contract by passing these journal entries, will it have any impact on deferred tax? Will it have any impact on deferred tax? Ask yourself a question. Whether this provision will be allowed in income tax at any time in future. This provision will be allowed only when there will be an actual loss. So if this provision will be allowed only when there will be actual loss, is it a temporary difference or a permanent difference? It's a temporary difference. It's a temporary difference. You can have an analogy for this, no? We have ECL also, expected credit loss. It is a temporary difference. And more importantly, let me ask you the last question over here. We discussed so many things of Ind-AS 37. Is Ind-AS 37 having any connection with the director's report? I repeat, is Ind-AS 37 having any connection with the director's report? And please don't say yes. I want yes, it is having connection because of this. See, if you try to recollect the section number 134, section number 134 is there in the Companies Act. Section number 134 deals with director's report. Section number 134 subsection number 5. Section number 134 subsection number 5 deals with director's responsibility statement that must form the part of director's report. Section number 134(5), if my memory serves me right, is having clause number B or C. That clause says directors have to acknowledge their responsibility for two things primarily: company's going concern, and second is estimates are reasonable. So whenever you come across provisions, contingent liability, all these are estimates. So whatever declaration board is given there in the director's report, they must have the basis. Now in real world, what is happening? In real world, when the financial statements go for approval to audit committee and the board, first they go to audit committee and the board. Nobody is checking how the estimates are made. If you check the minute record of your board meeting, simple one paragraph: the financial statements are taken on record as approved by the audit committee and we recommend the auditor's appointment, etc., etc. Not even a single paragraph is there which substantiates that yes, the estimates were properly vouched or properly considered by the board. So I would recommend to the house, if there are provisions or there are other estimates also like employee benefits estimates, please do take up this as an agenda item in the board meeting, and same for audit committee meeting also if you have audit committees, so that it is minutized. Only after getting it minutized, you will be able to substantiate the compliance of section 134 subsection number 5. So this completes your provisions, contingent liabilities and contingent assets. Let us come to the next move, Ind-AS 117. I will start this discussion with a precaution. If you belong to a company on whom Ind-AS are applicable, but that company is yet to approve the financial statements, maybe some of the companies may have a sort extension of AGMs. If your company is yet to approve the financial statements which are based upon Ind-AS, before approval of financial statements, please be cautious. In notes to accounts, you have to give a paragraph about impending changes with respect to Ind-AS 117. We do have Ind-AS 8. Ind-AS 8 says that if by the date you approve your financial statements, certain new standards have been enacted, a brief description and the possible impact of the same needs to be given in notes to accounts. It is called as impending change. Unfortunately or fortunately, you may decide, in the history of Ind-AS, for the first time what happened, MCA played with the emotions. MCA notified this standard on 12th August 2024, but made it applicable from 1st April 24. The real trouble will arise for those companies which are listed, because they have already published first quarter results and it requires a lot of revamping in accounting functions. So this could be a real heat to do. By the way, before I discuss this standard, I must ask one question once again. How many of you have read this standard or downloaded this standard? Reading. And I must tell you, when you will download this standard, for the first 1 week at least, you will lose the interest to read this standard. This standard itself is a complete book. So you may keep one book for all these standards and one this Ind-AS 117. And more importantly, when you will read first 10 paragraphs, you will forget what was written in the first paragraph. The way it is drafted is highly technical. When I started reading this standard, I am reading this standard for last 5 years. Because this standard is in making for last 5 years. When I read this standard for the first time, because the institution board, accounting standard board, what they will do, they will simply give you the standard. And very politely they will write, please submit your comments. Now then I saw this bulky standard, I said no comments, do whatever you want. But yes, we have to fulfill duty. Though I should tell you why I am discussing this thing. The best way to read any standard is only one. Do not read the standard. Read the illustrations given in the standard. By God's grace, today I know accounting gaps of 130 countries. I am thankful to my teacher, D.S. Rawatji, who is no more on this planet. He told me only one thing when I was 18 or 19. Today what time I will not tell you, why to disclose the age. So my teacher told me one thing, Kamal, you go to any country, 4 things can never change in accounting: income, expense, asset, liability. And in all the accounting standards, US GAAP, UK GAAP, IFRS, whatever you study, German GAAP, the dispute is only one. Whether a given item should be recognized as income or a liability, expense or as an asset. Now this hit me hard. I said, this is correct. Baat to sahi hai. This is very much correct. So I asked my teacher, sir, what should be done? The same thing he told me which I told you. He said, whenever you start reading any standard, do not read the standard. Read the illustrations. And this theory I applied for the first time on accounting standard 15, employee benefits, which was older days, it was a tough standard. I read all the illustrations and I gave a thought why this is treated as an income or as a liability. That changed my perception. We are at such a stage now that we cannot sit for a month in a coaching class for Ind-AS 117. Let me be very honest. Sitting for 8 hours itself is a challenge. Half of the time when we go to any program or a seminar, the tension is going on in subconscious mind. Whether my boss will call, or whether the board meeting will be called upon, or VC will be called upon. So this is tough to do. Let us be practical and feasible. The best way is, when you download the standard, leave everything, do Control F, and simply search illustration. Whatever illustrations are there, you read that illustration with a mindset. Why this treatment is going into income or expense, asset or liability. I must say 90% of your botheration will wipe out. And you will make it 100% by the time you finish the all illustrations. Now what is going to be discussed here? Here I will not discuss what to do debit, what to do credit, because that is a separate topic altogether. The main agenda we will keep here today is for Ind-AS 117, whether non-insurance companies are also getting impacted. Answer is yes. So let us have a ice breaking on introduction. So Ind-AS 117 insurance contracts replaces Ind-AS 104. Ind-AS 104 was earlier, which was very petty standard, small standard, nothing tough. In place of it we have Ind-AS 117. Now this standard applies to insurance contracts, not only insurance companies. So if your company is having some contracts of that nature which falls into the definition of insurance contract, Ind-AS 117 is applicable. We will learn what are those insurance contracts which may be there for manufacturing companies or other non-insurance companies. I told you this thing already, effective date. The standard was notified on August 12, 2024, but is made effective from 1st April 2024. There are 3 models of accounting. I am simply briefing. Once you identified that this contract is insurance contract, one thing is common to all the insurance contract, that one party will indemnify the loss of other party. That's the basic theme of any insurance contract. Now, once we identified whether a particular contract falls into insurance contract or not, the second is how to do accounting. For this accounting purposes, 3 models are prescribed. I am simply briefing, details we will see in some other seminars. First is GMM, general model, general measurement model. Second is PAA, premium allocation approach, and third is VFA, variable fee approach. Very simple, only words are technical, otherwise it's simple. Let me brief you in a very simplistic manner, then we will read here also. Suppose that there is an insurance contract and it is for more than 12 months. There is an insurance contract and it is for more than 12 months. Then we will apply GMM. Why GMM? Because in GMM we have to compute present value of a new term again, fulfillment cash flows. Now what is fulfillment cash flows? In the entire tenure of my insurance contract, what will happen? I will get premium or a consideration. I will get a premium or a consideration, and there will be a probability of indemnification. So PV of premiums minus PV of probable outflows towards indemnification. It is called as fulfillment cash flows or contractual service margin. So earlier days what was happening, the very moment you received the premium, you booked the income immediately. Now this cannot happen. You will recognize this premium received as a kind of advance from customer. and this advance from customer is called as contractual service margin. Are you getting my point? And this whole approach is called as general measurement model. If I read it for you, this is the default model where the liability is measured as the present value of future cash flows adjusted for risk and contractual service margin, which differs profit recognition over time. So, for example, the insurance contract was for 10 years. Premium was rupees 10,000. So, what you will do? First year, no income recognition. Second year, 10,000 divided by 10. First year of profit recognition. Earlier days, premium is recognized immediately as an income. Now you will spread it up. That's the only change. But precaution is, in this you have to complete PV also. Now there could be insurance contracts which are for up to 12 months. Then what we will do? No PV computation. Because there is no PV computation, we apply premium allocation approach. Allocation means for each year you will have a separate allocation of premium income. And that's why the words are, it's a simplified model which is meant for short-term contracts. Short-term is less than or up to 12 months, where liability is based on unearned premiums and claims. That is VFA approach. Now variable fee approach. What is the meaning of this model? We must be aware we have unit-linked insurance plans. So whatever premium you give to the insurance company, they'll put a money as a parking money to investment purposes. So whenever any participation features are there, investment features are there, the approach is VFA. What happens in VFA? Whatever money insurance company is investing on behalf of you in the mutual funds or any other funds, that will not be a part of its income. The income will be X percent fees that insurance company is charging towards this investment as a kind of fund manager. More or less, most of us, whether belonging to insurance companies or non-insurance companies, will fall into either of the first two models, GMM or PAA. Modeling is not tough. The tough is to assess whether a given contract is insurance contract or not. I must tell you, those who are into practice, it's a very big opportunity to grow the practice in this insurance contract. And those who are into job, it's a big challenge for them to revisit the contracts and check whether this covenant is going into insurance clause or not. You will get to know in a while. Just see the definition of insurance contract. Ind-AS 117 says insurance contract is a contract under which one party, that is issuer, accepts significant insurance risk. Please keep these words in mind, significant insurance risk. I will come to it again. A contract under which one party, that is issuer, accepts significant insurance risk from another party, that is policyholder, by agreeing to compensate the policyholder if a specified uncertain future event, that is called as insured event, adversely, very important word, adversely affects the policyholder. General perception across India is the words used are policyholder, and hence it is applicable only for insurance companies. Please understand, for the purpose of Ind-AS 117, policyholder includes even those persons who are getting indemnified under any contractual commitments. So this policyholder is not the common parlance word which is effective in insurance industry. It may include even non-insured parties out of insurance companies. Now, what do you need to understand? Let me share with you some examples. Then again we will go back. Case number 1. You have just seen the definition. What the definition says? Party A, Party B. Let me hide it, otherwise you will see here. We have Party A, we have Party B. What they agreed? They agreed through a contract. This contract, for the purpose of Ind-AS 117, is called as policy. So it is not a normal parlance word of policy. It is a contract. Party A, Party B, they entered into a contract called as policy, whereby Party A promised Party B that if because of some events beyond your control, that is adversely affecting you, and going to incur some significant loss, then don't worry, Party A will come to your place and will indemnify you. The major element of this whole agenda is two-way agendas. Loss must be significant. That is called as significant insurance risk. And loss must arise out of some adverse event, uncertain adverse event, not because of operational inefficiencies. With this background, let us see several case studies and you will get to know what Ind-AS 117 has in store for you. So we will start from easy case studies to tough case studies. Case study number 1, very simple case study. ABC General Insurance, an insurance company, offers motor vehicle insurance to its clients. The insurance covers damages to vehicles due to accidents, theft or natural disasters. In all the case studies, we will assume that loss is significant to keep them simple. Now whether here this is insurance contract or not? Answer is yes, because there are two parties and adverse impact is going to be borne by insurance company. Even if I simply write insurance company, by default it will go into Ind-AS 117. So how to analyze? Identify whether there is insurance contract or not. The motor vehicle insurance contract obligates ABC Insurance to compensate policyholders for damages to their vehicles if certain uncertain events such as accidents, theft, disasters occur during the policy term. Now whether this is significant, I assume that this is significant and that's why it will be accounted as per Ind-AS 117. Now see other question. XYZ Electronics. Now company name is not insurance company. So be very careful. So we are now coming into non-insurance companies. XYZ Electronics, a manufacturer, offers extended warranties. Please focus on these words, very important words. XYZ Electronics, a manufacturer, offers extended warranties on its products. These warranties cover repair costs for product defects over a 2-year period beyond manufacturer's standard warranty. Before you give any answer, let me ask you one more question because both are correlated. Number 3rd case study. ABC Automobiles provides a standard warranty for all its vehicles. The warranty covers defects in materials and workmanship for a period of 12 months from the date of purchase. The warranty includes free repairs for manufacturing defects. The basic distinction between case study number 2 and case study number 3 is, here it is a standard warranty, there it was the extended warranty. So please tell me, in case study number 2, is there insurance contract or not? First question is, whether two parties are involved? Answer is yes. Whether the loss which is going to be caused to second party is because of uncertain events? Answer is yes. Whether it will be adversely affecting that second party? Answer is yes. Assumption is it is significant, and that's why it is insurance contract. Why insurance contract? There is a more feature. This warranty is not a normal warranty, it is a purchased warranty. Had it been a part of original sale contract, then Ind-AS 117 is not applicable. But because it is extended warranty, it means that insurance contract standard 117 becomes applicable. That's the biggest change which this standard brought into being. Yesterday I was in Hyderabad. The same topic was there. So member said, "Kaise hoga? How we will do this thing?" That is not the problem. Why? Because if industry will be solely banking upon consultants, it will be a big challenge. Industry also need to educate itself. And what I suggested, read the illustrations. It will automatically be beneficial. Now, this example enshrines one more thing. Those corporates like LG Electronics, Samsung, those who are into home appliances, maybe automobile companies, extended warranty, maybe laptop Dell company, they always say, na, pay us some money, we'll extend your warranty. This warranty is not the original part of your contract. So they need to evaluate, re-examine whether they wish to remain in Ind-AS 117 or they wish to come out of Ind-AS 117. I must say with whole humble submission, advise your clients to please remain outside Ind-AS 117. Because the kind of calculations it involves will be a big headache otherwise. if you want to take revenge from your employer, then please suggest go into Ind-AS 117. Choice is yours. The story is not so simple. Tough questions are still waiting. Now, warranty you understood? Now other questions. This we covered. Number 4. XYZ Electronics sells televisions and offers a 3-year extended warranty at no additional cost to the customer. The warranty covers repair or replacement of television if it stops functioning due to electrical faults. So 3-year warranty is there. Ask yourself whether it is the original part of your contract sale or it is additionally given. It is original part. Original part, sir. No additional cost is written. So it is the part of original contract. That means it's the warranty for quality assurance, not any kind of a compensation per se, and that's why it is not the insurance contract. So how to make a distinction? Just see this table. This table will be useful. Whether a particular contract will go into insurance contract or will go into other standards, these points can be helping as a checklist. Risk transfer, first point. It will go into insurance contract if it involves significant insurance risk for future uncertainties, but it will remain either in Ind-AS 37 provisions or revenue if no significant risk transfer is there. The warranty is more in relation to quality performance. Nature of coverage. Ind-AS 117 applies when the contract covers uncertain future events like breakdowns or accidents, whereas non-insurance contract will include those product defects which ensures performance of the product. Premium. Separate premium is charged in case of insurance contracts, but in case of other one it is bundled into one. Just last question we did. Another one is purpose of contract. The purpose of contract in Ind-AS 117 must be indemnification for losses, whereas Ind-AS 115 or 37 it is not indemnification but upkeep, that is maintenance. This is the simplistic side of warranty. The real challenge is about performance guarantee, financial guarantee, and last topic, liquidated damages. So before I go there and discuss questions with you, whatever up till now you have understood, if at all you have understood, in Ind-AS 117, what is your view whether performance guarantees, financial guarantees, and then liquidated damages, they may fall into insurance contract or not? Answer is yes. But ultimately, what is the caveat? The distinction point, whether whatever loss is arising is because of operational efficiencies or inefficiencies or because of a external event, that is adverse event. That will be a decisive factor. So I am sharing with you 3-4 examples. First is performance guarantee. ABC Limited signs a contract to build a power plant for XYZ Limited for Rs 50 crores. ABC Limited provides a performance guarantee that the plant will meet an efficiency of 100%. If the efficiency falls below that due to unforeseen external factors, ABC Limited will compensate XYZ up to Rs 1 crore. Contract value is 50 crores and compensation for shortfall is 1 crore. This is the question before the house. You please tell me whether it will go into insurance contract or not. Ask yourself, everything is significant. Ask yourself 2-3 things. Whether 2 parties are involved, answer is yes. Whether one party is going to indemnify other party, answer is yes. Risk is significant, I am assuming. Now, one thing is left to be decided. Whether whatever amount ABC will pay to XYZ, shall I do the accounting in Ind-AS 37 or shall I do the accounting in Ind-AS 117 as insurance contract? Ask yourself whether this liability is arising or may arise rather, this liability may arise out of external event or because of project mismanagement. What the question says? External event. If this liability is arising because of the operational inefficiencies like project mismanagement, it will go into Ind-AS 37. But here it is the external event. So it will go into Ind-AS 117. That's why I told you. Better it is to revisit the contracts so that you may remain in Ind-AS 37. But the very moment you will go into Ind-AS 117, then calculations are cumbersome. The way we calculate present value in Ind-AS 37 is entirely different in Ind-AS 117. Now, this answer is already given, so I am skipping the answer. Number 7 case study, financial guarantee. XYZ provides a financial guarantee for rupees 20 crore loan taken by its subsidiary PKR Limited from a bank. The guarantee covers defaults up to rupees 5 crores triggered by, now be careful, triggered by specific economic or business conditions. Amounts are also given to you. So what is your wisdom saying? Will it go into insurance contract or not? Ask yourself the same questions again. Where two parties are involved? Yes. Whether one party, that is parent company, is going to compensate or indemnify the subsidiary company, other party, answer is yes. Significance I am assuming. Now only one question is left. Whether this will go to financial instruments, Ind-AS 109, or whether it will remain into Ind-AS 117. Ask yourself a question. Whether this indemnification is arising, or rather it will arise in future because of external events or because of credit risk. Economic recession is there, like lockdown happened, and because of this the company defaulted. It will go into Ind-AS 117. But if I change the question, I change the question to other thing, that the company was sinking, it was not having good business orders. It is a credit risk. That means we have to make a distinction whether this default is taking place on account of credit risk or because of external events. In such a case, if you say it is external event, it will go into insurance contracts. And again the same thing I will reiterate, that you have to revisit the contracts. So for example, you have a subsidiary company, you have a holding company, generally intercorporate loan transactions happen. So whenever intercorporate loan transactions are happening, please make sure that whatever guarantee you have given, that guarantee must have proper clauses so that you may remain out of Ind-AS 117. Better it is to remain in Ind-AS 109. So answers are already given. The last question of this day, liquidated damage is LD. ABC Construction Limited is building a highway for DEF Limited valued at rupees 100 crores. ABC Limited agrees to pay LD at 0.5% of contract for each week of delay up to a maximum of 5%. The clause also specifies that damages apply only if delay is due to unforeseen external events, and some values are given. Ask yourself the same questions again. Two parties are involved, answer is yes. Indemnification laws is there, answer is yes. Now the only one question is left. The question is whether this LD is going to be paid because of operational inefficiencies or because of external events. It is because of external events, will go into Ind-AS 117. Had your answer been that this LD is arising because of operational inefficiencies, the proper standard will be Ind-AS 37. And that's the main context of 117 for which this chapter was kept in today's program. Again, I will reiterate, revisit your contracts. And if possible, please make efforts to keep your company outside Ind-AS 117. If it is not possible, nobody can help. But yes, if it's possible, please keep the company outside it, because otherwise accounting will be a big challenge. So much of computation and so much of disclosure is there. Ind-AS 117 came at a time when even today people are not comfortable with Ind-AS 109 financial instruments. Now Ind-AS 117, I don't know what is going to happen. I always do say, are we drafting financial reports for users called as general users, or are we drafting these reports for regulators who themselves may not be aware what is this Ind-AS saying? For example, if the company say Reliance Industries Limited, in Reliance Industries Limited, you are also investing, CPI is also investing, Autowala is also investing. Now when Autowala will read the annual report of Reliance Industries Limited, what he will do of Ind-AS 109 or Ind-AS 117? He will see only one thing, profit. Profit positive hai na? Good. Then four friends. Tune kya kiya, what you did? I invested. Okay, I will also invest. So in a country where investment goes into these companies by sentiments and hearsay, we are discussing about these typical standards. And what is happening because of this? Auditors are always fighting with the management. Management is also fighting within itself, and then they will come as a team to fight with the auditors. Ultimately what is happening? Clean report. Because clean report is given, then you also don't know, I also don't know, so better it to stay clean. You are also my friend, I always was your friend. So ultimately I will conclude my speech with only one saying, whatever standards are coming, instead of impairing our own standard of studying, raise the bar of your own standard, read the illustrations. Half of the battle is over, maybe 90% of the battle is over if you read the illustrations of any standard. Why? All these illustrations are taken from real world. Only thing is they do some changes because of the illustration nature. So thank you very much for the patient listening. And now ma'am, the floor is all yours. You can do whatever you want. But I never wanted to waste the time. Thank you very much. And sir was there, so he was requesting my phone number and email ID. So I'm not contesting elections, so no problem. So my email ID is cakamalgarg@gmail.com. And my phone number is 98110-54015. 9810-54015. Right? Tamil. So this is known as, sir, repetition sir, badi mushkil se bola hai. So I will repeat in English. Again, repeating in Tamil will be tough because for last 10 minutes I was reminding myself. So it is 98110-54015.
Okay. I'll have to talk.
Thank you, sir.
Shall I also conclude this speech because...
Thank you, sir. The section was really amazing. To be concise, I will put a big I for your section. That is informative, interesting, Ind-AS section. It gives me an immense pleasure to deliver the vote of thanks for this event to the dignitary assembled here. I would like to thank our resource person, coordinators, technicians and all board person of ICAI. Last but not least, our beloved audience. Without you, we can't make this section a great success. Once again, I thank you one and all present here. Now I would like to invite Mr. C. Balasubramanian sir to present shawl and memento for our resource person, Mr. Kamal Garg.
This is known as audit documentation. Center again.
Excuse me, sir.
Once again, thank you, sir, and thank you one and all present here. Have a great day.